Good morning, everyone. Morning. Thank you. So I know some of you have been staying in Bristol before today, and I hope that you've enjoyed your time so far in our city. A little over 12 months ago, my company became a publicly traded company, and at the time, many people told me that the UK did not need and could not have a Bitcoin treasury company, but I did not agree. I think by seeing how the market is developing globally and also in the UK, more and more people are now seeing what I believe, which is that Bitcoin treasury companies will become some of the most valuable companies in the world in the future. And I think that what we're witnessing at the moment, particularly with some of the things that many of you will be aware of, is the reinvention of global capital, and that's digital capital built on the Bitcoin standard. Late last year, I was chatting with Ed and Tim from Bitcoin Treasuries Media, and we said how great it would be if we could have an event in the UK. So there and then we agreed to organise this event, and then over the last couple of months, we've put all the things that you can see in place for today. Laura from my team, wherever she is, deserves a very special mention for pulling all this together, because when I say we've pulled this all together, it's been primarily her. So before I hand you over to the wonderful and talented Jessie Myers to give you an overview of the UK asset landscape, I just want to thank everyone else who's made the effort to come here today. You know, all the speakers who'll be sharing their views with you later, and importantly, all the sponsors. You know, without the sponsors, this event couldn't take place. And I'd also like to give a special mention to KeyRock. KeyRock have produced an overview of the European Bitcoin treasury sector. They've got copies out at the front, and they should be in your bag. And it's a really good document, which I hope you will all enjoy. So that's enough for me for the moment. I hope that you have some good conversations with each other. I hope you enjoy listening to the various different speakers and panels that we've got in store for you today. And I look forward to talking to many of you as the rest of the day unfolds. So over to Jessie. Thank you.
All right. Hello, everyone. Okay, so today I'm going to be talking about the UK asset landscape. And this is a report we put out very recently, so you can view the full document on our website if you go to shareholders, then presentations and media, and SWC perspectives here. So a few years ago, I wrote a piece called Bitcoin's Full Potential Valuation. And to do that, I needed a starting point of how much value is in the world. And the point of that is to understand what's the total addressable market for Bitcoin, and then how much Bitcoin could take from that. And in writing that piece, I realized there wasn't a singular view of that global asset landscape. So I did the research and put this chart together. And Michael Saylor read that piece and very much liked it and incorporated it into his presentations and made it the basis for Strategy's Bitcoin valuation model. So there's three main takeaways in my mind on this chart. And first is just how small Bitcoin still is in the global asset landscape. It's still only 0.2% of global asset value. The second is it helps you to see the potential for Bitcoin. I think in that piece I concluded that a conservative end state for Bitcoin might be to take 20% of global asset value. Saylor then argued it might be 50%. So somewhere in that range, I think, is the potential for Bitcoin. And obviously, that's a long way to go from where we are today. The third thing is this chart is kind of a map for where capital sits in terms of asset allocations in the world. And Strategy has used that frame of thinking to create what they've done. They've pioneered this new model of what a Bitcoin treasury company looks like. And they have created various public equity offerings that target different capital buckets, whether that's equities or the fixed income market or money markets. And they've been incredibly successful in doing that. I'm sure everyone here is quite aware of how successful Stretch has been recently in particular. Strategy has been buying 25,000 Bitcoin a month for the last 3 months, and that appears set to continue into the future. So what they're effectively doing is meeting capital where it's at and offering a value proposition to fixed income investors and money market investors, similar sort of thinking of they're looking for yield, and Stretch offers fantastic yield, and I think is still mispriced risk. It's, in my view, quite unrisky. And they've been very successful, and I think this will only continue, in attracting capital from fixed income. And what they're doing is they're buying Bitcoin with it, because they believe that Bitcoin will appreciate at 29% a year, and that makes it a better value proposition than anything else out there. So that's the model they've pioneered and have been very successful with. But this is a global view, right? So it's a little unfair here. We're sort of assuming that Strategy is reaching all global capital, but global capital is really segmented by regulatory jurisdictions. And that's where the UK comes in. So what does this look like for the UK specifically? And what matters to the UK and in running this sort of playbook in the UK? Well, what matters to the UK, first of all, is this. I think we've seen over the last few decades how the pound has lost its purchasing power, and the UK is experiencing pretty rapid debasement. The headline on the left, it was immortalized in the first Bitcoin block by Satoshi, but there's a little advert there for 1 pound pints. And recently there was an article a few weeks ago that made a big deal about how there are now 10-pound pints in London. And yes, I'm cherry picking. One is notable for how cheap it was, one's notable for how expensive it is, but that's a 14% CAGR if you were wondering. So the backdrop for the UK is that the pound is losing its purchasing power. What are you going to do? We wanted to do the same analysis specifically for the UK and see what it came up with. And this is the result of it that you can read about in that report. And the UK commands 6% of global asset value, and it's distributed in these buckets. And let's see how that compares to the overall distribution for global assets. You can see that it's slightly different in terms of the weighting of the different buckets. So this is the UK. Equities and money in particular stick out. They are heavier buckets than for the global landscape. And that should be no surprise. That's the legacy of the British Empire, basically. The UK is a financialized economy and has 9% of global equities value and 10% of global money. And that's really the result of the UK being the international banking destination for much of the world, much of Europe, Africa, and the developing world. So there's a lot of money, especially in bank deposits in the UK and in London in particular. And yeah, the reality of the legacy of the British Empire is that the UK is the financial plumbing for much of the world. And despite being only 0.5% of the world's landmass, 1% of population, 3% of GDP. UK commands 6% of assets, 9% of equities, including 10% of global money. And yet, the UK lacks Bitcoin products. So SmarterWeb is the first Bitcoin treasury company in the UK and the largest, and there's still room for more Bitcoin products in London, in the UK in general, and we're excited about that potential. So, what we think we are on track to do is replicate the strategy model in the UK. That's what we want to do, and that starts with our equity SWC, which is listed on the London Stock Exchange, and represents the same sort of Bitcoin-powered equity potential that we hope is attractive to all of this, equity capital that sits in the UK jurisdiction. That's 9% of global equities value that hasn't had a native Bitcoin treasury company, and with SmarterWeb, that can increasingly attract capital from London Stock Exchange capital, equity portfolios across the UK that are looking for better returns and might be interested in a balance sheet that's appreciating at hopefully 29% a year as strategy theorizes. So that's how the global asset landscape translates into a specific jurisdiction for the UK. And I think in doing this analysis, we realized just how perfect, in my opinion, the UK is for a Bitcoin treasury company, especially in the spirit of what strategy has now pioneered. Specifically because there is a ton of equities capital, 9% of the world's capital, of the world's equities capital, and 10% of the world's money sits in London, in the UK, and might be interested in products that deliver better returns than they can get elsewhere. And I think that Bitcoin is the key to doing that because of the precedent that strategy has now put in place with how successful their preferred equities and their equity have been over the last 5-6 years. So that's the UK asset landscape as it currently stands. Now there's 6% of the world's value in the UK, 9% of global equities, 10% of the world's money, and I think it makes it the perfect jurisdiction to repeat the strategy playbook of what a Bitcoin treasury company can be. Great, thank you.
Hello, it's really great to be here with all of you in this room this morning. My name is Danny Lopez. I'm the chair of Aquis Stock Exchange. We've heard about the London Stock Exchange, so wanted to make sure that we also talk about Aquis Stock Exchange today, and it really is an absolute pleasure to be with you today. So first of all, thank you so much to the SmarterWeb company and Bitcoin Treasuries Media for bringing us together. And having the opportunity to spend the next few hours talking about your world, which is absolutely fascinating. So Aquis Stock Exchange, this is a word from one of your sponsors, by the way, but I will keep it very brief. Aquis Stock Exchange is a UK-recognized investment exchange. We have the same regulatory profile as the London Stock Exchange, and we're now owned by six. Six operates stock exchanges in Switzerland, and also in Spain. So we have a large group behind us now. We are part of the second largest primary exchange group in Europe, accounting for 15% of market share. So whilst we have a big backer behind us, I think it's also really important to stress that at our core, our DNA is exactly the same DNA as the one that everybody in this room has. We're hungry, and we're focused on scaling. We are extremely entrepreneurial. we're agile when we need to be, and we're extremely ambitious. So, and scrappy when we need to be, right? Which is exactly, I think, where everybody is in this room. So, so that's who we are. I think the differentiator from our perspective is that we have a personal approach to how we deal with companies listed on the exchange, a flexibility that we're very proud of, and as I say, a sort of relentless focus on innovation. When I think about how we've progressed over the last few years, we're all about embracing new technologies, emerging sectors. I think that it's, we were a natural home for the Smarter Web Company's IPO, and have been also the natural home for a number of you in this room, five, six companies, I think, many of whom we'll be hearing from later in the day. And look, I think the main message that I wanted to stress today is that we believe really strongly in what we've just heard, right? The future and the ambition behind the opportunity. We believe really strongly in the ecosystem that you have created over, frankly, the last few months, right? We believe very strongly in the opportunity ahead. We want to be a part of it. And not only do we believe in the ecosystem that you're building and that you're growing, but of course, we're also very firm believers that the public markets can play a very big role in realizing your ambitions. And when I talk about public markets, there are a number of them, but at Aquis Stock Exchange, as I say, we are extremely focused on being part of your growth story. So that's really all I wanted to say. I've got a couple of colleagues with me here today. I think they're in the room, Steve and Natasha. So Steve, Natasha, and myself will be here over the next few hours, looking forward to having a number of conversations with you, but frankly, looking forward to hearing from all of our speakers. So thank you very much again, and have a wonderful day. Thanks.
Lovely, thank you. Good morning, everyone. Thanks for the warm welcome this morning, and we are running so far ahead of schedule, it's unbelievable. I'm here with Henry, Scott, and Joe. Hello. Some familiar faces, so welcome everyone. The topic this morning is a really good one. It's around perspectives on Bitcoin and Bitcoin treasury companies from a few folks that might be in both. So we'll find out. I guess let's start, Joe, we'll start with you and maybe go around. How do you think about Bitcoin versus Bitcoin treasury companies? How do you balance them? Are they two distinct categories? And is one better than the other? Does one build on top of the other? He's already laughing, so I'll stop there.
Well, firstly, thank you for the invite, and congratulations to Andrew and the team for putting on the first Treasuries Conference in the UK. I presume it will be the first of many. I'm also very grateful to Andrew for inviting me on to take part, because I'm not naturally part of the Treasuries space. I probably come at the whole space from an angle which probably doesn't match most of the people in the room, in that, for me, treasury companies and companies that own Bitcoin are a natural consequence of the system we find ourselves in, but they are downstream of Bitcoin. And so to compare the two, or to consider the two as being comparable or equal, or a sense of allocation between the two of them, would be to frame it in a way which I wouldn't. Bitcoin is money. Treasury companies are equities. They happen to stack Bitcoin on their balance sheet, but they are vastly, vastly different things. That's not to say one is right, one is wrong. They're natural consequences, and there's room in a portfolio for both of them. But it's, in my view, driven by conviction and circumstance as to why you would choose to allocate a certain amount to either or both. And yeah, for me, they're night and day. They're night and day. But I realize I'm probably at one end of the scale here when it comes to this. But I will also be talking in about half an hour, or maybe sooner, with the pace we're going, which, in a way, which hopefully will better articulate to everybody why I'm of that view, and that we shouldn't lose sight of the bigger picture as to why Bitcoin treasury companies exist in the first place. And to focus only on Bitcoin treasury companies would be to go halfway towards the solution you ultimately need to encompass in your lives.
Thank you very much, Joe. My name's Scott Ellen, company's XC Connecting Excellence Group. And just on what Joe said there, and I'm looking forward to seeing what's the problem up on the screen shortly. The point with Bitcoin and the split between Bitcoin being money and Bitcoin being equities, Bitcoin's got a fixed supply cap. Bitcoin is unconfiscatable, and you can transfer Bitcoin anywhere in the world into any jurisdiction. Or if you wanted to, you could transfer it out of the planet. There is no restriction, no third-party involvement. With equities, very different, yes. Now, my journey as the CEO of what you would say is an operating business with an integrated Bitcoin treasury started with Bitcoin in 2016, and it was those three key properties that drew me to Bitcoin as a money. And the benefits of, if you can imagine Bitcoin without a fixed supply cap, but unconfiscatability and transportability with no third-party influence, even if that was inflation-linked, it would still be an extremely compelling money, given that if you wanted to take your money from the UK to a lower tax jurisdiction, you'd have to ask quite a number of parties for permission. So when it came to putting Bitcoin on the balance sheet within the business, that was 2021 for me. It was those properties that stood out, and it was a long-term savings vehicle for what was at the time a private business. And the choice for all private businesses in the UK is, do you want to hold on to a cash reserve that's guaranteed to go down in value over the long term, or do you want to hold on to an asset class, or consider a certain allocation to an asset class that has a proven compound annual growth rate and a proven 200-week moving average that goes up over a long, say, 4+ year period? When you move into the public markets, my point would be, why would you hold an equity that isn't holding Bitcoin if it's got a significant cash reserve? And for me, I'm a Bitcoiner, first and foremost, Bitcoin. But I've got trapped capital. And in 2017, Jesse had the Bitcoin ETNs up there saying that you can now buy them in 2025. You could buy them in 2017. I didn't buy enough of it. But you could get access to it. And I'd looked at the time, got access to this ETN in 2017, and they banned access to it. And I think, I might be wrong here, James, my lawyer from Hill Dickinson, will tell me if I'm wrong and correct me, but 2021, maybe they banned access to the Bitcoin ETNs. So you've got trapped capital, 1.5 trillion to 2 trillion in ISAs and SIPs. If every single person holding that 1.5 trillion to 2 trillion in value in ISAs and SIPs is a Bitcoiner, then they're looking for Bitcoin exposure in those ISAs and SIPs. And I think that was why you're seeing such a ferocious appetite for smarter web when it came to IPO for those who knew it was coming to IPO last year, and why you see such a strong community and network, and why we're all sat here today is Bitcoin treasury companies allow access to tax-trapped capital first and foremost.
Good morning. My name is Henry Herbert. Bristol's my hometown. I was born here, so it's great to see so many people come to this lovely city. And thank you, Andrew, for inviting me. So I'm not in the financial markets. I run a bakery, and I trained as a chef. So balance sheets and whatnot aren't really my forte. But I guess for me, as a kind of a humble pleb, I got into Bitcoin because I felt disenfranchised about how shit my money was, and that kind of slow creep of inflation just eating away, and working harder and seem to buy less, holidays not getting better, looking at that kind of future, how can I provide for my kids and for my, for their kids, and just thinking the math doesn't work anymore. And so I got into Bitcoin from wanting a sense of agency in my life and that freedom. But then I also had a pension, so I work in a business that pays into a pension every month. I can't change that. I can't take it out of the pension. And until Bitcoin treasury companies came along, I was just DCAing into the S&P 500, which is fine, but it's pretty uninspiring. And so when Andrew, actually it was Scott who put a tweet up saying, Bristol, Bitcoin, ISA, and I thought, yeah, I'm all in, and it's been quite a wild journey. It's certainly made my pension more interesting. It's made my wife's pension more interesting. She prefers it when it's going up rather than when it's going down, but that's fine. But I think the thing for me is that I see them as two totally different things. My Bitcoin in cold storage is like, that's my future, that's my sovereignty, that's the, if the shit hits the fan, I can leave this country, I can take it with me. My money in the smarter web companies in my pension, hopefully the government will allow me to withdraw it when I eventually get to retirement age, but who knows? But I kind of, it's money that I can't put into Bitcoin. So, but also I think I really enjoy supporting the Bitcoin space, and so actually, why put my money that is trapped into something that is, like the S&P, but actually I can support a Bitcoin company, which fundamentally is buying Bitcoin. So, actually it's good for me in the long term.
Henry, I would love to start with you with this next topic, which is, do you get more questions from your friends and family about Bitcoin or about Bitcoin treasury companies, and has that changed at all over time?
Well, my experience has been that I was probably a bit of a zealot when I first got into Bitcoin. I saw that the earth was round, it wasn't flat, and so I told absolutely everybody. And of course, they very quickly labeled me as either a nutter, get back to cooking, what do you know about pensions and finance? And please, their eyes would roll. So I'm kind of in that phase now where there's, my mum will occasionally ask me like, oh, darling, how's your Bitcoin? And so I'll always go back with, well, what do you want to know? And she's like, well, nothing. I just want to make sure you're okay. So I'm in that kind of sympathetic stage. I would say I've had more success with talking to people about smarter web and the Bitcoin treasury space, because people do have pensions that have been pretty disappointing, particularly if you're in like a work-based one that, you're in a kind of medium tracker, and it's, it tells you when you can withdraw it when you're, in your 50s or 60s, that you're going to get $4,000 a year, and you're thinking, well, that's not a lot. And so I've had good conversation around that, whether any of them have then put the money into it, because I think there's still, that suspicion of, is Bitcoin, is it, it's still a bit fringe. It's not quite, in the mainstream. But I think it helps. It's just, it's a different conversation. Talking about, freedom money that you can take anywhere is quite, I don't know, for a lot of people, I think it's a bit extreme. It's big, it's really big. Whereas actually, hey, do you want your pension to go up in value? Buy some Bitcoin treasury companies. Easier.
Do you feel like that's shifting a little bit though, especially in the last couple of years? The freedom money, the being self-sovereign, after the last, things are deteriorating and have been deteriorating for a while, and they are accelerating, especially with the people we have in charge right now. They've sort of pressed the accelerator towards the edge of the cliff. Right, we're still in the same direction, we're just going faster now. And do you not feel like that is starting to seep into the conversations? It's eating at the back of people's minds, like I actually am worried about things being taken off me, and actually worried about pensions ever being accessible. The retirement age gets pushed back, and then they get taxed to high heaven. So, and they get debased at the same time. So you're going to get whacked from all three.
So
all three
I live in Stroud, which, if any of you have ever been, it's a beautiful town, and but it's quite, I would say, quite a kind of lefty, progressive, probably a bit woke, Green Party kind of town. And so you have these conversations with people in the pub, and they're talking about all these things, and I'm like, yeah, and there's a solution, but I would say they're still very much on the government needs to give me more money, rather than taking agency in their own lives. But they'll get there.
I'm thinking back to when I first started speaking about Bitcoin, when you were saying how people might judge or think you're mad. And my passion and enthusiasm for Bitcoin, when I look back at WhatsApp groups with friends from, say, 2017 to 2018, was probably misdirected and not as informed as I am today. It was hard to get good information back then. So when you're coming up with ideas of, you're kind of saying, and I won't be too specific on what my thoughts were on why Bitcoin will be adopted by certain types of maybe oligarchs moving country, or people who are necessarily going through changes in life where they might be divorcing, those kind of uses of Bitcoin, where you're saying, well, people are going to be interested in this asset class. And you're trying to make it as relatable as possible with your friends in the pub and your friends who are not interested in this topic. And going through that journey, when we started buying Bitcoin in the business, I was very conscious that if I speak to the staff in the business like I speak to my friends and family, which comes across as, you're all on the Titanic is sinking, I'm in a lifeboat, please get in the lifeboat with me, I don't want to watch this happen in slow motion over the next decade or 2 decades. When you're going through, it kind of trains you to drip feed it over 1 year, and Jonathan Russell, who's in the office, will remember this, doing a year where it's history of money and asset classes, and you're dropping Bitcoin in there, and then you're moving on to, a few months later, we'll move on to, why is Bitcoin a suitable asset class, and then why is it on our balance sheet, and then, surprise, we've been buying it on the balance sheet for 4 years. It's looking like a good time to go through that detail with you now. But as I came towards the IPO last year, I saw a big shift in people embracing, after Smarter Web, and people embracing the Bitcoin treasuries first rather than Bitcoin first. And I think what I saw there was an ex-chair of a top 5 UK bank, chair of a big division within the bank, who I'd known for a few years and I'd been talking to about Bitcoin non-stop. First time they met me, we were on a safari together. That's how I met them. So they were trapped in a vehicle with me for 7 days on my honeymoon. And I remember my wife looked at me when he told me what the job was, and I was like, don't do this on the honeymoon. And I'd been speaking to him about Bitcoin for years. But as soon as I said, the business owns X amount of Bitcoin, we are listing on Aquis, and we're integrating a public capital markets facing treasury, he said, yeah, I'd like to participate in the IPO. And I said, well, we've been speaking about Bitcoin for quite a few years now. What stopped you buying Bitcoin first? And he said, I don't trust myself to have enough time to do as deep a dive into Bitcoin and how to buy Bitcoin safely and how to secure it safely, more than I just trust you to go and buy it and store it and put it in a public company wrapper. So I think it's an onboarding vehicle for those people who don't necessarily feel the pain and the urgency of, I want self-sovereign money, I want to be able to protect it, I want to be able to transfer it without permission. It gives them an onboard and drives Bitcoin adoption in areas where it wouldn't necessarily be taken up over the next 5 to 10 years otherwise.
You're on fire, Scott. You have to know when to pause for applause. Pause for applause.
Andrew said we had a lot of time on this one, so...
Well, I mean, from my side, it's probably a slightly different question set that I get from most people. Given the the success of what's the problem going around the world, most of the questions I get are about Bitcoin, as opposed to Bitcoin treasury companies. But when people do ask me about Bitcoin treasury companies, a lot of them are confused because they assume that they're all just the same. And they're confused as to why these things should have more value than just the ETF. Right? And in some jurisdictions, we're protected from accessing ETFs, in which case, you give some companies like Smarter Web some structural advantage, again, within a regulatory or tax wrapper background. But I think a lot of people struggle as to sort of just rationalizing why they have any value at all, or why you should expect them to have more value than just the value of the Bitcoin on the balance sheet. And I think it's a difficult one. It's a difficult one to explain, especially when effectively the tremendous job that Smarter Web have done of clearing that path, especially from a UK perspective, clearing the path in the forest so that people can actually get a private business listed in a public market with Bitcoin on the balance sheet, means that it's now replicable. So what stops 10 more coming or 100 more coming, and therefore why do any of them have value? And I think this is a challenge for many people, and will become more of a challenge over time as the number of businesses that come to market increases. And so I think there'll be more and more pressure on treasury companies to be able to better communicate why they are able to drive shareholder returns over and above just the outright performance of Bitcoin. And I don't know whether we'll discuss this in a bit more detail, but you have different models. You have different models there. And my standard response to people when they ask this question is, well, they don't all have value. They're not all going to trade above their book value, because it would be logical for them to trade below their book value if all they did was just have some Bitcoin on the balance sheet in a wrapper. Unless, because of the tax consequences of trading in and out, unless you have a backdrop where the company itself has some structural advantage. And that structural advantage can be tax or regulatory in nature, which I would put initially Smarter Web in that category. Scott's talked about trapped capital in the UK. There's been all this pent-up demand, looking for a home, looking to try to get into Bitcoin, it hasn't been able to. So if you're the first company to be able to relieve that pressure, you see like a rapid flow of capital into your business that drives the growth. And now Smarter Web are at the next stage of their journey about thinking about how to take the assets they have and the scale they have to be able to find a path to drive long-term shareholder value outperformance. And this comes, in my mind, in one of two ways. Because the structural advantage for tax wrappers and things is a one-time process and winner takes all or winner takes most type of thing. But the two ways are, you need an operational business that itself is aligned to the growth of Bitcoin. And so, the whole view here, the rationale is Bitcoin's going to eat the world. It's going to eat the asset base. Ultimately, depending how far you are down that scale, it's going to be the money. And so if that is your core view, then wouldn't you want to have a Bitcoin treasury company that itself is leveraged to the long-term adoption of Bitcoin, not just the value of Bitcoin on the balance sheet? Because I want this business to become stronger the more the Bitcoin network strengthens. Right? And you see, therefore, companies like Scott's, where he's positioned as basically the on-ramp of human capital into the Bitcoin ecosystem. Right? You can see how that business scales. You can see how businesses that focus on payments, Bitcoin payments network infrastructure. In a world where you think Bitcoin becomes the money, then there's a path there to drive long-term value. The challenge with some of these, this is a long answer by the way, the challenge with some of those is how do you scale that business in lockstep with the Bitcoin treasury you have? Because if you scale the treasury too fast, the operating business becomes a rounding error, and therefore you're just a treasury again. And so you've got this constant balance until you reach a scale. a scale of strategy, and maybe one or two others. And Smarter Web, I would say, are probably on the cusp in the UK, because the UK is just smaller in general. And that tipping point comes when you can begin to weaponize the financial system against itself. Because you are positioned to begin to take advantage of the Cantillon effect. You place yourself closer to the money printer, closer to the cheaper financing that comes from being closer to the source of power. And strategy can now finance itself, it can hit the deepest capital markets in the world, and it can therefore take Bitcoin's volatility and all the latent energy and power and expectations about future growth and domination of Bitcoin, repackage that and deliver it in a mutated form into a capital market that is starved for yield. It doesn't remove all of the risks. It introduces different risks. In some ways, you end up with a tiered capital structure, but it morphs the risk profile and makes it more attractive for the everyday user, for the everyday investor. And Smarter Web are on that cusp, but it's in the UK. But it's hard to get there, and very few companies can get there. And so not all treasury companies are the same. There are some that will be gigantic, and there's some that will be in this mid-tier, and most will die. Most will trade below NAV and will either be acquired or close, go private, because you don't have a route out of the underperformance.
I promise this will be quick, Tim.
Sorry.
And I think everybody in the room probably, and I'd be interested to ask actually, show of hands, because we asked a question earlier about the Bitcoin adoption. How many people in the room first bought a Bitcoin treasury before buying Bitcoin, if you don't mind just giving me a bit of an indication for that? Right. I thought there'd be a reasonable amount of people who came into Bitcoin treasuries first, and I think there was a bit of an urgency to educate last year. I sat on the first call, in fact, Joe, you might have hosted that first call with, it was Jordan Walker, Jeremy, you, myself. We hosted the call with Andrew and Tyler, introducing that business somewhat to a community of Bitcoiners in the UK at a retail level prior to the IPO, and then I put that post out which did explicitly state not financial advice, do your own research, but I've been thanked for since. And shortly after that, there was quite a few companies that pivoted strategy all of a sudden, and there was a bit of a need and a rush to start educating people who are coming into the space to identify that not all Bitcoin treasuries are the same. All Bitcoin is the same. It's a very simple decision. But with Bitcoin treasuries, you need to be looking at the leadership of the business. Who's the CEO? Are they a founder, and are they going to be with the business long term? What's their background in Bitcoin? How long have they been in Bitcoin? Because it's quite easy to adopt a Bitcoin strategy at a time when the euphoria is going up, but it's not so easy to continue that over the long period when it's not. And I think you've seen some pivots in the marketplace back into what they were doing previously, but as a result of that, they've got a much stronger balance sheet. And I'm sure over the next 4 years, while they study and they go through that journey that everybody has to go through in Bitcoin, they'll come around to becoming high conviction businesses. But there is a lot more to take into consideration when you're looking at Bitcoin treasuries. And ultimately, you want to see that the board and the team are aligned and have been through that personal Bitcoin journey as well, because there just is no cheat code to gaining high conviction in Bitcoin. You can't borrow it. A lot of people I've spoken to over 10 years tend to just buy for the very first time at a top, and you think it's never going to be a drawdown again, but you've just got to go through that 4-year learning curve of studying and buying on a daily, weekly basis, monthly basis, before you can really build that foundation of conviction.
Henry, I would love to end with, where did the name Bitcoin Chef come from?
Well, I guess for me, the Bitcoin community is unbelievable. I mean, some call it a cult, probably is a cult. My wife thinks it's a cult. But it's, I guess, I kind of looked in that space of like, well, I'm a chef and I like feeding people, and I mostly cook for local people. So if anyone wants to come have dinner, we run monthly supper clubs in my bakery in Nailsworth. But also, I'd like to travel the world, and I'd like to take my kids, and ideally, in my mind, I'm thinking, hotel in Bali, put on a nice menu, and then have a nice bit of time on the beach with the family. That was kind of what I was thinking, kind of would be fun. And I thought, well, actually, if there's this kind of a global money that's really well supported all over the world, people have always got to eat. Maybe if I kind of claimed the Bitcoin chef, that maybe one day I could cook on Michael Saylor's boat. That could be fun, or Andrew's yacht when he gets one in a few years' time, when he's the biggest company in the UK. So yeah, I purely for selfish reasons, but yeah, I like cooking and I like Bitcoin, and so yeah, that was it, the Bitcoin chef. But yeah, just to follow up what these guys said, I think for me, when I think about Bitcoin treasury companies, because it is a minefield, and like how do you navigate through when you've had to learn these things like MNAV and all this kind of jargon, which sounds quite confusing, and particularly for the layperson. And I think for me, it's around how well does the leadership of the company communicate their conviction in Bitcoin, and that's kind of what I look for. So if the company is buying Bitcoin and they're helping to educate the properties of Bitcoin as an underlying asset, that gives me reassurance. Whereas when it's all just, I don't know, trying to pump the stock or whatever, I lose interest in that bit. And I guess the bear market will be a real leveler of which companies will survive it. And that, that's the same from a personal point of view. If you can weather a bear market, you come out the other side stronger, hardened but stronger. And I think it'll be the same for the treasury companies, the ones that can get through it without selling Bitcoin. And, if hopefully accumulate some more Bitcoin, they'll be stronger on the other side.
Henry, Scott, Joe, thank you so much for your time. Please give them a warm round of applause.
Good morning, everyone. So great to be here in Bristol, talking about Bitcoin. My name is Stefania. If you don't know me, I've been in Bitcoin since 2016. I've been investing and advising public listed company, and I currently sat on the board of Falcon Edge as a non-executive director. I've got 3 amazing panelists here. We are going to be talking about Bitcoin yield. So let's just go around with just a 30-second introduction, and then we can go straight into it, because it's one of the hottest topics right now. So,
yeah, I'm Jesse Myers. I'm head of Bitcoin strategy at Smarter Web. And I've been in Bitcoin for the same amount of time, actually. And yeah, I'll pass it on.
I'm Roy Kashi. I'm the CEO of Falcon Edge. Co-founded the company last year. We're a hedge fund advisory business with a Bitcoin treasury management policy. My background's been traditional finance for 25 years, like in hedge funds, and yeah, this is me.
Hey guys, thank you very much for having us here today. Pleasure to be in Bristol. I'm Freddie New. I'm the CEO of BHODL, and I'm also a co-founder at Bitcoin Policy UK. Don't think I can quite beat Jesse, but I've been kicking around the space for a while.
Great. So let's go straight into it, because Bitcoin yield is definitely a very important topic right now. And what I want to start with some definition, right? Because there are different ways to think about Bitcoin yield. So you can say, it's like appreciation, Bitcoin per share, store of value. But actually now there are ways that actually you can leverage Bitcoin as an asset to generate revenues, also minimizing risks. And that's what we are going to be talking. So let's go straight to you. Because because I want to talk about this kind of concept of Bitcoin as store of value and medium of exchange that we can use to kind of generate revenue.
Sure. So I know that a lot of the debate around Bitcoin is kind of split into those two camps, medium of exchange versus store of value. You've got to feel a little bit sorry for unit of account. We never talk about that one, but that's probably a long way down the road.
We are not there yet.
Okay, no, not quite there yet. So I'm glad you mentioned talking about this conceptually, because one of the most fun things I find doing is really thinking about Bitcoin as money and really what that means. And looking at the history of something like gold, actually Jesse and I were talking 30 seconds ago around Croesus, which was his handle while he was still a non. Croesus obviously created the concept of coinage as we currently understand it. In terms of the evolution of gold as money, I always like to remember that jewelry came quite a long way before coinage. And if you look back at the very early history of Bitcoin, Satoshi's writings were not dissimilar in some respects. It was thought that Bitcoin initially would be a collectible that people would like to hold and collect, even though we forget, for the first couple of years of Bitcoin's existence, there was no market value whatsoever. We just had Bitcoin Pizza Day last Friday, 22nd of May, the first recorded transaction, the 10,000 Bitcoin that Laszlo spent. And that was obviously its first step into a medium of exchange rather than a store of value. And certainly for us at our business, we like to think that store of value and medium of exchange are two sides, of the same coin. Sorry to make a terrible pun. And that for us, certainly in the way that we generate our revenue, they both complement each other and they're not exclusive of each other. Happy to go into a bit more detail about exactly how we do that. But for us, given as we do make our money from Lightning routing and now from Lightning service provision, it wouldn't make sense for us to do that unless we believed in the first place that Bitcoin was valuable, that it was a store of value, and that by using it as a medium of exchange, we can thereby generate yield.
Great. We can go then more into details into the Lightning Network and how you do that. But let's just move to you, Roy. Obviously, we can use Bitcoin as a base asset to generate revenue. But I think one of the questions that many people have, and one of the reasons why perhaps a strategy is not actually leveraging the assets, is the counterparty risks. So talk to me about your approach of minimizing this and more about the platform that you're using, the structure that you have got as well.
Sure. So we spun off from our sister company last year, which is a 12-year hedge fund, FCA, full regulated business. And we decided if we're going to do this, we're going to leverage off that and actually make this incredible store of value workable to earn you revenue at the same time. So we have our own in-house fund, which has been going for several years, that's made money every single month since inception. And what we did was create a Bitcoin share class within this fund where we can directly allocate our Bitcoin into there to generate a yield, which is what we do. So there isn't, the counterparty risk is negligible because it's actually us. So it stays within our ecosystem of Falcon Edge and Falcon Investment Management. So far, this has generated 6.34% yield compounded since December, so in 5 months. So we're averaging around 1.25, 1.3% per month. And we're aiming for around 15% annually, which will compound our balance sheet and grow.
And that is in Bitcoin?
It's directly in Bitcoin. Stays in Bitcoin, stays with our custodian, stays in our ecosystem, so it doesn't go anywhere.
Jesse, what do you think about this risk? And obviously you have a very different kind of strategy with the smarter web.
Yeah, first of all, I think it's very interesting how, what is a Bitcoin treasury company? It's any company where the value proposition is you're going to grow your Bitcoin ownership over time through the successful execution of the strategy. And that is possible through any number of business models. And I think these are examples of what's possible in traditional finance business models being ported over to a Bitcoin world where you are able to generate returns in Bitcoin and pass that on to shareholders. And we're going to see an explosion, I think, of every business model out there being done with a Bitcoin foundation, Bitcoin as the bedrock, Bitcoin as the unit of account for the balance sheet, and what the company's measuring themselves in. And there's going to be a Bitcoin disruptor, I think, in every major category of TradFi business models, whether that's insurance or payments or how you run a fund. And so I think it's something that we don't talk enough about in Bitcoin Treasury landscape, is that the term is really overly broad. I think what a Bitcoin Treasury company truly is an extremely broad lens of any company that's delivering value in Bitcoin terms. What Smarter Web is focused on is sort of the first version of a Bitcoin Treasury company, which is that perhaps the low-hanging fruit of a Bitcoin Treasury model, and that is how do you have a Bitcoin-powered equity and then potentially become amplified Bitcoin. And that's the value proposition to shareholders or prospective investors. But that's a pure Bitcoin Treasury company model. But in truth, Bitcoin Treasuries, is any business like this that is generating positive Bitcoin returns for investors. And it's I think a topic that will be at the forefront for every industry, TradFi industry in the world over the next coming decades. Yeah.
I would say thank you for bringing that up, because actually Bitcoin Treasury company are companies, so we should actually stop putting them into a basket, because then it all comes down to how are you actually generating value for investors, and there are different business models that investors can resonate with. Now I have a question for you, Jesse. I was kind of thinking, obviously being a poor play, minimize the risks. You have got a very clear razor-focused strategy, but at the same time, I'm thinking about scalability, or how big you can get if you can only invest as much as your revenue from your operational business, right? So can you maybe share a little bit how you are thinking about, scaling the business model that you have got to keep growing your Bitcoin? Because one thing is going to raise money, and that's fine, but there is also dilution and all other things that comes. On the other side is actually having money that you can get, and then you can buy more Bitcoin. So obviously you are the first, so you have got the first mover advantage, but maybe there is more strategic angle that you can share with us.
So you mentioned earlier that strategy is not putting their balance sheet to work, and I think that's not quite right, because they're using their balance sheet as collateral for their preferred equity offerings, and I think that has shown that there's the larger they get, the more creditworthy they are. The more reliable they are, the more time passes, the more Lindy they are. And I think that's served them well already, and is they're increasingly the name that's synonymous with digital credit, and how you can grow your Bitcoin per share through if you're going to pick one Bitcoin Treasury company in the world, strategy is the first name you think of. So there's a lot of advantages with scale with that model, I think, and that Smarter Web enjoys some advantages, being the largest Bitcoin Treasury company in the UK that's running that specific playbook of, there's advantages to scale, and the larger that our balance sheet gets, the more creditworthy we become. And I think that trajectory, can play out in the UK for the leading Bitcoin Treasury company that's running that pure play balance sheet strategy, which is really what we're pursuing. And yeah, so when you think about how a Bitcoin Treasury company is putting their assets to work, it can be it can be execution of a strategy. It can be, offering amplified Bitcoin, which is based on the collateral that you have on the balance sheet, and then the leverage or amplification from preferred equities, as strategy has shown, that becomes the value proposition. So I think there's advantages in scale, and hopefully Smarter Web can continue to build that balance sheet and become more and more creditworthy by doing that.
Yeah, you're right. There are different products that can actually generate revenue. And Roy, you being a financial company, that's what you do. What else are you thinking about in terms of product ways that you can minimize the risk? Because we all agree that we don't want to put Bitcoin at risk, but we want to be innovative as well. And also, if you can touch on the regulatory side, that will be important, because we can be innovative, but we need to be in a framework, especially here in the UK.
Yeah, absolutely. I mean, obviously, for us, being able to put our balance sheet to work gives us opportunities for other products. We've already started creating a Bitcoin bond, which will offer, a fixed coupon for investors paid quarterly with a Bitcoin attached certificate to that, where you'll participate in the upside in Bitcoin, but not the downside. That's something we can offer because we get the yield on the balance sheet. Other things is looking at managing Bitcoin for third parties, which we've been approached to do by a number of people, and it's another avenue we're looking at. And I guess everything will lead down to the avenue of preferred equity. And as we know in the UK, preferred equity has to come from revenues, dividends have to come from revenues and profits. There are other ways you can circumnavigate that with the share premium, change the share premium accounts into profits. But so that's probably one way of coming to the regulatory issue you've mentioned. But for us, being in a position where we can generate, for us it's about, like you said earlier, treasury companies are put into this bracket of one basket, but ultimately they are companies. They are listed companies on the stock market. So as such, we believe, why not value them as companies, other companies on the stock market would be, on revenues and profits, where you're not just valued on an NAV basis, because you are making revenues and profits, which give a far higher multiple, as they should. And that's what we see ourselves as potentially being slightly different. We want to grow that side as much as we can, and be valued on that metric as much as possible.
Freddie, talk us about the Lightning Network, because I don't know much about how you use it to make money. So tell us how you basically integrate your Bitcoin treasury with that.
Sure. Well, tracking back slightly to some of my earlier points around the nature of money, for me, I fundamentally got into Bitcoin, I think, probably for reasons similar to those a lot of people got into it. Initially, you looked at this thing and you thought, that's undervalued. That's going to be worth more in the future. And it turns out I was partially right. I was more right in October last year than I am today, but the price will go up again. And the second thing that really fascinated me was the idea that we have here a monetary asset that you can use even when your government doesn't want you to. And so for me, it's the uncensorable payment proposition that's so fundamentally important around the nature of Bitcoin. And I think that's something that we, I suppose, in the developed economies and the less authoritarian economies, although in the UK we're moving more authoritarian, which I'm sure we're all delighted about, that's a really fundamentally important value prop for me. Can you move money across borders if your country doesn't want you to do that? Can you buy things? Can you pay to attend a protest against your government without your government shutting down your money? That for me is fundamentally important. So thinking about Bitcoin through a payment lens, we all know that the base layer, the UTXO set, isn't capable of giving censorship-resistant money to everyone on Earth. We know that there's a UTXO set limit. Not all of us can hold our own keys, and quite frankly, the settlement time, so the gap between your transaction speed and your settlement speed on the base layer is probably always going to be too long for you to buy a cup of coffee. And that was always one of the main criticisms in the early days of Bitcoin being used as money. Oh, you can't buy coffee with it. Now we know now there are a lot of different second layer solutions to enable that instantaneous transaction and instantaneous settlements effectively to merge. The Lightning Network is the biggest and the most well developed of those. For anyone who's not familiar with it, there are 2 base layer transactions in order to create a Lightning channel. One when you open the channel and one when you close it. And for the period that the channel is open, the 2 participants of the channel, let's say Steph and I have a channel here, we can make as many different payments between each other in real time as we like. But the cool thing about the network is it's not just one payment channel here. If there's someone at the back of the room to whom I want to send money, but I'm not connected to them, but Steph is, then I can route through Steph. And much in the same way as you may be familiar with Visa and MasterCard interchange fees, which are relatively high by comparison, Steph would then be able to charge a small routing fee for the privilege of enabling me to pay that person at the back. And that's essentially how our first business model works. We are setting up a large number of well-capitalized, well-funded routing nodes at specific junctures on the Lightning Network that enable us to optimize for the routing of payments. And at the moment, we're seeing about 6% return on invested capital. And crucially for us, because we self-custody, we have a proof of reserves on our website, there's limited to no counterparty risk there. So back to the credit idea, no one's being trusted here, so that Bitcoin locked in the channel is still ours. And if anything goes wrong with the channel, it will come back to us, to our self-custody address within about 6 blocks. At the absolute maximum, about 2 weeks.
It's kind of like we are opening a tab. We are opening a tab in a pub, for example. We all do that, and then the money circulates without each transaction being finalized each time.
Exactly. You don't write it down. You don't write it to the base layer until you close the channel, and you're basically trading the Bitcoin IOUs between each other, but in your own self-custody. So you haven't got any counterparty risk as you might do if it was a lending model. And then our second business line, also denominated in Bitcoin revenues, is as an LSP. For anyone who's not familiar with that, an LSP is a Lightning Services Provider, and that's essentially providing more of the infrastructure plumbing behind that payment network. And if, for example, you're a wallet provider or a merchant who wants to receive Lightning payments, you need, and again, this is more technical than hopefully most people will ever need to know, you need to have inbound liquidity in order to enable you to receive payments. And we will sell you that inbound liquidity, again, our own Bitcoin. You pay us in Bitcoin, and when you have finished, when you're done with that liquidity, you can close that channel, and the Bitcoin reverts to us. So those are roughly the 2 business models we have running at the moment.
I'm curious, show of hands, who's done a Lightning transaction before? Oh, good. All right.
Wow,
cool.
That's impressive.
That's awesome.
It's magic.
That is very. I don't think you would have got the same answer 5 years ago to that.
Totally agree.
What is the yield that the Lightning is generating?
Sorry, what's the
yield that you are generating?
It's about 6% we're getting on routing.
Annually?
6% APR on invested capital.
Okay. So very different business models. Now, obviously, Bitcoin yield is something that is not so easy to explain to investors. We have got, obviously a room of very educated people in the space. But for example, Jesse, when you are talking to investors and, being a public listed company, obviously you are talking to more traditional investors. What can we do, what you are doing, and then we can get also Roy and Freddie to share what they are doing, to get people to understand this new concept?
Yeah, it is tough. I think that the toughest part is to just get the other side of the table to understand Bitcoin. And that's the real barrier, frankly.
They can all go to Joe.
yeah. So we'll just need to bring Joe out every time we talk. That's the real barrier. Is you're either bullish on Bitcoin or you're not, and really the question there is, have you done sufficient research on Bitcoin in order to think that it's not internet monopoly money, and instead understand it as digital scarcity of a finite digital currency that has won as in terms of digital money. so that, that's the first barrier, and then explaining the concept of Bitcoin per share and how a Bitcoin treasury company's value proposition is that you can grow Bitcoin ownership over time through the successful execution of the strategy, whether it's the sort of pure Bitcoin treasury company model that we run at Smarter Web, or alternative business models that result in the same effect of growing Bitcoin ownership. So for us, it's there's sort of two parts to it. There's you can grow Bitcoin per share if you're trading at an MNAV premium and are able to issue equity and buy Bitcoin, and that results in an accretive transaction, grows the amount of Bitcoin on the balance sheet at a rate faster than your increasing share count. So that's a great outcome, and that's what Smarter Web has most of the Bitcoin per share growth that we've delivered over the last year has been through that. The other way that you can increase Bitcoin per share is through the amplified Bitcoin model, which is really leverage, whether that's traditional debt or, with, as we've seen with strategy, preferred equities, preferred equity obligations. The net of that is you're creating a fiat obligation, using those proceeds to buy Bitcoin, and that amounts to creating a levered Bitcoin balance sheet, where if Bitcoin appreciates in value, then the unrealized gains from that levered Bitcoin position accrue to the equity holders, and that's an increase in net Bitcoin per share to equity holders. And I think that's the more accessible version of the model to wrap your head around. That an amplified Bitcoin treasury company like Strategy, and increasingly like Smarter Web, we now have about a 13% leverage ratio. That means that if Bitcoin goes up in value and our fiat obligations stay flat, then you have delivered a net increase in Bitcoin per share to equity holders, and that's just a classic playbook, and I think easier to wrap your head around. So it's hard to communicate the value proposition of a Bitcoin treasury company because you have to understand quite a few things. But I think that the thing that helps a ton is whenever Bitcoin goes up. So when Bitcoin is trending up, as it does, people need to figure out how to get exposure, or how to not miss out. And I think that Bitcoin treasury companies create the most accessible way to get Bitcoin exposure for a portfolio, and in my opinion, the most compelling, because it comes with not only do you get Bitcoin exposure through the balance sheet as it exists today, but if the model executes over time, you're growing your Bitcoin ownership on top of that. Just some quick numbers that come to mind. If Bitcoin grows at 29% a year for the next 2 decades, as Strategy believes it will, and then you're able to add 20% Bitcoin per share on top, well, those compound together, and that amounts to 55% annual return. And that beats the pants off of anything else that you can get out there. So I think that's the potential of a Bitcoin treasury company, above and beyond the already great potential of Bitcoin.
Thank you so much. Unfortunately, we have to finish here. So Jess, Roy, Freddie, thank you so much. You're going to be here, so anybody that is interested in catching up can do. Thank you so much.
Thank you. Thanks.
Right. I think we're going to add in an unscheduled break, so stay in your seats, and you're going to get a chance to go out, get some coffee, go to the bathroom. We lost one? 1, 2, 3. No, you're good. Okay. Excellent. Well, today's topic on this panel is not the most exciting, but I'm going to do my best to make it. The official title is The Evolution of Institutional Custody and Trading. But being American, I want to put another American on the hot seat here. You didn't know I was going to do this. You get out of Villanova in 2006, and your first job is 2007-8 is Lehman Brothers. What was that like? Is that what drove you to be a Bitcoiner, is seeing all that?
I think that the way it was despite what happened, Lehman was an incredible place to work. I think it was a really good culture of people. Unfortunately, there were some missteps that went wrong, and I think that a lot of those missteps that we took at Lehman, you can learn from and not repeat with some of the things that we'll talk about today in terms of like custody and trading and the segregation of those duties and assets and how they should be held.
Awesome. Had to put you on the hot seat there. Had to get your blood going, man.
Boring answer, but more about Lehman and Villanova later.
Yeah, fantastic. Okay, well, institutional custody used to mean one thing. It was about keeping the assets safe. And institutional trading used to mean another thing. It was execute efficiently. But with Bitcoin treasury companies, we've got something new. It's custody and trading are no longer separate. They're kind of one and the same. So where the Bitcoin sits affects your liquidity, your financing, your governance, your auditability, your counterparty risk, your board confidence, all these things now that Bitcoin treasury companies are going to have to consider. So the question that we're going to answer today is simple. It's like, what does institutional grade really mean when the asset is Bitcoin? So Alex, Xapo Bank comes at this from a Bitcoin-first banking perspective. Custody, USD rails, BTC-backed lending, financing, institutional relationship management, and Bitcoin-native wealth products. So let me start with the uncomfortable question for you. When a company puts Bitcoin on the balance sheet, should it be thinking like a treasurer, a bank client, or maybe a sovereign wealth fund?
Okay. From my perspective, as soon as any asset hits your balance sheet, you're instantly thinking as a treasurer. The thing about a Bitcoin reserve is immediately you're thinking like a sovereign wealth fund. The idea is to hold the Bitcoin long term, and as such, you need the governance in place to hold that Bitcoin long term. Then you think about yourself as a bank client. So someone like Xapo or whoever your provider may be, is what do they offer? Do they offer trading? Do they offer liquidity? Do they offer financing, collateral? So you're looking at it from 3 different perspectives. From a Bitcoin trading company, yeah, I think treasury first. You have the mindset of a treasurer. The second point is you have the thinking and thought pattern of a sovereign wealth fund in terms of long-term holds, and then you think of yourself as a Bitcoin bank client and your services that you're being provided.
Just keep it close to your mouth. Okay. So Alex gives us a Bitcoin-first bank perspective. Andrew, Coinbase sees a huge range of institutional behavior across custody, execution, et cetera. You lead Coinbase's institutional client business for all of EMEA?
And Asia.
And Asia. Okay, working with investors, financial institutions, corporates across custody and trading. Coinbase Prime is effectively trying to be the institutional operating system for crypto markets. So here's the question. Are Bitcoin treasury companies looking for a custodian, a broker, a prime broker, or are they really looking for like in the software world, a full capital market stack?
Yeah, I think like much of crypto, it started with like one thing and then kind of evolved into the full stack. And so you kind of went from like this just boring, like I need to have my assets in cold storage. I remember we did the acquisition of Xapo's custody business, and then it's like I need to be able to trade these things. And I think that now we're very much into the world of like it needs to be a full stack offering, because the moment that you put Bitcoin on the balance sheet, it very quickly the conversation very quickly evolves from, okay, well, now I need treasury management, as you said, to now I need liquidity, and then ultimately your risk and your governance and thinking through like those multi-layer steps. But like more importantly, where you keep your Bitcoin or your crypto also, it impacts a lot of things, right? It impacts financing, it impacts collateral mobility, and as you mentioned, like ultimately confidence of the board from like a counterparty risk exposure perspective. And so at Coinbase and with Coinbase Prime, the way we think about it is like, how do we marry that all together into an institutional grade infrastructure that allows for the secure keeping of crypto for deep liquidity, for execution, and for like that policy engine with those governance and controls in place. And Coinbase Prime is that operating system.
Okay. So we've got two models. We've got a Bitcoin first bank, and then we've got an institutional prime broker. Let's see if we can create some tension between the two. Maybe not.
We're friends.
Yeah, I know. They're backstage agreeing on everything. I'm like, this isn't going to work. So for both of you, let whoever wants to go first. Bitcoin Treasury Company, there's a natural tension. The safest Bitcoin may be deeply locked down. I remember Saylor one time saying that he wanted his Bitcoin to be like Mount Rushmore, right? It's like it's there, it's valuable, but you can't move it, you can't touch it. That's since changed. But the most useful Bitcoin may need to be available for trading or collateral or financing or corporate action. How should institutions balance custody security with liquidity? Alex?
Sure. I think the thing you've got to think about when you hold Bitcoin is it's not all the same product in terms of what the requirements are. So for a Bitcoin treasury, for example, it's probably split into 2, maybe 3 buckets. So ideally, you're not going to be selling any of your Bitcoin. Okay, worst case scenario, you've got to, but in reality, it doesn't really happen. So I'd be thinking 70, 80% maximum or minimum, wherever you want to look at it, should be held in cold storage. Now, cold storage stroke MPC, whatever works best for you. I would then say you would probably have what I'd consider minimal operability with that set of Bitcoin, that cold storage Bitcoin. But then you also have what I'd call the working capital Bitcoin. So that Bitcoin would be used for collateral. It could be used for obtaining a credit line. That is making the most of your Bitcoin on a day-to-day basis without actually selling the Bitcoin. You may have a smaller proportion, maybe 5% tops, which might be operational day-to-day. You may use it, you may not use it. I'd like to consider most cases people wouldn't use it. You know, the idea of Bitcoin Treasury is actually to hold your Bitcoin. The moment you start talking about selling your Bitcoin, there's alarm bells going off. You know, you saw what happened when Saylor mentioned it. Our world fell apart. Oh my God, he's talking out of his backside. But that is not the case. No, sometimes you need it, sometimes you don't. So from my perspective, majority goes into cold storage, MPC, wherever it may be. So we're talking a higher percentage. Then you go to your collateral credit, wherever it may be, or for the rest, sort of, 20, 30%. And when you're taking loans out against that percentage, you're probably talking 30, 40% LTVs. What you do not want happening to that Bitcoin is it getting liquidated. You need to run scenarios where it's highly managed, it's highly secure, but equally operation policies are in place that if the LTVs, for example, started increasing and there's a risk of liquidation, there is operational procedures in place to get the LTV back down.
I think that unfortunately I'm going to disappoint you and agree with him. but no, I think that taking a step back is that convenience cannot come at the convenience can't be like the tail that wags the dog, right? It can't come at the expense of like common sense or like reckless like risk controls in terms of like who has access to the Bitcoin, like how it moves. And to Alex's point, like the majority of that, like I don't know like what the percentage is, like that's going to be a personal question for each institution or firm or even individual that should be in cold storage, but definitely majority, right? And you can play around with like what that looks like. And so like the question becomes like, how do you make those two things, convenience and security, like not be at odds with each other and dissolve that tension? And so I think that there's 2 solutions that we look at for like a lot of our clients, and I think that they're becoming more prevalent in the market. One is around trade finance, and then 2 is like around like vault holds. So with trade finance, you can say, okay, I have 100 BTC, whatever it is, and I want to sell this. And so that Bitcoin sits in a qualified custodian. You sell it, you execute it in the market. At the point of execution, you then settle that trade, right? So you're able to get liquidity without having to move your assets out of cold storage or secure custody. The second part of like vault holds, you say, okay, well, I want to borrow against it, right? I want to use it for collateral. Great. So what do? You keep your Bitcoin again in a secure custody, qualified custodian environment, and through that, there's no rehype, right? So that stays in there, and you're able to, you know where your assets are, you're able to get financing about it. So both those solutions provides the ability to make Bitcoin or any crypto not just dead asset, but actually active and work for you.
If you ever want to confuse a treasurer that doesn't really understand Bitcoin, just ask him how many of his T-bills are in cold storage. Right? They just give you this blank stare, like, okay, I'm going to get you there. But it's going to take a minute. Okay, so crypto markets are 24/7. Corporate governance isn't. Bitcoin can move on a Sunday night. Boards and treasury committees do not. Has institutional trading infrastructure matured enough for public company Bitcoin treasuries, or are we still forcing a 24/7 asset into a 9-to-5 governance model? Andrew.
Yeah, so I think that the first part of your question, like, yes, like the institutional infrastructure has definitely matured into like 24/7 environment, keeping up with crypto, and a lot of the features and products in TradFi that you weren't necessarily used to in crypto are now there. The tools are there to allow people to come in at size and at scale. But I think that particularly probably within the corporate segment, if I look at like other institutional participants like market makers, hedge funds, they definitely have adopted more of a 24/7 model, like follow the sun, and they have to because of the nature of their business and like the liquidity and the constant like risk that they have on. Obviously, for corporates, to some degree, there's a longer-term horizon, which makes sense. And so I think that there is an element of still living in the 9-to-5 world because you need like legal approvals or like board reviews, and like this isn't something that's happening kind of constantly. People like to sleep. I personally also like to sleep. This whole like 24/7 like keep going thing I think is not necessarily sustainable. So it's like, how do you marry those two together? And so I think that again, when you think about the infrastructure that's built and being built, it's things like having guardrails in place and pre-approved limits, and again, that right policy engine in terms of like who can move the assets, where can they move them, and having like a predefined kind of like path, and therefore like clear escalation. But there's gonna be natural delays of things like if there's like multi-sig and settlement involved, like where someone's on a plane or someone's in a different time zone, there's the natural lags. But I think that we're getting better and better, and as we see this become more common in terms of people putting Bitcoin or crypto on balance sheets, having those right processes in place so that employees are able to keep going without being blocked by one or two people.
I think the problem with this intersection between the governance and the 24/7 nature of Bitcoin and crypto, whatever you want to call it, is that they don't fit precisely. So you need policies in place with the board whereby if the market collapsed X, Y, Z%, then policies are in place whereby automated collateral could be traded or things like that. I mean, basically, what I'm thinking, you basically said in a few sentences, but I think the problem we have right now is governance model was based off traditional assets. So we're talking market, the market trading hours of equities, bonds, etc. We're trying to fit the 24/7 nature of Bitcoin into that model. It doesn't quite fit. There are ways we can get around that. So you can have board policies whereby, certain trading conditions are met, then you can execute at certain points. But for now, it's not quite there. On the infrastructure side, yes, it is there. 24/7, 365 works. But on the governance side, I think there's a lot of work still to be done. The reserve model doesn't require as much sort of maintenance as such, but if you are a trading company, you've got to adapt your governance in terms of being able to trade or execute at any time of day. You don't need to be calling up and doing an emergency board meeting at 2 a.m. on a Saturday. That doesn't quite work. You need policy in place where, okay, the market falls 20%. We have policies in place whereby we can cover it by X, Y, Z, wherever it may be.
And also, like, by having those policies in place, it means you actually have a plan. So you're not just flying by the seat of your pants, which I think is also maybe more important as well.
I mean, that's also, like you say, that is an indication of the maturity of the market now. Like before, when the market collapsed, it's like, oh my God, what do we do?
So let's say we have a CFO or CEO in this room about to choose a custody and trading partner. What are a couple things that they need to ask before choosing one?
I think there's one question, right? And we get it a lot. It's like, well, no, you kind of get two questions. One is like, can I save a basis point or two in custody? Not that question. The real question is, what happens to our assets, like if you go bankrupt, a Lehman situation, right? So what happens to our assets if you fail? And I think that as a CFO or a COO or anyone with a fiduciary responsibility, you really need to hear three things in terms of that response. And if you don't, you should just leave the room and walk away from that counterparty. One is like the legal segregation of those assets. Two is to make sure their bankruptcy remote. And three is, again, the transparency and verification. And so from a legal segregation perspective, you want to make sure that those assets are held off balance sheet, and you want to make sure that they're in the qualified custodian, right? And I think there's a lot of regulatory jurisdictions, like such as Europe with MiCA, like where you can ensure that's happening. In the U.S., there's like NYDFS and other regulators. On a bankruptcy remote side of things, you want to make sure you have the legal protection in case of like the worst case scenarios that's like clearly spelled out. And then for transparency and verification, just that they're able to explain like in plain English, like where your crypto is stored and how it's stored, and that the governance and risk controls are around that.
The one thing I will ask Andrew, and this isn't this is not sort of a negative. You mentioned qualified custodians quite a fair bit. Are you mentioning that because Coinbase is a qualified custodian? Yeah. Because from my perspective, and I work at Xapo Bank, we have a lot of clients in this space who haven't requested a qualified custodian. So why would you think that is a requirement?
I think that and the business models are like a bit different, right? So I think that when you have that fiduciary responsibility, like as a corporate or as a hedge fund manager, there's like certain like legal restrictions that are put in place and a regulation behind that, right? And so even if it doesn't have that qualified custodian status, I still would want to have those first two things that I talked about, right? Which is the legal segregation, right? Because it just gives you more protection. And then two, on top of that, the bankruptcy remoteness, right? So like if you can package that in a different way, then perhaps you could get comfortable with it. But for me, as I kind of go through a diligence checklist and I think about, because ultimately it comes down to like, what controls and processes you have in place and what's going to hold up in court, right? Like those are kind of the two things that you want. And so not saying that necessarily a qualified custodian works in every jurisdiction. We have kind of different like iterations of that are popping up depending on the regulator, but based on where you are to make sure that you have those strong protections in place.
I think from my perspective, you have to be able to attest to the coins that you have in custody. So that is, for me, the most important thing. So being qualified...
That's transparency and verification.
And being qualified custodian or not, if you can certify that by like SOC 2 certification, whatever it may be, then you're doing exactly the same job as a qualified custodian, right? As I see it. So I should mention, I think, as a CFO coming into the market, yeah, what happens if there's an issue? What happens if your company goes bust? What happens to my Bitcoin? You know, is my Bitcoin being utilized elsewhere? Am I just going to become an unsecured creditor somewhere else? You know, is there commingling, for example, of funds? How separate are, is the house Bitcoin separate from the customer Bitcoin? Can you verify that? That's what's important to me.
We are out of time, but I want to get this last question in. So company roadmaps that you're not supposed to tell anybody about. So 2030, what will Coinbase be doing? What will Xapo be doing that will change the institutional side of Bitcoin?
Okay, so 2030, Bitcoin price is now $500,000, let's say, being optimistic. I'd like to think that the market has matured to a point where it's not just about easy access to Bitcoin in a secure environment. I think it's about being within a fully regulated, compliant manner, echoing what's already happening in the institutional world. So we have the same trust, the same legal documentation, the same trust, basically.
I think that like the conversation of this panel will be like very different because we'll no longer be delineating between traditional like corporates and crypto native corporates and treasuries. Everything will be much more blurred and interoperable.
Okay. Awesome. Is Laura in the house? Are we doing a break or no? We're going to keep going. What does that mean? Time. We're taking a break? Okay, we're going to take about a 9-minute break. Before we do that, show of hands. Who says Arsenal? Who says PSG? Ooh, that's what I thought. I got to go make a bet later. And then, who's willing to put money on England to win the World Cup? Okay.
This is cool. Like live prediction markets. I like it.
Yeah, 9 minutes. Please come back because we're going to have Joe Bryan presenting What's the Problem. If you haven't seen this presentation, it's the best one in Bitcoin. See you in 9 minutes. Check 2, 3, check, check, check. Okay. Check. Got me? All right, welcome back. Those by the door, please find your way into some seats here. Our next presenter, Mr. Joe Bryan, I stumbled across his What's the Problem video while I was working at Strategy. And Sailor Academy has this kind of, is it Sailor Academy or no, it was the other page? Hope.com had this page of favorite videos. And I had sent it to Sailor and he really loved it. And Joe said, can you please put it on Hope.com? And I said, let's try to make that work. And sure enough, I got onto Hope and then it blew up from there. So I take all the credit for Joe's success. No, it's an amazing, amazing thing that he put together, allegedly on a Sunday night over a couple bottles of red wine for his friends, but I'll let him tell the true story. So with no further ado, Mr. Joe Bryan with What's the Problem?
Hello again, everyone. Right, well, we're going to do something slightly different today. I'm interested, who has actually seen What's the Problem, either the video or me present? Okay, great, it's probably 70% of the room. Okay, well, firstly, thank you for watching it. Thank you even more if you shared it with somebody else who needs to see it. If you haven't seen it, please go to what'stheproblem.org or just Google What's the Problem and click on the image of this guy's face on Google. We're going to take it in a slightly different direction today because this is not a regular Bitcoin conference. This is more about treasury companies. And so we're going to pull out some of the key thoughts and relate them back to what it is we're talking about today. And disclaimer, I do own Bitcoin treasury shares. And I own them for 3 reasons. Well, when 3 things are true. Firstly, it's run by an actual Bitcoiner, somebody I respect and who I consider to have high integrity, which is not everybody in the treasury company space. Secondly, that the company has got what I consider to be a competitive advantage. And I outlined in the conversation this morning the angles for which I consider competitive advantage to be material in this space. And thirdly, where I have trapped capital. Because due to some arbitrary rules or regulations enforced upon us, I cannot use my capital in the way that I would choose to use it. So I make the next best decision in my view. And I would say nothing in here constitutes financial advice or anything like that. Now, I always like to go back to first principles with everything when thinking about a problem. So why do Bitcoin treasury companies exist at all? It's one word. It's debasement. We are being stolen from. And if we weren't being stolen from, treasury companies would not exist. The state is an abuser. It abuses us through the money. And it always has, and it always will. And when you debase the currency, you trigger 3 main issues. The first is you distort all the price signals in the free market and you corrupt productivity. The second is that business input costs rise for everybody because the new money finds its way into the cost of people, energy, infrastructure, on which every business relies. And the third is it drives asset inflation. And that's the realization that everybody here has had, and hence why we're in the room today. It's this third one. It's about asset inflation. And one of the most famous charts in Bitcoin is that they've been printing money for 50 years. And if we let them, they'll print it for another 50. The purchasing power of the money is decaying. The pound is going to 0. The dollar is going to 0. The euro is going to 0. And when you measure anything in something that can be printed infinitely, it will be worth more in the thing when you measure it in the space of the thing you're printing infinitely. And once you realize this, you come to the conclusion, well, obviously can't hold my savings in the thing you can print for free.
I have to find something else. And that something else has to be something harder, something more difficult to print. And so people think about collectibles, they think about silver, they think about gold or houses. But when you've reflected long enough, you come to the conclusion that actually you just need to own the thing that is impossible to print, and that is bounded by the laws of thermodynamics. And so you end up buying Bitcoin, and as a result, come across treasury companies or the other way around. And those treasury companies are, to a greater or lesser degree, some proxy to Bitcoin. Some are more Bitcoin-like than others. Some will outperform, some will underperform. And some will die along the way, and rightly so. But if it's all just debasement, you do actually own Bitcoin as well, right? And I mean actually own Bitcoin. Bitcoin in self-custody, where you are the bank. You are the person in charge. And unfortunately, we are at the situation, we're at the point where, due to the success of treasury companies, we now have lots of people who hold ETFs or treasury company shares that don't actually also have Bitcoin in self-custody. And this is a big issue. And perspective matters. These things are absolutely not the same thing. We have two sides of the wall in our world. And at the moment, this wall is porous. You can move between both sides. On one side, you have perfect money, bounded by the laws of physics, secured by energy, limited in supply, absolutely, that you can hold yourself, send to and receive from anyone, anytime, anywhere, at the speed of light at zero cost, that no one can ever take off you, or even prove you have access to. Or you have a shadow of that. You have the financial performance linked in either a highly correlated or less correlated way with a different set of underlying risks. And it's a different set of underlying risks because on the other side of the wall, it's financial performance stacked on a series of promises. You own shares through a broker, held at an institution that you may not even be able to name, in a company that itself doesn't actually own the keys to its Bitcoin. It has a legal promise that the person actually holding the keys to their Bitcoin will return them if requested. And that custodian will do so at the good grace of the government. And promises do get broken. Promises always ultimately get broken. And the US and governments around the world have confiscated gold in the past. And they will do the same to Bitcoin in the fullness of time. And it takes one stroke of the pen to change your exposure to being dollars as opposed to Bitcoin. And so this is a permissioned world. And that still makes it a viable investment in circumstances. But it's not a substitution, it's a supplement to what you have. And you're not wealthy if you require permission. If I have to ask you to be able to access my assets or do something with my assets, I don't own them. And so, what if we're actually right here? Like, we view this as a debasement trade, but what if we're actually right? Well, if you're right, then you can't pick and choose the consequences. You can't say, well, I'm just going to benefit from the asset inflation. You find yourself subject to the other two as well, and it's the combination of the three that destroys everything. The distortion of the price signals drives the misallocation of capital across the economy. The business input costs going up drive consumer prices higher, shrinkflation, and the deterioration of quality everywhere. And this is where consumer inflation comes from. The first two make you poorer. The third one makes you unemployed. Bigger government. It also makes you sick because the food starts to get compromised. The quality goes down. More government. Asset inflation, great for some, bad for others. You get wealth inequality across the economy. You get increased homelessness. Houses are now more unaffordable, more government. You get more leverage everywhere, more debt. House prices go up. Families are struggling to feed themselves, home themselves. You can't buy a house on one salary anymore. You need both parents working. And both parents working, you get the breakdown of the nuclear family. They're spending less time together. There's more stresses at home. You have fewer children because the maths doesn't work. You can't have the children you want and keep a home. Fewer children, bigger government because the pension crisis. The pension system becomes underfunded and structurally insolvent. The youth don't care about the future. They're never going to be able to buy a house, never be able to have the family, so they focus on today, not tomorrow. Fewer children. Other people struggle because they're trapped in hopelessness. They can never get ahead. They slip into bad decision-making, destructive behavior, addiction, health crisis, mental health crisis, bigger government. And now the government's got all these secondary issues it has to deal with, so it has to allocate more capital back into the market to try and deal with them, further distorting all the price signals. And between the misallocation of capital and the greater leverage in the economy, it sows the seeds of the next emergency. And all the government can do is print more money to try and solve it. And you get the same thing happening again. And now you're in a death spiral. Bigger government, more spending, more control. The net tightens on everyone. The government has to try and have more and more control to keep the show on the road. And now you find the wall isn't quite so porous anymore. We are seeing the construction of the Berlin Wall for capital all around the world. Europe is leading this charge, but the UK is not too far behind. We see the invention of CBDCs, the restrictions in the banking sector, harder and harder to actually buy Bitcoin and get it into self-custody. And even when you're using stable coins, they're just CBDCs by another name, a more accessible name. And this wall is now a very real wall, or it will be in the future. And what happens when you print money is that ultimately it ends in one of four places. And we know this from history. It's sustained inflation, maybe hyperinflation, and everything that comes with that, normally one of the other three. It's asset seizures. You're trapped inside the system. It's at the barrel of a gun, the threat of a prison cell, or it's via the back door, via taxation changes, structural reform, unrealized gains taxation, for example. They're all asset seizures by different routes in the name of fairness. You find yourself in a situation you can no longer vote your way out of. And this is at both ends of the spectrum. Or something worse. But in all of those scenarios, you are trapped on the wrong side here. Where you could just say no. No. No, thank you. And you're not free if you can't say no. And so I hope this will give those in the room who haven't yet taken the leap to figure out self-custody and action it, to do so. And please protect your families. Thank you.
Hello, everyone. So I'll be hosting this, I guess, fireside chat, which is getting done virtually with Zinks, which should be, hopefully, he should be able to hear us, maybe?
Hello, can you hear me?
Yes, there we go. I can hear you loud and clear. Okay, so let's get this started. Zinks, for a quick intro to everyone, could you just explain who you are? And the title of this fireside chat is Navigating Bitcoin Treasury Companies. Could you just explain what that means to you?
Well, can I just say firstly, I agree completely with what the previous speaker said. Bitcoin in self-custody should be first and the primary goal, and that everything we're about to discuss is supplementary and secondary to having Bitcoin in self-custody. But yeah, I describe myself as a sovereign individual. I've been a Bitcoiner for over a decade. Still anonymous, which is why I'm not with you today. But yeah, interested in the Bitcoin treasury space as well. But like I said, it's supplementary. Bitcoin in self-custody is the primary goal for everyone, I think.
You're very active on X. For anyone who doesn't know, it's Zinks BTC. In your opinion, what makes a good treasury company these days?
So Bitcoin treasury is essentially a game of whoever is the best financial engineers who can perform the best carry trade. So, you know, let's say the total addressable market cap for Bitcoin right now is $300 trillion. It's $1 trillion right now. So there's a massive arbitrage, essentially selling the weaker currency, fiat, and accumulating as much Bitcoin as possible, the hardest asset. And to sum it up quite succinctly, whoever are the best financial engineers stand to benefit the most from that arbitrage. A perfect real-life example is the Japanese yen carry trade. Institutions for decades have been borrowing in the weak, debasing currency at super low interest rates and making a profit by investing that currency and benefiting from those rates into assets that are higher yielding. And essentially, it's the same thing. What the primary goal of a Bitcoin treasury company is to benefit from that arbitrage between fiat, which is constantly debasing, and Bitcoin. So yeah.
There's obviously most people in this room will know about preferred shares, but it's a big thing at the moment and a big talking point. Do you think this is changing the Bitcoin treasury landscape?
So essentially, the best way so far that we've figured out for a Bitcoin treasury company to benefit from this arbitrage is to offer perpetual debt. We've seen Strategy offer STRC, which has allowed them to accumulate Bitcoin at a rapid rate. I think there's just over $10 billion in issuance, and then you've also got SATA, which is the Strive product, which is also doing very well. And it seems to be, the way that the best companies are going to profit from this arbitrage.
So the landscape moves so fast within Bitcoin, but also then on top of that, the Bitcoin treasury space. Where do you see the industry going over the next few years?
I think it'll get more competitive. You'll see a lot more innovation, a lot more products. Essentially, products built along the maturation curve, just slowly eating the fixed income market. So yeah, I think that's what we're going to see. Obviously, in the UK, you've got companies that will probably issue preference shares. And yeah, I expect this model to be replicated, all around the world. And, the race is on, like I said, for the best financial engineers to figure out how to benefit from this arbitrage the most.
When you're analysing the treasury companies and looking at the space and what companies are out there, what they're doing, what sort of things are you looking at and what attracts you to one over the other?
So most of them are pretty useless, to be honest with you. If they're not generating a profit or they don't have a route to offer, Bitcoin-backed fixed income products, then, there's no point, I don't think, wrapping Bitcoin in an equity is that appealing anymore. So yeah, those two things really. Companies that can grow their operating business to generate profits, to accumulate Bitcoin on the balance sheet, and then those that can engage in, financial engineering to essentially offer Bitcoin-backed fixed income products, and preferably in the form of perpetual debt obligations. So if there's no viable route to either of those things, it's a waste of time.
A last question, we've got 20 seconds. Nice, short and sweet, but what do you think the biggest challenge is that these treasury companies face today?
Like I said, just generating yield, which, you've got companies like Falcon Edge. I recommend everyone go to speak to Roy. Very, very interesting model going on there. That, generating a yield on their Bitcoin, and then the other thing is, are they able to be good financial engineers and offer these Bitcoin-backed fixed income products? Like I said, if there's no viable route to any of that, then you're wasting your time. And just one more thing, again, this is all supplementary. Completely agree with Joe Bryan. Self-custody is the primary goal.
Amazing. Well, thank you very much for joining us virtually today. And
yeah, thank you. I hope everyone has a good time as well. Yeah.
Awesome. Amazing. Thank you very much.
Hello again, everybody. So, my name's Scott Ellen. I'm the CEO and founder of XCE. We are a public listed operating business built on a profitable, international, scalable executive recruitment company with an integrated Bitcoin treasury. So I'm going to talk you through how this helps drive corporate Bitcoin adoption and how this works within our business. But first, do your own research, not financial advice. Taking it back to the very start of the journey. So 2014, I established Spencer Riley, our flagship operating business. That business began over those years to do overseas international revenue. So we do 70% of our revenue from international clients. We have sector specialists within the business focused on their specific industries. And from a scaling point of view, we are sector agnostic and regional agnostic. If there's a high billing recruitment consultant who focuses on hedge funds, we could start them tomorrow and they could generate revenue on our behalf next week. But 2016, as the founder and CEO of the business, I discovered Bitcoin in my personal life. And the three elements that we've spoke about today, the hard cap, finite, 21 million cap, unconfiscatability, and transportability stood out. Those three characteristics, that's the first time in human history those three characteristics have been combined. And I believe that that's infinitely valuable. So I moved the business to Leeds in 2020. Now, Leeds is the epicenter of international executive recruitment. Pretty much every business in Leeds competes directly with us in the USA, Europe, and the Middle East. Now, 1 week after moving the business into Leeds, we had lockdowns. I'd been building a cash reserve in the business from 2014, precisely for this type of moment. I thought, we have an opportunity here to attract the best revenue-generating talent from the bigger businesses in this city centre to join our company. And very quickly, the central banks doubled the money supply in order to support employees and businesses. And that opportunity to scale immediately was taken away. But not only that, the cash reserve that we'd been building, I could see was now going to be debased and was going to draw down in purchasing power over the next 5, 10, 15 years. So, in 2021, in October, I committed the business to a Bitcoin balance sheet. You'll all probably remember, if you were in Bitcoin at that time, what happened next. There was an 80% drawdown in the price of Bitcoin. The business at the time increased revenues by 37% compound annual growth rate between 21 and 25 because executive recruitment is uncorrelated to the Bitcoin price. Now, over that 4 years, I was trying to push to find a way to allow the Bitcoin balance sheet to benefit the staff and the future staff of the business. And through design, iteration, engineering, and networking to build an incredible board, I believe, we designed what I'm about to share with you. The first traditional people-driven business designed to grow as a direct result of an integrated Bitcoin treasury. But why does that matter in executive recruitment? How does that drive corporate adoption? Well, a quick run through of how executive recruitment works. So, the recruiter is the business's asset, the individual. And that recruiter, it's their network, it's their billings that drive the revenue. So if the recruiter in the office is asked to find a vice president of sales for a specific client and market on behalf of the CEO, then they must speak to every single vice president of sales in that industry until they've secured the right candidate for the client. On the flip side of that, they must speak to every CEO in their industry and build a relationship in order to be the one they use when they're looking for the next vice president. So it's a very self-sovereign business. The recruiters, if they're billing 500,000, so $500,000 a year of revenue they're bringing into a business, they might earn 200,000, but it's salary and commission. No equity, no long-term incentives, generally speaking. But the more recruiters, the more revenue. So you've got a capital-light business, high margin, that's based on headcount. But every single privately owned recruitment company, the owner faces 3 problems. Cash. They are generating cash, but it is losing value over the long term. Scale. Headcount directly drives revenue. But how do you attract more revenue-generating recruiters? And ultimately, how do you incentivize them and keep them? And then exit. There is no exit available for the owners of recruitment companies. The people are the assets and they can walk. So, competitor acquisitions, rare. Private equity, very rare. And this builds a situation where most recruitment company owners work in their own company their entire career only to self-fund a management buyout. So 3 problems, no solution until now. XCE, cash, the solution is we have an active Bitcoin treasury with a capital markets team with deep expertise. We have Richard Byworth as a board advisor. We have Adam Back as a follow-on investor throughout all of our rounds. And scale, we have performance-based equity used to attract, incentivize, motivate, and compound the earnings of every recruiter who joins the XCE group. And then exit. For those recruitment company owners who have no exit in sight, they're able to join a listed vehicle and switch their cash reserves into Bitcoin, switch their ongoing cash flows into Bitcoin, and build equity in a listed vehicle for the long term, giving them the opportunity to work towards the exit they never thought possible. What does this look like in practice? The more revenue-generating recruiters we attract, the more revenue-generating acquisitions we make, the stronger the operating business. Now that provides strength, credibility, durability to the integrated Bitcoin treasury, which makes the Bitcoin treasury more attractive to investors in the markets. Now, the stronger and bigger the Bitcoin treasury, the more attractive we become to the next recruiter and the next acquisition. And it is a compounding model between operating business and balance sheet. But what's the opportunity and what's the scale? There are hundreds, thousands, and tens of thousands of recruiters globally with no long-term equity options. We are the only listed vehicle with a Bitcoin treasury backing those share options over the 10, 20 years of revenue generating that they intend to do. There are 30 local competitors competing internationally. There are over 500 in the UK, and there are thousands globally, privately owned, often between 5 and 50 headcount. So, what this allows us to do is design a Bitcoin treasury company where every capital raise we execute increases Bitcoin, increases revenue, and increases Bitcoin adoption across businesses. The larger the raise we do, the more attractive we become to the next recruiter, the next acquisition. But why is that important to Bitcoin corporate adoption? Well, I firmly believe that Bitcoin is most powerful when integrated into operating businesses that are service-based, people-driven. In executive recruitment, you can imagine thousands of recruiters aligned with Bitcoin, whether they understand Bitcoin or self-custody or not. Every single business leader in every single market, in every single jurisdiction around the world speaks confidentially to executive recruiters about their biggest challenges, their biggest opportunities, their career ambitions, and their business ambitions. And by globally disrupting the executive recruitment market with Bitcoin, we have an opportunity to drive the Bitcoin network forward, expand corporate awareness and education, and drive Bitcoin adoption through every industry around the world. So I welcome you to join XCE on that mission to drive Bitcoin corporate adoption, and thank you very much.
Hello, I'm back again. So I'm going to talk around something that we've built over the last 6 months. But a little bit about me is I'm the founder of the Bitcoin Collective and the co-founder of the Bitcoin Business Network. And to give credit to Scott, he was actually one of the ones that came up with that idea, and we've ideated over it and formed it into what it is today. So I'm going to talk around the Bitcoin Business Network rather than the Bitcoin Collective. So we started as just a podcast. I started the podcast back in, I think, late 2020. And this was great, and then it moved into being a conference. One day we said, right, let's do a conference, which spiraled into the UK's first major Bitcoin conference, where we had 30 speakers flying in from around the world. But then we had institutions like Fidelity, UKUS, members of parliament there. But conferencing wasn't really what I wanted to do and what I wanted the business to be like solely, because conferencing is hard. Hats off to everyone that's put this together. So we went through many different failures, trying different things, as any business does. And then it clicked with this. This is what we enjoyed doing. We enjoyed talking to business owners, talking to entrepreneurs, founders. What are their struggles? What are their problems? And this is when we could bring the conversation of Bitcoin into this. So we built the Bitcoin Business Network, which is a network of businesses who are stacking Bitcoin, accepting Bitcoin, or on that journey, learning from each other on the right way to do it, different ways of doing it. And it's just about being a community. So this is a flavor of a few of the businesses in the network. And you'll see some of them are in this room today, quite a lot of them are in this room today. And a lot of them are normal day-to-day businesses as well. And they're not necessarily Bitcoin businesses. And that's the thing I want to highlight, is these are just normal operating businesses that happen to have found Bitcoin and are either stacking it, accepting it, and adding it to their balance sheet. But there is one down the bottom right there that you'll see. And this is the one that I hinted at on X the other day that has just joined the network. So I'm very thrilled, and I managed to get approval from them that I could announce that Great Ormond Street Hospital Charity is now part of the Bitcoin Business Network. And I think for me, like, the price tells you nothing. Like, this tells me everything about the direction that Bitcoin's going. Because the types of companies that are now reaching out and coming forward, when we're giving that credibility and putting those brands out there who are looking at Bitcoin, this is where I see and I get most of my excitement. I don't really look at the price. It's the adoption of businesses that are coming to Bitcoin. What is the Bitcoin Business Network? It is an ecosystem. I wanted to build it in two different parts. So this is the first part. It's an ecosystem of businesses who interact with each other. We're already seeing these businesses pay in sats to each other, work with each other. Maybe they're just not paying in Bitcoin, but they're still working with each other, supporting each other because they've got that values, or they've got the aligned values when it comes to Bitcoin. So we put on events for them every quarter to bring them all together, doing introductions, putting people together who we think would be great to work together. And then obviously we've got like directory, discounts, newsletters. But the big thing for me is the connections and the events. And then the next thing is, and this is what really matters, is this is a force for change. It is hundreds, then thousands of businesses all saying the same thing together and coming together to actually potentially change UK policy and be a louder voice rather than screaming individually. This is where I see that we can get UK policy changed in the favor of Bitcoin. So it's not just a networking club, it is a movement, because we've got hundreds, and soon, hopefully, we will have thousands of UK businesses all saying the same thing. So the idea formed last year, and we really started to pull it together at our last conference, Competitive Advantage, in November, and then we launched it late January. And that's then, we launched with 50 founding members, which Smarter Web are one of them, so thank you. Moving up to 75, and now we're over 100 members in this network in such a short space of time. And before our next conference, I want that number to be 300, because I'm only seeing things speed up. More conversations happening, larger companies coming forward and saying we are interested in Bitcoin. Not necessarily saying we've got Bitcoin, it's we're interested in it and we want to learn more and be part of this community. So I've put it into, this is a Treasuries conference, so I've put it into your language. So we count members that we hold rather than Bitcoin, so we're holding 102 members since IPO in January, 104%. And then we've had monthly compound growth of 19.5, and as I said, 300 is the target that we want by the end of this year. And that is very achievable from the conversations that we are having. So we're doing this because we believe that every business needs a Bitcoin strategy. And we have different tiers within the network. We have tiers for business owners, but then we also have tiers for professionals as well, because we see how important it is for professionals to be that voice within their organization. Maybe they don't own the company, but it's important to have people that are knowledgeable in Bitcoin in organizations helping educate from internally. So we have tiers for professionals as well. So I just want to say thank you for listening. And if anyone wants to chat about the Bitcoin Business Network, please come find me, or you can just scan this as well, and you can find out a load more on our website. I'm way over time, so thank you very much.
All right. Ed mentioned that we need to liven this up a little bit, so real quick, everybody stand up and either shake the hand or fist bump the person next to you, maybe introduce yourself. This is only going to go like 10 seconds. Okay, all right. Oh, wow, this is going well. All right, great. Please take a seat. Check. Is this lively enough for you, Ed?
Testing. And stop.
Okay, this went a little too well. All right, please take your seats and help me welcome Ed Julien and Stafford Massey to the stage. I learned that trick from Anthony Pompliano, actually. So we're joined by Stafford Massey, the executive chairman of Africa Bitcoin Corporation, and Ed Julien, an advisor to Arcadia B. He's repping the team. I mean, look at that. So Africa Bitcoin Corporation represents the African Bitcoin Treasury case, a listed company, a strategy built around Bitcoin, regulatory credibility, financial inclusion, and the reality of emerging market currency and capital restraints. It's the first African-listed Bitcoin treasury company combining Bitcoin with financial services. If any of this is wrong, you're going to correct me, right? And it's operating under South African governance and FSCA oversight. Maybe you could tell us what those letters mean. Arcadia B represents the Mexican Bitcoin treasury case, a Bitcoin treasury model adapted to local regulation, local investors, tax treatment, and Bitcoin native financial services. And Arcadia B is Mexico's first Bitcoin treasury company combining years of Bitcoin financial services experience with a strategic Bitcoin treasury allocation. So Stafford, Ed, thank you for being here today. We all appreciate your time. I'm going to start with a statement, and I'd like each of you to weigh in with a disagree, an agree, or a strong agree. Here's the statement. Emerging markets are not just earlier versions of the US market. They may have stronger monetary pain, weaker local currencies, different tax incentives, less developed capital markets, higher trust deficits, and more urgent use cases.
So okay, thank you. Thank you for having me here. I think that's exactly it. I think the difference between us and everyone else in this room is that you folks sit in markets that have high capital and very low yields. We sit in markets where low capital, and the yields are extraordinary. Warren, our CEO, shared a couple of stats with us the other day that, a 1-year hold on some of the government bonds and some of the pension fund bonds can yield you 20 to 22%. So something like SDRC doesn't work where we come from. We've got to take the Bitcoin and do something different with it. You guys take Bitcoin, you financially instrumentize it, and you create these preferred stacks, and then you generate yield. And we find that very fascinating. We find that interesting. For us, where we sit, we need to take the Bitcoin, and we need to do something where we can farm the yield. It's a polar opposite, but yet it's very synergistic relative to our approach. So we have a very simple business. We have a private credit business. We deploy capital from pension funds that's lent to us at a weighted average cost of capital of 12%. We lend that out at 18 to 22%. It's very, very competitive where we come from. We take Bitcoin, and instead of lending from pension funds at that weighted average cost of capital, Bitcoin allows us to extract fiat out of it below 5%. And if I can get something below 5% and employ it in a market of 18 to 22% being cheap, that's an incredible arb. That's an incredible opportunity for us. So for us, Bitcoin kind of changes our lives. Bitcoin allows us to deploy private credit in a weighted average cost of capital way that we've never been able to do before. And then what's exciting for us is we can drive down the cost of fiat. And Seyfuddin Abbas joined our team, the guy that wrote the Bitcoin standard, and the reason he joined the team was for exactly that reason. He could see the personification of what he wrote in the Bitcoin standard and the fiat standard playing out in our territory. And that was we were taking Bitcoin, or we are taking Bitcoin, and we're bringing fiat to its knees, and we're deploying it in and having real human impact. So our core is very accretive. We have a business model that's very, very synergistic with our Bitcoin strategy. So it's not far removed, it's not just integrated, it's synergistic, and it's very combined.
I didn't know this until we had dinner last night. I don't know if it was you or Warren that mentioned, and I think this is important because when people hear the arbitrage is between like 12 and 18%, if I'm remembering your numbers. But that 18% number probably sounds high to someone just listening, but that's sometimes 40% below your competitors.
Yeah, you go to Zimbabwe and you ask guys over there what's their lending rates. We did. It's 20% per month. Right? 20% per month. You go north of South Africa's border and it just keeps increasing in that way. So if you can take a business, take Bitcoin, bring fiat to its knees, and you got it at 3 to 4 to 5%, and you're deploying that capital at 10% per annum into Zimbabwe, into Ghana, into Botswana, into Namibia, that changes lives. That's access to capital that these folks have never had before. And when you take a look at the type of businesses that we deploy capital into, I mean, these businesses are real businesses. These businesses have been able to survive, managing loan books or managing their stack at 20% per month. You give them money at 20% per annum, you've completely changed their lives. And that impact is a story. That's the reason we get up every day. Because, Warren and I and our families, we grew up in you guys talk about broken money. We always say Bitcoin wasn't made for you. Bitcoin was made for us. We know deflation. When you guys talk about inflation or deflation, you guys talk about 4, 5, 6% per annum. We talk about 4, 5, 6% in an afternoon. Where we grow up, we see broken money. When we see Joe get up and he talks about the stuff on his slides and he talks about how broken money impacts people and makes them less, more depressed, gangsterism. We grew up in those environments. For us, it's a very lived reality. So when Bitcoin came along, Bitcoin for us is, for the first time as an African, we've got a piece of collateral that the entire world desires, will allow us to collateralize, and will give us fiat for it, instantaneously within 5 minutes, sub 5%. In the history of Africa, we've never had that. We can have an apartment in Cape Town, and we can fly to Switzerland, and we can try to collateralize that apartment. No, they won't do it. I can't leave my country, even though I have a gold-based country. I can't leave the country with a bag of gold to go and collateralize it somewhere else. But when we discovered Bitcoin, for the first time ever, when we call it perfect money, here's the reason we call it pristine capital, perfect money. For the first time, I've got something that I can go online and I can lend against with deep liquidity pooling, sub 5%, and I can deploy that capital into a high-yielding environment That to us is life-changing. We've never had that. And for us, that's why we say Bitcoin for us is today. We talk about unit of accounts today. We talk about medium of exchange today. If you come to South Africa, you go to some of the coastline, you'll find people utilizing this asset as a medium of exchange. In some circular economies, it's a unit of account. If you go into those circular economies and you offer them a US dollar, they're not interested in it. You offer them a pound, they're not interested. They want Satoshis. That's our lived reality. We see that on the African continent, and it's continuing, and it's continuing, and it's continuing, and it's increasing. So the core principles, that basic value proposition of Bitcoin, I think sometimes we've all forgotten that, right? We're trying to financially instrumentize this thing to such a sophisticated level, but in our world, the core, decentralization, immutability, sovereign, those core basic principles is our base case for Bitcoin. And all we're doing is we're taking a private credit engine, and we're saying, when we hear everyone talk about private credit in such a negative way, we just want to wave the flag and say, private credit in your countries changes lives. It does impact lives. Yes, you get opaque private credit, but I would say that's not the majority of private credit. And I keep hearing in the Bitcoin community, we keep talking negatively about private credit. I can tell you something. You take private credit away and everyone just sits on Bitcoin, I don't know what the world looks like. Where do all the inventions go? Where does all the expression go? Where does all the purpose go? So for us, we believe there is private credit that's pristine. And we've demonstrated that. We publicly traded for the last 3 years. Take a look at our book. Look at the company's performance. All we're doing with that engine, we're taking a thermonuclear weapon, like Sailor says, and we're shoving it into a private credit engine and deploying it into a high human impact environment. And for us, that's the excitement. So, the pent-up demand, it's almost $500 billion of demand in Africa. Our book is 4 or 5 times oversubscribed. Our loan book is, all our loans are double securitized. Our default rates on our loans are sub 1% over the last 3 years. And that's because they are beautiful business operating under extreme conditions. And if you just give them a break, if you give them access to pristine collateral, it's incredible. I mean, just the difference that it makes. Yeah, that's our story.
So that's all we have time for. And thank you. Yeah, thank you very much.
Mexico.
Sitting next to Stan, one of the best public speakers I've ever been around. So it's kind of intimidating to be here with him. But every time he tells a story, he gets the round of applause and standing ovations and stuff. So I'm not expecting that. I know the first thing you're thinking is I don't look very Mexican, but. I lived in Mexico for 13 years. My wife is Mexican. I have a lot of ties to Mexico. And while I was still at Strategy, I was approached by Boyd Cowen, I know that doesn't sound very Mexican either, who wrote the book, The Bitcoin Singularity, and Carlos Flores, who started one of the first Bitcoin companies in Mexico 7-8 years ago called Capital X. And they said, we're going to do a Bitcoin company in Mexico, Bitcoin Treasuries company in Mexico. And I said, I'm in. Couldn't do that in Strategy at the same time. So I became the Bitcoin strategy advisor for KDB. The difference in Mexico, and the way I like to explain it, the difference between countries is not like football, American football, baseball, basketball. It's more the subtle differences between how they play in the Premier League, how they play in La Liga, how they play in the MLS. It's just each league kind of has their own, not different rules, but different strengths and different ways of playing, right? So in the case of Mexico, what you've got, and I've been to Bitcoin conferences all over the world, and you go to Prague, for example, and they wear it like a badge of honor. It's like, yeah, down with the communists, Bitcoin, they're proud of it. You go to a country like Mexico, and you see a guy with mining rigs, and he's got like ledgers all over his desk, and it's like, you have Bitcoin? He's like, no, why? Why are you asking? I don't have any Bitcoin, I don't have any money, right? It's a different culture. And so, what we're trying to do with Arcadia B is bring all those closet Bitcoiners out into the open and say, hey, this is a way to invest in Bitcoin, this is a way to use Bitcoin. Maybe not with as noble goals at first as maybe what Stafford's doing in Africa, but if we can get Bitcoin into the common speak of the country, we've advanced Bitcoin. So there is no effective stock market in Mexico. Family offices, investors, they put 90% of their money outside of the country. And so what we're trying to do is find a way to create a vehicle, in this case Arcadia B, that may be listed in Mexico, may be listed in NASDAQ, where Mexican investors can actually invest in a Mexican company. The underlying business is an exchange, it's loans, it's everything that you see at like a River Financial, but in Mexico. And then on top of that, you have a Bitcoin treasury company. We've had to pivot a couple times. One thing with Jesse Meyer's chart, we redid it for Mexico, and 2/3 of the chart is real estate. So you go to these wealthy Mexicans and you say, hey, sell your real estate for Bitcoin. No, I'm not selling my real estate. So we had to think and think and think, and we came up with a way where we can put their real estate into a trust, and then they get a loan against that real estate, and they're like, do it. I want that done today. So that's kind of the different way that we play in Mexico. And then on top of that, it's just allowing people more access and more access. We were the first Bitcoin company in Mexico with a bank account. We've kept that same bank account for 8 years, which is miraculous. But just a different way to play the same game, but distinctly different.
You're good. I held up the microphone. I was like, and how does real estate? I'm like, he already covered it. Got it. What's different in the emerging capital markets? I'll throw the easy answers out since we have 3 minutes left. Currency volatility, inflation, access to capital, regulation. Like, are you copying MSTR? Are you becoming something structurally different? What's going on in these very unique, different, separate markets?
I think we front run all your questions, didn't we? Yeah, but I'll just go briefly on that. You and I have talked to Bitcoin treasury companies from around the world, right? And every one of them's just got its different angle. You know, this can sometimes come across as inappropriate, but people try to tell me, well, how do you define different Bitcoin treasury companies? I'm like, well, how do you define different women, right? It's that distinct, it's that different. It's like they're all just a little different, and you can't really put your finger on what the best one or the right one is for you. Are we copying the strategy
Unless
playbook?
you're married, then you know which the right one is for you.
Are we copying the strategy playbook? Yeah, in some ways. It's about Bitcoin accumulation. It's about financial engineering. It's about all of this. But it is massive, massive amounts of adaptation to the local market and the local needs. You just got to be ready to pivot and pivot and pivot and see, you know, what's going to work for your market and how that plays into the same underlying values of what you're trying to accomplish.
Yeah, I think what we look at strategy and we think it's interesting, and I'll just take it back to our market. Our market is different. It's a complete inverse. It's low capital, high yield versus low yield, high capital. You use Bitcoin to generate. Over here, you do Bitcoin is your lightsaber. You can walk and just farm yield. That's an extraordinary thing. But we've taken a look at it, and we're seriously considering it, and there's nothing I can say because it's a publicly traded company, but STRC is a very interesting thing for dollar-denominated African countries. We think we could put a wrapper around STRC and do something by listing on those exchanges. So dual listing across Africa is definitively our strategy. So if you take a look at strategy is very US-based at the moment. I think what makes us maybe also different is that we're continent-wide. You can't do what we've done in Ghana. You can't do it in Nigeria. You can't do it in Kenya. Those, the capital markets are opaque. The exchanges are arcane. We know how to navigate that. So I think what we represent is a continental strategy. So that's very different from other Bitcoin treasury companies, which is just the country that they're in. South Africa does orchestrate a lot of the rules and regulations. So from a regulatory compliance perspective, what gets articulated in Africa tends to feed back up into Africa, and that gives us the opportunity to go up. But I think what we're interested in continental-wide, but one of the things that I just want to drop here today is, we spoke to a couple of treasury companies last night, but I just want to open up the door. If you're a treasury company in the room, and you're sitting with tons and tons of Bitcoin, and your core business is sort of just over there, and it's not doing nothing, and you're just waiting for a number to go up, or you're waiting to just get more Bitcoin so you can finally build a cap stack with a preferred on it and attack some market, we want to open up our doors and say, come talk to us about your Bitcoin. We've got a passing layer where we can gain access to high yields, and we can take your Bitcoin, you can pledge it to us, and we want to work with Bitcoin treasury companies to give you access to high yield African markets in a regulated way. We've just moved up from the alternate exchange on the JSE. We're now on the main bourse. So we're a serious player, continent-wide. We can open up yield in Africa. So Bitcoin treasury companies, I'm waving the flag today. If you want to speak to us, Stafford at AfricaBitcoinCorporation.com. We want to help Bitcoin treasury companies to generate significant yield with human impact, continental-wide, and bring Africa to you. We think it's a massive opportunity, so please speak to us. Yeah.
Yeah, and if you're trying to decide which one to invest in, just wait for the Mexico-South Africa World Cup match. And when Mexico beats South Africa, you know where to put your money. Thank you very much for your time.
Warm round of applause. Thank you, gentlemen.
Thank you.
Hello, everyone. So I've got somebody that some of you won't know, Radu, with me today. And we're going to talk about the role of data analytics in Bitcoin Treasury Company metrics, which is an area that's very, very important to me, and I'm sure lots of you as well. So if I just get you to start, Radu, do you want to tell us a little bit about yourself and how you came up with the strategy tracker, originally the Sailor tracker, and what your role is in the industry?
Yeah, thank you, Andrew, and thank you for the invite and for organizing the conference. It's kind of surreal that I get to be here because for the most time I didn't have anyone to talk about Bitcoin with, and now I get to talk to you and to all the leaders in the space, and it's really surreal that this is happening. The reason, I run these analytics websites that showcase Bitcoin Treasury performance. Start off with MSTR tracker, and that led to Sailor tracker and strategy tracker. And MSTR tracker came before strategy.com, and the motivation behind that website or that work is that I think we're in between this paradigm shift that's happening at a civilizational scale, but there's a very big information gap, and what I was trying to do was bridge that gap between, what we in this room know and what the rest of the world knows, and that's a massive gap. And the question is, how do you tell this story to the world of what's happening? So I was trying to compress. So one problem that I had was, well, maybe let's roll back the time a bit. And I can tell you how I got into Bitcoin to begin with. So I started as an engineer at Amazon end of 2016, and when you start at Amazon, you get a signing bonus, and for the first time in my life, I had some money to invest, and the timing was exceptional because that was before the Bitcoin bull run, and somehow I decided that Bitcoin was the most interesting to invest in, in early 2017. So I invested my signing bonus in Bitcoin. And I rode Bitcoin all the way up and all the way down. And then, after that happened, I was like, what did I invest in? What is this thing? And then I just fell down the rabbit hole. And then as you fall down the rabbit hole, initially you're skeptical. Initially I was interested. I invested in it. And then I went through this journey. But by the end of 2017, I was still kind of skeptical. And when you're skeptical, you have a lot of questions. You're like, is this scalable? Is the security model? What is it? Is it solid? Is it decentralized? There's all these concerns you have when you invest in a new monetary network, which wasn't even a term back then. Anyway, so you start off being really skeptical, and you start eliminating all these concerns you have, and then by the end of it, you don't have any concerns anymore, and I was left believing that the only way this is gonna perform is just up and to the right. That's what I convinced myself that Bitcoin is gonna do. Which back then was a very strange belief to have because it was before any institutional adoption, right? So I had this belief and I had no one to talk about Bitcoin with because it's just hard to get people's attention. At most I would get 30 seconds and then I would get cut off. And that would happen regardless if it was family, friends, or coworkers, you just get cut off. So then I started thinking, okay, how do I talk to people about this idea that I've come across that I think is very profound and very beautiful, and it's going to help everyone? And what I've landed on is that, okay, I need to communicate this in the most concentrated form possible, in the quickest way possible. So that eventually is what led to analytics, because analytics is a way to tell the story in a very concentrated manner. Because what people, like one thing that draws people's attention is the fact that number goes up because everyone likes to make money, right? Another thing that draws people's attention is the thing being endorsed by public companies, right? Because people follow leaders and they're looking for authority to say this is fine, it's fine to buy this thing. And what I was trying to do with the analytics is combine those things, like show the number going up, show the endorsement by public companies, and find a way to tell that story very easily to the whole world, because I think it's a story that needs to be told, and you want to tell the story in the most effective way possible.
Yeah, I completely agree with that, but it brings us nicely on to, if we look at Strategy Tracker today, you've got Strategy, you've got Strive, you've got SmarterWeb, you've got a number of other companies all on there with their data, right? But what can we do as an industry? So, people like yourselves, the companies, many of the companies in this room, what can we actually do to make it better? Because, it's okay right now, the analytics, like we've got our own dashboard and it's okay, but what can we do to make it better?
So I think what's important is to align on what the right question is, because I think there's a lot of focus on the data and presenting the data, but the real thing that drove me was storytelling and trying to tell the story to the world. So the real question, I think, is how do you most effectively tell the story to the world? It's not about dashboards, it's not about data, it's storytelling.
Yeah, so we as a public company, we have a fair bit of experience in that, because you're right, we spend a lot of time speaking to investors, institutional, retail investors, journalists, anyone that wants to listen, in all honesty, about the story and what that means. And you're probably right in the sense that the analytics do come secondary. But maybe where we need to end up is we need to end up where people understand them. So, if you take regular equities, PE ratios and things like that, people get them. But on the Bitcoin Treasury analytics stats at the moment, I don't think people really understand how they all interlink together. So if you take our company, we've got a fantastic Bitcoin yield quarter to date. That's amazing. But you have to view that alongside the leverage or the amplification that we've added into the business, because otherwise it's very one-sided. But to me, more as an investor than someone that runs a Bitcoin Treasury company, I think all of the companies need to work together better with people like Radu to share the data in a common format that is the same as it can be. Because if you look at the structure behind a lot of Bitcoin Treasury companies, they're quite difficult to get your head around, and if I sometimes can't be bothered to look at some of them because of the structures and all of that stuff, then somebody that's an investor that's not as committed to Bitcoin and Bitcoin Treasury is going to find it harder, right?
Yeah, so I think one thing that would help with that is having all companies align on the story. And that means having all companies align on the standard. And I think that's the most effective way to channel the story, because that way, if every company shares their story differently, then it's much harder to sell that to the world. But if all the companies come together and say, we all believe in this one story, this is the story, I think that's the most effective way to broadcast it.
Yeah, the only thing that I would say slightly against that is defining the story.
Yeah.
Because the story, as Jesse said earlier today, most of us believe that with a Bitcoin treasury company, you're trying to increase the Bitcoin per share ultimately. That's the point of having a treasury that's been built on Bitcoin.
Yeah.
But it's challenging because we have to explain the story, but at the same time, explain it in different ways, but around that common goal, because lots of businesses, Freddie, Roy, and Jesse talked very well earlier about the Bitcoin yield strategies, and there's different ways of improving that Bitcoin per share, which is, one of the challenges. But maybe, just maybe, the takeaway from that is that, we're so early in this new industry that it is harder for people to understand if they're, not as keen to get their head around the Bitcoin treasury model, and whilst we don't want to talk about price too much, when Bitcoin price improves, that encourages people to put in that effort to understand it more, right?
Yes, I think one problem is that in order to understand the Bitcoin treasury company, you have to understand Bitcoin. And to understand Bitcoin, you have to understand all these, all these seemingly independent areas of study. You have to understand the computer science of it, the engineering, the economics, arguably even like the physics of Bitcoin. You might even say it has to do with mythology and those things. But anyway, the point is that you have to understand this very complex thing before you get to understanding Bitcoin treasury companies. And like to even talk about Bitcoin yield and to appreciate what Bitcoin yield is, you have to agree that Bitcoin is the paradigm shift, and that's the thing that's going to change the world. Because if Bitcoin is not something you believe in, you're not going to care about Bitcoin yield.
Yeah, very, very well said. So I don't want to put myself too much on the spot here. So rather than addressing it to me, if you just address it to all the Bitcoin treasury companies here, if you had to ask us to do one thing then, just one thing, and try and keep it high level, what would your request be to us in order to make it better for everyone?
I think aligning on the story is important. And not just from a storytelling perspective, but also from a standardization perspective, because if everyone defines metrics like MNAV differently, and if everyone defines their own metrics differently, then it just makes the space more confusing. So it's good both from an analytical point of view, but also from a storytelling point of view, I think.
Yeah, so from the perspective of the Smarter Web Company, we're very keen on that, and we'll certainly try to standardize those things, and we've had some sort of private chats around some other companies that might help with that, and see if we can get some standard definitions and models and data structure to pump that data out to whoever wants to use it.
That would be very helpful, and I think that would be a good thing for the space.
So just before we move on to my final thing that I wanted to ask you, I did want to say again, we all appreciate everything that you've done for the space. I followed Strategy Tracker, Sailor Tracker, for years and years. Everyone here is probably going to be familiar with the orange dots, that we see almost every Sunday afternoon. So yeah, we appreciate everything that you've done, Radu.
Yeah, I'm honored to be part of the story and the mission. Even if it's a small part, it's a big honor.
So my final question, and you can answer it however you want, but I think everyone would be quite interested to understand where you see Bitcoin going in the short term and where you see it going slightly longer term. So, price predictions.
Yeah, I think people tend to be too optimistic in the short term and too pessimistic in the long term. I think that's a common thing that humans do. So I'm extremely bullish over the next 10 years. I think more bullish than a lot of people would say it's reasonable. I think Bitcoin's going to take over in within 10 years. But I'm actually bearish over the next 3 months. So we'll see how that plays out. Because I also think Bitcoin does this thing where it might just drop to 50K, and then everyone's like, oh, it's over. And then the next 11 months, it just shoots up to 300, 400K, you know, just straight up, and everyone's taken by surprise.
Yeah, I think definitely the only rule with Bitcoin is that you can't predict it, right? You know, I share your same long-term outlook, but I don't necessarily share the shorter-term outlook, which is why we've been, you know, adding what we can when we can. But the price is almost academic as well, because, you know, if we all believe that within 1 year, 2 years, 3 years, 5 years, you know, it's going to be way higher. It's about building that Bitcoin balance sheet. You know, what we have to do for ourselves, you know, whether we're a company or an individual, is accumulate that Bitcoin in the most effective way that we can. You know, because the one thing that's certain is that the future is not certain. Mm-hmm. So it's you know, I can't time things to any reasonable degree.
Yeah.
But what I can do is slowly increase the ownership over time.
Yeah, that makes sense. And I think that's why HODL is such an important meme, hold on for dear life, because we don't know exactly what's going to happen in the short term, but you have to hold on regardless of what Bitcoin price does in the short term.
100%. Well, we appreciate you being here, and let's give Rado a round of applause.
Thank you so much.
Well done.
You think that's good?
All right. I'm sure you're wondering why I'm on stage every other time. This is my last one. So I'm just going to do this by myself, I guess. Get your asses up here. All right. This one's going to be on social media lessons from Bitcoiners and what treasury companies can learn, what the Bitcoin industry can learn from social media and social media influencers, of which none of them are. No, they mostly are. You know, Bitcoiners learned something before the institutions did, which is that distribution is power. Bitcoin social media is not just marketing. It's about education. It's about the reputation of your company. It's about deal flow. It's about investor relations. It's recruiting people by the image you have on social media. And it's about defending your narrative as well, that you need to do that on social media. But the danger is just as real. Social media can reward hype and tribalism and overstatement and short-term price obsession. It's got this weird, screwy set of incentives that institutions aren't used to. So the question today is quite simple. What can Bitcoin treasury companies learn from Bitcoiners about building trust online without becoming noisy, reckless, or even, God forbid, cringe? Before we start, how many people check X once a day? Raise your hands. Okay. And LinkedIn? Less. TikTok? And pretty much all hands up, Truth Social, right? No Truth Social in this crowd. That's unusual. No, it's not. Okay. Fernando, you built the Bitcoin Libertarian as an independent media brand, Global's Perspective, Spanish language reach, and now English language reach as well, daily solo content production, some hard-earned lessons from platform risk and censorship. You've been shut down a few times. Let me start with you. What do Bitcoiners understand about media that companies still completely miss?
That's a good question. The Bitcoiners understand about media with the...
No, what do Bitcoiners understand about media and social media that the institutions and companies haven't figured out?
Yeah, I think that from social media what we learn is the power of creating communities, the power of the voice, of being in contact with your audience. I see many people here that they see my show. So I think that social media, I don't want to say influencers, but we can connect with the companies with especially straight with the people. We build trust, people trust us, people follow us, and we can send the people the message that companies want to send.
Okay. So Fernando gives us that independent creator view, moving fast, taking risks, own your audience, don't trust the platform. Jordan's built more of a community over the years and kind of an education machine. First question for you, who goes farther in the World Cup, Scotland or Argentina? Yeah, wrong answer. No, sorry.
You know what I would say, but yeah.
We're looking for a Scotland-Argentina final. Scotland-England final would be great. Okay, that's my last World Cup quip. The Bitcoin Collective, Bitcoin Business Network are built around education and community, bringing business owners into Bitcoin without drowning them in the jargon, the stuff that we even get cringy about ourselves. How do you talk about Bitcoin online without sounding like a cult or a trader or even like a techie?
I don't talk about Bitcoin. You don't start a Bitcoin. And this is how we talk to businesses as well, offline, is you start with the problem that they've got. And what Joe was talking about, the debasement. So you talk about the problems that they have, make them, or people online see what that problem is, and then Bitcoin becomes a lot more obvious. Rather than at the start of my Bitcoin journey, I was preaching Bitcoin, and as everyone does at the start, you just want to tell the world what this thing is. And then I soon realized this was not the best way of doing it. And I think Henry said you got labeled a little bit crazy and all of this. So it's more going down the route of, okay, what's the problem? So you'll see all my posts online now, a lot of them don't even mention Bitcoin. It's highlighting what that problem is in different ways, different angles of doing that. And then you will then see I'll do 1, maybe 2 posts a week around Bitcoin. So it's balancing the problem with what I believe is the solution and what I believe people need to get to. But you can't just throw it at them. It doesn't work.
Yeah, so translating Bitcoin for the business audience. Tim, you've been more at the confluence of Bitcoin and capital markets, right? And where that all collides in Bitcoin treasury companies. You built your personal brand, your media platform around these Bitcoin treasury companies before it became, mainstream capital markets story. And your interviews have become part of the information layer for executives, investors, analysts. You get approached by people on the streets everywhere you go. In the Bitcoin treasury world, is social media now part of investor relations?
Yeah, I think it's, I'm reminded of your first question. The word that came to mind was authenticity. The traditional media, they may mean well, they may be authentic, but it doesn't come across in that way. I think the independent media is really the only outlet shining a light on these new iterations of technology. Bitcoin's a technology. How much real education can you get from a 30-second or even a 6 or 9 minute spot with Saylor or Phong or Matt on CNBC? Lots of props to Pompliano, but he had to learn how to talk really fast and not get pissed off when people interrupt him. That's not a real interview. So I think it's just very naturally come out from the independent media because there's a real need and there's a real want. Why wouldn't you want a real conversation? When you have the CEO of Coinbase, I don't know if he actually took a drink of the beer, but it looked like they're at a restaurant in a booth. It's a little staged, but the more authentic without being, to your point, hyperbolic or, I'm a YouTuber, click on this now, sort of thing, I think really goes a long way, and just be yourself. People would ask me, were you nervous when you first started interviewing people? I was like, well, maybe I took a walk around the block the first time or two, but really it was like, I know what I look like, I know what I sound like, let's just do this. And I was also curious. So the first time I walked into Anthony's office and I said, this has a lot of views, what's going on? He's like, great content, great person that you're interviewing at the right time. He's like, that's how I started. I said, the crazy thing is, Anthony, most of these questions that I'm asking, I don't know the answers to. And he's like, yeah, that's how I started.
Yeah, it's that authenticity. For each of you, Bitcoiners are unusually good at memes, repetition, narrative warfare. What is one lesson Bitcoin treasury companies should steal from Bitcoin, Twitter, or X? And what's the one habit that they should absolutely not steal? Jordan?
So I think I would go down that authenticity route of it's so important for treasury companies to be out there and you'll see a lot of the CEOs here today being there, being online and being themselves rather than, because people can tell straight away if you're being fake and you're not being real, not being relatable. I think that's a real thing. Like, people want connections with people, and that's something that we do a lot at the Bitcoin Collective is like the whole team is on social media because people connect with people. So I would say the whole team should be out there in the community for these treasury companies. And the thing that they shouldn't take from Bitcoin, Twitter, it's a tricky one. I would just say like the toxicity of it all, because it can, in Bitcoin, I would say less so now, but it can be toxic, but I realize why it can be, because it's such an important thing and you want to get that message across. But there's tactics to doing it and strategy to communicating Bitcoin or Bitcoin treasuries to other people.
Kind of being cocky and snarky, but not arrogant, right? Do you guys want to add anything to that of what they should do?
Yeah, I want to add the authenticity, because I think that with social media especially in Twitter, you can send a straight message, even if there are good news or there are bad news, people take it good, the reaction of the people is good. So if you are authentic and you send a straight message, your audience will like it. And on the other side, what shouldn't do pick from the Bitcoin Twitter or whatever is all this hype that usually these accounts that try to engage, that probably, Bitcoin is going to 100K, and they put a picture of Sailor and the logo of Bitcoin, all this stuff, I think it's like misleading for the people. Another thing is educate, be straight and be simple words for the people. And I agree with them when they say we need to address the problem. We don't have to speak about Bitcoin, we need to speak about the problem and how Bitcoin is the solution of that problem.
So would you say it's okay to tweet something like, I'm dedicating my life to Bitcoin, I'm all in?
That's amazing. I do. I will start doing the same in Spanish. So every day. Sorry.
Espanol. I'm going to start posting it in Spanish.
Of course.
I think that's the next level. I'll throw something in. EQ versus IQ. Emotional quotient over intelligence quotient. Probably, I don't know. I say things over here and they're like, I've never heard of Pandora Radio. So I'm not going to assume that anyone knows anything that might differ in different parts of the world. But there's a saying, people don't care how much you know until they know how much you care. But after they know how much you care, you better know something. And I think there's several people in the community that, some people really are, and of course it probably took years and practice, but when you see them up on stage now, it's incredible. You have people like Michael Saylor and people like Joe Bryan and people like Stafford Massey that are very good at storytelling. And I know some panelists were talking about storytelling earlier. I think that's really the most effective way to get the education out there, and something that everyone kind of it takes a certain balance to get the information across, but in a way that you're not turning people off, or and maybe this is in private, but as Ben Workman says, maybe he hasn't said it publicly, is like, be somebody that people can root for. And if you can do that in a genuine, authentic way, I think that's a real value to the community.
Yeah, you can really tell which companies that maybe the CEO or somebody very close to the CEO is actually doing the post, and the ones where it's coming out of Hootsuite or something, some kind of engine, and the ones that are coming out of the engine, you're just like, yeah, that's not authentic, right? Along that same topic, and you may not have the answer to this one, I sure don't have the answer to this. Bitcoiners often say study Bitcoin, but the platforms reward the opposite, outrage and hot takes and people making certain statements, et cetera. How do you build an audience without becoming addicted to the incentives? Nobody?
There are accounts that have, whatever, I'll make up a number, 10 times the amount of followers that I have, but maybe they have a different goal in mind. So my goal is to be like committed to Bitcoin, I'm all in, but committed and consistent. And I think reaching the right people, and we really niched down. But there's ways to pivot. I mean, I don't want to talk about Pomp the whole time, but he was Bitcoin and now he's more macro. So there's ways to naturally kind of evolve over time. And if it's your deal, you can do whatever you want. And being an independent person really goes on the media side, goes right along with Bitcoin.
I would say that it's to my point before as well around the problem. So I started posting regularly only probably about 2 months ago. I properly thought about it and put a strategy in place. And posting around the problem, and you don't put the word Bitcoin in there, the algorithm loves it. Unfortunately, the word Bitcoin, when you talk about Bitcoin, it just doesn't get the same reach. So that's why I strategically will talk about the problem and gain loads of new followers, interest, impressions on X and LinkedIn are usually my main ones. And then I'll drop in a little bit about Bitcoin. And this is how I guess I kind of play the algorithm is I will talk around the problem, attract those people, okay, yeah, I understand that problem, and then I'll drop a little bit of Bitcoin in there. You get a lot of hate for it, with people that are just very anti-Bitcoin, but in my view, that's a good thing.
Yeah, and also I think that you need to understand the audience you are talking to, because as you were speaking, the people from Africa is not the same that the first world countries. So in my case, when I speak in Spanish, I try to address what they need, what problem they are having. In the Spanish Bitcoin community, all of the people talk about self-custody, sovereignty, privacy. When they don't understand that people are suffering for inflation, they will not have pensions. So I try to address this problem with Bitcoin as a lifesaver for the future, and that's how I connect with the people.
I have one final question, but before we do that, it's at Tim Kotzman, at the Bitcoin Libertarian.
The Bitcoin _.
The Bitcoin _, no
yes.
Libertarian.
No,
just the Bitcoin
THE Bitcoin _.
And yours is?
At JAYW132.
1, 2, 3.
If you put in Jordan Walker,
just look up Jordan Walker, you'll
up.
find him. Mine's E. Julene, but let's end with a question here. So we only have 10 seconds each, or however long you want to take. You get approached by either a small company that says they're going to do a Bitcoin strategy, or you get approached by Coca-Cola or whatever, and they say, hey, you're going to be our social media consultant here. What's the one thing you're going to say during that interview to lock that job in, to tell them, this is what you have to do if you want to have a successful social media strategy as a Bitcoin treasury company? Probably be authentic, but yeah.
Yeah, I think you need, I would say you need to constantly be out there messaging. I mean, I think there's a lot that goes into trading volume and liquidity, and I'm going to have some of those maybe spicy questions from Matt Cole this afternoon. But if you're not going to, look at what Michael has done for 5-6 years now, like one podcast a day, it's just that consistently having the message out there, it's a full-time job. If you don't have someone on your team that's going to own that, then I probably don't even want to talk to you anyways.
I would just say, firstly, make sure the internal education is up to scratch. And then I would highlight the storytelling. It's so important. You can scream and shout about it all you want, but it's how you communicate that message is so important.
Adding to what they said, understand the concept of proof of work, showing every day, speak every day, deliver the message, even though some days a lot of people is not watching to you, but deliver the message every day and understand proof of work and understand that Bitcoin will win.
Wonderful. Thank you very much, gentlemen.
Thank you.
Well, good afternoon. My name is Hunter Albright. I'm the Chief Revenue Officer at SALT. It's a pleasure to be here with you today. I'm joining from Colorado, but I did live in the UK for over 10 years. And when I lived in the Midlands, we decided to move to Wales, and I got a question, just why? From all my English friends. And, you know, I get that same question when I talk to people about putting Bitcoin on the balance sheet. And so today, I'm going to talk to you a little bit about what I'm really excited about in terms of Bitcoin as treasury companies and expand, hopefully, how you think about Bitcoin and treasury companies and what it really means. And I think it's important to think about Bitcoin on the balance sheet from operating companies, right? We think about McDonald's as an example as a company that is profitable from a fast food perspective, but really they're a real estate company. And I think that's going to become a model when we look in the future. We're going to have great operating companies that have Bitcoin on the balance sheet as an asset for strategic purposes. And we'll talk a little bit more about that today. You know, the big guys, I've worked in banking and financial services for nearly 30 years. And the big guys have all had a playbook in terms of being able to leverage their assets when they need money. When they need to hit payroll or they want to make a capital investment, they borrow against their assets and they have an investment banker on speed dial. Small and medium-sized businesses have never had that. They haven't had that advantage to be able to have access to capital that quickly and at a very effective cost. And I believe with Bitcoin that changes, that Bitcoin, more than just being something we can hold for future value, it becomes a tool. It becomes a tool that allows us to use the value that we create, that we store in assets intentionally and proactively to sort of manage our companies better. So SALT was founded in 2016. We've been lending for nearly a decade. And in 2017, one of our early customers was a miner. And back in that point, like a miner, you were unbanked. You didn't have a place to go get a bank account. In Colorado, you were in the same category as cannabis companies. Nobody would touch you with the 10-foot pole. And so you had to figure out how to be innovative. And one of the things that we did at SALT along that journey was build infrastructure to help people take advantage and tap into the value of the assets they had. And so one of our customers needed to make payroll 1 month and had a high energy bill, but had worked really hard for all the Bitcoin that they had accumulated and did not want to sell it. It was essentially thinking about why do I want to sell my future to pay for my present? I don't want to do that. So I want you to hold that thought, and I'll come back to it here in a bit. Now, I come to this from sort of nearly 3 decades in credit. I have run large credit card and lending portfolios globally. And worked significantly in sort of the payment systems. And so I've seen this playbook run from the inside for larger banks as well as for larger companies, and really excited about the potential that it has for businesses of all sizes going forward. And I pulled some data from the UK when we think about what is the struggles that small and medium-sized businesses faced, right? Because when you look at all the businesses that have failed, it's generally not about the idea. It's about access to capital. And so 82% of UK sort of small and medium-sized enterprises have said they have struggled with cash flow. That can be due to slow revenue months. It can be due to a timing, if you're a manufacturer, about when you get an order and you need to pay for your cost of goods, and then when you're going to get your revenue. And it could just be due to sort of accounts payable and it being really slow in terms of when the money comes in. And the compounding problem to that is that the 80% approval rate on business loans was pre-pandemic, And it's all the way down to 37% in the UK in terms of businesses that are being approved. So not only do you probably won't get access to it, right? You're having to go to a bank to sort of have a time delay. And Bitcoin as an asset class, I think one of the game changers is the speed at which you can get a loan against it. And what we're seeing, and I'll touch more about this, is how that market is changing rapidly in terms of the cost coming down and companies like Salt being able to provide you better services and more flexibility with how you want to use your assets, right? So those are assets you have accumulated store value in, and you want to figure out how do you make best strategic use of those to help your business grow and sustain. So if we go back to the miner, right, not wanting to compromise on the ownership of the Bitcoin, on the perceived future appreciation in terms of the belief of the asset class, they borrowed against it to make payroll, they borrowed against it to pay the power costs, while still preserving their ownership of the asset. One asset, two uses. Allowed them to sort of pay bills in the near term and be able to maintain exposure to the asset in the long term. Now, one thing that this requires is a bit of reframing, I think, of how all of us probably have thought about debt, right? Generally, debt is not talked about as being a positive tool, largely because debt, for the most part, has been unsecured. It has been a way, right? Unsecured credit is essentially money printing. It is a surrogate for adding more liquidity into the global macroeconomic system and encouraging people to buy and consume. And on that side of things, I think it is potentially harmful unless it's really well understood and people manage it well. Because you're basically borrowing from your future self, and you might get yourself in a hole that not only is a debt hole, but with our current system, it impacts your credit score. So it puts you in an even harder place in terms of getting access to capital. Now, on the unsecured side, that's a different game. Again, you have accumulated value in an asset. How do you tap into it? How do you use it? The ultra wealthy and large companies have been doing this for centuries to outpace us, take advantage of lower cost of capital, and create opportunities that they saw before anybody else did and could take advantage of it. And I think Bitcoin solves that. We know from a lender perspective, rates are coming down because we can demonstrate the quality of Bitcoin as an asset, how fast we can sell it, the value appreciation of it over a longer time period. And so as people start to understand more about it, I still find it amazing. I was having a conversation earlier that when I was at Barclays, we'd go around and say, hey, we've got a 6% loss rate, we've got an 8% loss rate on portfolios, and people would be jumping over themselves to give us capital to lend out. I go to somebody now and say, we have a 0% loss rate. We have over-collateralized loans with an average 50% LTV, and I can liquidate the collateral if I need to in under sort of 5 minutes. And they're hesitant to lend. Now, that's starting to change. Like the Treasury companies are doing a great job of helping educate people. We're seeing more asset-backed lending opportunities and investing opportunities, which is bringing more capital to the market. So I do expect to see both business rates and consumer rates to continue to drop as we go forward. And I think that's exciting because what we see is the number of companies that are in the space is continuing to grow rapidly. Right? We are seeing more public companies and a lot more private companies and conversations like this about how do more companies get in the space so they can understand about how do they use Bitcoin strategically on their balance sheet. And we're getting to the place where if you have a 200,000 pound balance sheet, you're going to have the same strategies, the same tactics that you can implement as a 2 billion pound balance sheet. Right? The same sats, the same power. And I think that's going to be really empowering for businesses of all sizes. And I think that is what really will create a lot of flexibility and resiliency in terms of people having assets where they don't have to go ask for permission to get liquidity. They can just get it. They can be proactive in terms of what you fund, when you fund it. You don't ever have to be a forced seller, and really create a lot more power and flexibility in the business owners who own the businesses that are driving the economy. So one thing I want to leave you with is like, it's your opportunity. It's our opportunity together in terms of to think about Bitcoin as a tool, as an asset class that really can help power businesses of all sizes. And I think it comes down to two parts. One is it's the education of understanding and starting to believe in the asset. And if you're there already, great, educate another business owner about how they might want to think about it and why they should consider it. And the second step is to do something about it, is to actually learn how to borrow against it at whatever amount you're comfortable with, because it is a tool that the largest companies, that the ultra-rich, the ultra-wealthy have been leveraging for centuries to be tax efficient and to be fast and to take advantage of opportunities and be more resilient in how they run their businesses. And so the one thing I would leave you with, if we go back to the miner borrowed against his Bitcoin to make payroll, to pay the power costs. 6 months down the road, after a little bit of appreciation, borrowed some more to buy more machines, and 12 months later had a business that was significantly larger than what he was at the point where he thought about selling Bitcoin to fund the near-term expenses. So I encourage you to think about how that might change how you run your business. We are in, as Asbin has outlined earlier, we're in a changing macroeconomic environment. We need all the tools that we can get. So I think Bitcoin does represent a disciplined way to be free, and I encourage you to play bravely. Thank you.
Great. Here we are talking about regulation here in the UK, which is actually a very important topic. And it's not going to be a boring panel. So my name is Stefania, and I already introduced myself. I just want to bring up something that happened a few years ago. Just after COVID, I started to do those events called crypto circles, where I was bringing together investors, policymakers, and founders in the Bitcoin crypto space. And I remember at the time handing the mic to my Hancock that was talking about how you wanted to make the UK the crypto hub and all these amazing speeches. Nothing happened. And we are still at the same situation today. So I'm going to start with this question, and anybody of you that wants to answer, please do. What are we missing? Why are we still here with all these amazing speeches from politicians, but nothing gets done?
Do you want to go, Lisa?
Yeah, well, I mean, hi, welcome everybody, and thank you for having me here. Lisa Cameron, Chair of the first House of Commons, Cryptocurrency and Digital Assets, APPG. Didn't start with a tech background, I have to tell you. The first psychologist to be elected to the House of Commons, and we all know that Parliament needs a psychologist, so I was there for some time. Yeah, what are we doing wrong? I think that's a good question. And actually, before coming up to this panel today, I had a look. Since the last election, Bitcoin has been mentioned only twice in the Hansard, which is the record of speeches in the House of Commons and House of Lords. twice in the House of Commons, not at all in the House of Lords in, almost 2 years. So what are we doing wrong? Well, we're not making a mark in the Parliament. So there are many events in Parliament. I know this because I go to them myself. But they happen to be in committee rooms in the back of a corridor somewhere, and nothing ever happens because it's never raised to the Chancellor. It's never raised in the form of a debate about Bitcoin in the Chamber or in Westminster Hall. And the 2 times that it was mentioned, recently linked with the King's speech, was about how to prevent people with Bitcoin having any influence in policy. So whatever we're doing, and the industry is doing, it's doing it in the Parliament somewhere behind closed doors, but not in the Chamber. And I think that's what has to happen. There has to be more of a presence. There has to be more education. There has to be more engagement across party with the members of Parliament. But it has to be engagement with an outcome. And that has to be more questions, more engagement. And when I was an MP, I said, what is the point of written questions? What's the point of the debates? What's the point? What happens when you are mentioned or your sector is mentioned? And this is why all the other sectors want to be mentioned so frequently. I mean, the BMA were always there as saying, can you mention the work we're doing, etc. The traditional finance industry is always doing the same thing. You want to be mentioned because it prioritises then the work you're doing and the sector in Parliament. And I think that's what's missing.
And Kwasi, I just want to hand the mic to you because let me just say, I just think on that point it's also important to have people that actually do the thing. And this is exactly what you have been doing. You have been part of politics, but you are actually doing the thing.
So I'd like to say, in commemoration, if that's the right word, or in honor of Matt Hancock, he was, in my 6 weeks as Chancellor of the Exchequer, he was the only MP who lobbied me on digital assets. So he did his bit, as it were. I think what Lisa says is very right, because all these other groups, if you're an MP, you're being lobbied all the time by all sorts of pressure groups. I mean, literally hundreds of these people. And what they do is they're very good at identifying backbenchers, because backbenchers have the bandwidth to do this. And the backbenchers ask questions, either on the chamber, oral questions, written questions. As a backbencher, I used to enjoy having Westminster Hall debates, because you essentially, you put in for a debate, and then you have an hour and a half to go back and forth with the minister to talk about the subject. There should be a Bitcoin debate. We should get an MP. And Lisa's quite right. The outcome is important, but the fact that you're being mentioned and talked about is hugely significant. And it's a good way to shine a spotlight on a question. And I had a couple of, the last backbench debate I did before I left, before I resigned, was on sudden death syndrome in children. And it's really, really sad, really, really profoundly tragic phenomenon. But by having the Westminster Hall debate, the groups that lobby in this area, this very tragic area, were extremely happy because it raises the profile of the subject, however tragic, whatever it might be. And I think in terms of the Bitcoin community, and I have said this to Freddie and others, we've got to try and raise the debate. Now, if you raise the debate, and I'm used to this, people love you or hate you. You're going to have people saying this is the worst thing on the planet, this is the devil's creation, but then you're going to have people also, weighing into support. But it's important you have the debate. The worst thing that can happen is just being completely ignored and forgotten about.
Yeah, so that's definitely a good point. Going back to regulation, it's not easy to regulate nascent assets. It's not easy to educate. Especially in the UK, we have an investor community that is very different than and also advisor community that is very different from the US. And I wanted to go back to this point to also for Lisa to share some of the work that she's doing. But maybe James, you can step in now from like an advisory kind of angle to explain First of all, the achievement that you have done in these last 12 months, for example, with the Smart Web, in educating the space, so regulators, investors, and then what are the challenges that perhaps how we can overcome. But let's talk also about the good work that has been done and not always on the negatives.
Yeah. Oh. You asking this James or that James?
Both James, yeah. Go. You will all have a different point anyway.
Good to be here. Yeah, so we are sponsor and financial advisor to Smarter Web, and we're the Aquis advisor before that. They've obviously demonstrated how companies can use UK financial markets to raise significant sums of capital in this area, and I think one of our strengths is the different markets we have. So the Aquis is obviously very flexible, and they were able to raise a lot of capital there and mature as a business, and then come now to the main market, which obviously has size thresholds and higher standards of corporate governance, etc. But clearly have demonstrated that it's possible, and there is access to our substantial capital markets there. I think as has been talked a lot about today, it's largely an education piece. I think the advisory community in general are not all Bitcoin believers, let's say, but the understanding is growing. And I've seen recently the broking community wanting to understand this because they want to know if their institutions come to them in 6-12 months' time and say why didn't you tell us about these treasury companies and explain it to us. They're not going to be very happy. So I think that's, the capital follows return and yield. And so, we need the early movers in this space to be success stories and to do things the right way. And, that brings the capital and brings the sort of institutional pressure, as it were. And then, from the regulatory perspective, regulators are by nature risk off, which is probably rightly so. But I think there's, the tide is changing, and I think there's also the sort of global competitiveness angle, which is increasingly topical. So I think it's moving in the right direction in that respect, but it needs all stakeholders to be pushing in the right direction. And yeah, I think the recent regulations that manage wallet services, etc., that provides a framework for utilization and broader access, which obviously supports the whole space. So, it's still relatively nascent in the public markets space, but if you look at the last 18 months, there's now 14 odd treasury companies on the market, and so things are moving in the right direction, and the advisory community is getting up to speed, as it were, on understanding the space generally.
And I think the point, if we go back about regulation, being a publicly listed company is not an easy thing. You have got lots of compliance, there are lots of regulation, and you really need to do things properly to be listed on public markets. So the other James, so from your experience, obviously working with public listed Bitcoin treasury companies, how we are doing now? I know there is a lot of work that still has to be done, but is the regulation going in the right direction to allow this company to grow, not just to get on capital market, because you have fundraisings, you need to grow the company, right?
Yeah. Thank you for the question. I should have known that you weren't going to be asking a lawyer to talk about the good things and the good news story. Perhaps slightly unexpectedly, I'm not a fan of regulation. And I think the market only works, and a nascent market only works, if it's allowed the freedom to grow. The current proposals for regulations, they are what they are, but fundamentally, the whole space took off just over a year ago, because we didn't seek permission. There was the moment in time where we thought, well, do we go down the fully classically FCA regulated route, or do we go down a route that works but doesn't, it's only regulated as a public company. And in the UK, as James has said, the regulator, for understandable reasons, is very reticent to be positive towards Bitcoin. And you're left with sort of, do you want to be King Canute sitting by the waves, or do you want to say, well, actually, no, the tide is coming in, and debates in Parliament are all very well and good, and awareness is all very well and good, but if you ask somebody, can you do it, they're going to say no. If you start talking about it, it'll be 10 years and nothing will ever actually happen, and in the meantime, currency is being debased and value is eroding, and so you need to just get on and do something. And the regulatory environment here is such that we are able to operate, how can I put it, outside, completely legally, but outside of the regulatory perimeter. There are some things that we just can't do, and that is as it is. But it's quite clear that there is appetite for it. And then you build up a head of steam. I mean, look at this room today. Look at this event today. You know, this is, in many ways, to my mind, this is sort of Andrew's Field of Dreams moment. You know, if you build it, they will come, right? Yeah. And we're all here, and this is really exciting. And it's lovely to see so many friendly faces and friends and clients and colleagues and friends and clients and colleagues that I've yet to meet. But you know, there is a buzz about this space which you don't get when it's overly regulated or subject to a heavy amount of regulation. And what we need to be given the space to get on and do what we can. Within that, public companies, there is a degree of oversight. It's good governance. Generally, it's common sense. We're getting there. Yes, there does need to be a shared lexicon when companies are talking about Bitcoin per share or yield or MNAV or whatever these terms are. There does need, I think, for the sense of the market to operate, they all need to be talking about the same thing. So we're talking apples and apples, not apples and oranges. But beyond that, you know, let's play around a bit. Let's be a bit brave, and let's see what works and see what doesn't work.
Yeah, that's a really good point. I thought the standard. Yeah, no.
First time I've ever been clapped. I'm going to tell the missus that. She won't believe it.
Sam, I want you to come in here because you have been working with companies for a long time. You sat on the board of one Bitcoin treasury company. So from the inside, obviously Bitcoin treasury or Bitcoin companies has got a big task, which is education. And there are challenges that you are overcoming, like James said. Share some of the insight and the work that you have been doing in advocating for the space and also the achievement that have been made.
Thank you. So I'll give a brief intro because that will then position what I'm then going to say. So I'm a director at Cartwright. So we, in the context of today, we help companies and other institutions to implement their strategy on their balance sheet. So what does that mean in practice? It means, how do you buy Bitcoin? Where do you buy it? How do you custody it safely? What are your internal controls and governance procedures? What is your reporting? What's your, what could happen if things go wrong? So we spend a lot of time identifying risks and mitigating those risks and thinking about practicalities. So I guess that's hopefully gives some context to what I'm going to say. So I'm going to try and position that as a metaphor for where we are right now. So I think historically, and maybe still at the current moment, from a general point of view, but I'm thinking obviously particularly institutions, the regulators have been talking about how we could get into that car to make our journey, but it will probably crash and it'll probably be a write-off. So be very careful about what you're doing. Whereas from next year, hopefully, and onwards, that will evolve into, we're going to make sure that there's not too many potholes on the road. The roads are relatively operational. You choose your car and you choose where you want to go in that car. And to me, that seems a lot more sensible because the people who should be thinking about the risks of Bitcoin and how it applies to them are those people in those companies, and the approach taken for each of those companies is going to be different. They will have different risks, and they need to apply all the things I mentioned, which we sort of think of as the back office of these companies, in their own way. So that also includes, by the way, some companies not buying Bitcoin, and we should lay out all the options. So that's where we've been helping, and that's where I think we're seeing improvements in the market infrastructure. But actually, to try and answer your question, is there anything missing? And no, I don't think there is right now. Companies can, as is demonstrated by various people on the stage or in the audience or elsewhere, it is possible to add Bitcoin to a balance sheet right now. So nothing is missing. However, it needs to be done with obviously extreme care. I'll pause there.
Can we talk about banking?
Sure.
Kwasi, maybe.
It's a short conversation.
Well, what's the question? I mean, look, there have been so many different things said. I mean, if you've got a question about banking specifically,
yes, because
what
I
is
think
the question?
it's still a problem. Banking is a big problem for, in general, if you have any crypto assets. So
Definitely.
obviously, as a Bitcoin, as a publicly listed Bitcoin treasury company, you want to see the banking is not a problem for the credibility of the space.
There were so many different things I wanted to pick up on before I answer your question directly. Firstly, what James said is absolutely right. The fact that we're here, thanks to Smarter Web and Andrew Webley's work, is extraordinary. I mean, I left Parliament in July 2024. This industry didn't exist in Britain when I left Parliament, and that was less than 2 years ago. So the fact that we're here with hundreds of people, 100 people, is remarkable. So we got to give a big tick and get behind that. The second thing that James said is that debates in Parliament, whatever. But ignorance is a very dangerous thing in public policy. And what you don't want is a world in which regulators, ministers, whoever they might be, know nothing about Bitcoin, and then suddenly think, oh my God, that's scary, let's legislate and let's protect people against it. And that's why you need to have the debates before the ignorance creeps in and people react reactively against it. So it's a kind of prophylactic in a way, if I could put it that way. The second thing I would say relating to banking is part of the general conversation, links into what I was saying about debates, openness, what is this thing? A lot of bankers, a lot of institutions are terrified in the UK about Bitcoin. They don't understand it, they think it's scary. One of my old colleagues, my old boss, wrote an article, I won't say who it is, but we all know, he wrote an article in the Daily Mail saying Bitcoin was going to go to zero. Now, he knows nothing about Bitcoin, absolutely zero. He held a lot of power and influence in this country, if I can put it that way, and that's scary when someone like that writes an article. I'm not going to say who it is, we know the article. So I think in terms of banking, it's got to be part of the wider culture. You've got to have bankers, you've got to have people in the mainstream TradFi, as we call it, who are fluent or comfortable with this idea. And that's where the United States is infinitely ahead, frankly, of where we are. And I want to close that gap.
Yeah. But obviously the UK and US are very different. So can we copy the US, or maybe there is a different discussion where obviously there are things that we can learn perhaps from the US, and you, Elisa, you have done lots of work with understanding what the US is doing, talking to different influential people there. What can we learn from the US?
Yeah, absolutely, and Kwasi's totally right. And I think if you do check the Hansard, the sentiment currently in the House of Commons is negative towards the industry. The two comments that have been made have been about how do we clamp down on this industry having any influence in the Parliament. So you're starting from kind of like a negative in a sense. We need to have much more education, information. We need that to translate into debates. The industry needs it to be questions at Prime Minister's questions and to the Chancellor. In order to do that, we have been learning a lot from what's happened in the US. We've had delegations across to the DC summit of members of the House of Lords, House of Commons, and we've brought Senate Banking Committee over to the Parliament, the CFTC. Were in town last week speaking to the MPs. We're learning a lot. The thing that's kind of switched the dial there, I think, has been the increase in knowledge and understanding. And I know from speaking to the folks at the Bitcoin Policy Institute that they spent a lot of time and effort creating internships in Senate and in Congress so that there could be points of expertise within the parliamentary system in the US. When debates were coming up, when questions were coming up, there were people to go to. The members of the parliament in the US, they had resources that they could have from Bitcoin Policy Institute to do research for them, to come up with what was happening at the forefront of the sector. I think that's missing in the UK Parliament just now. It's something I think, collectively as a sector we should be working towards in that sense. And I think it would make a huge difference because not only does that expertise come back to the industry when the interns have finished their placement, but also the expertise remains within the Parliament and the connections are there for life as well. That's what other industries do very regularly, is they have policy interns in Parliament. So I think that's a concrete thing we could be doing. At the UK-US Crypto Alliance, the next thing we're going to be doing is working on that initiative, but also we're going to bring American Bitcoin over to Parliament to speak about what's happening in the US and why the sector has really taken off there and what it means, not so much if we do get on board the car that you're talking about, but what happens if the UK doesn't. I'm concerned the UK is left behind. And, we need to do everything possible to make sure that the UK has a leadership position in the new world of digital finance, which is here to stay.
Especially if we look ahead at 2028, we are trying, to make sure that there are changes implemented in the next government to make sure that this industry can flourish.
Steffi, can I just come in on the banking question? I don't think British banks are particularly keen on Bitcoin because I don't think they feel they need Bitcoin. I think British banks are making decisions based on their own profitability, and they can continue to be traditional finance houses and make bleep loads of money, and it's not worth the risk, and it's not worth anybody losing their job, and that's to do with the way they are plugged into the system, and also partly it's cultural, and there is entrepreneurialism hard-coded into the US, massive generalization accepted, which just isn't really here in the UK. But let's not lose sight of the fact we are in a price slump at the moment with Bitcoin. When Bitcoin starts moving up, whether it's 3 months or more, depending, whether Andrew or Radu are right or neither of them, then there is a sizable market here, and it will reach the point where banks are missing something by not joining the party, and then they're going to have to join the party, because the only thing that is going to change banks' minds, as I see it, cynic that I am, is whether they can make money off it. And right now, the banks, for whatever reasons, I don't think that they can make money off it. And it's as simple as that. And that's why they debank all these lovely Bitcoin companies, even the PLCs. And that's one of the most common questions that I get. And there are banks that are beginning to look at it, but not seriously enough and not quickly enough.
There are always ways that you can make money. It's just you need to do it properly and within the regulation. Now, the UK has quite some Bitcoin. I think it's over 60,000 Bitcoin. And it will be really interesting to see what is going to be done with those Bitcoin. Are they going to be liquidated, or what the discussion should be around? What should the UK do with these assets?
So my view, this was held in the Treasury. I think it's the Chancellor of the Exchequer who decides. My view is that they won't do anything, because you remember when Gordon Brown sold half our gold reserves in '99, and I think it was at $284. Look at the gold price now. And I think, even though they don't say this publicly, I think the Treasury, the officials, are pretty scarred by that. And if they were to sell it, it would be very much on the sly, in the sense that Gordon Brown announced that he was going to do the deal, and the price he got was very low. They would probably do it without much fanfare, frankly, over maybe a year or two, and sell it gradually. But I don't think it's not going to be watch this space. I don't think they'll be very public about how they deal with this stock.
I think that's probably what will happen. But what I think should happen is I think they should sell it all. And any asset is a problem if it's held by people who don't really understand it, and I think we've established even just today that it's not generally understood, and should be held, if at all, by people, institutions, companies that do understand the asset and can manage the risks around it.
Yeah, but I think like also for the all-party parliamentary groups that are in existence, if there were one that focused on Bitcoin, say a Bitcoin APPG, you could be doing an inquiry report in the Parliament and making recommendations to the Minister about what should be happening and taking a forefront position on it.
Hopefully they will do something intelligent. All right, we just ran out of time. Thank you so much for all my panelists. And yeah, just stay around, ask any question. Thank you so much.
That was very good.
So I hope everyone's sort of had a bit of a break and enjoyed the morning so far. So next up, we've got Lance from TD Cowen joining us live, remotely. This is going to be about institutional research in the Bitcoin Treasury space. So I'm not sure whether any of you have been able to access the research that TD Cowen have done on Bitcoin Treasury companies in the wider digital asset space. We were delighted that they picked the Smarter Web company as one of a number of different companies to cover from an individual stock perspective. And so I wanted to spend some time with Lance, asking him a couple of questions. So can you hear me, Lance? Yeah, you're on mute, Lance. I think we can see you. Yeah,
Sorry about that. Yes, I can hear you fine. Can you hear me now?
Yeah, all good. So we've got
Great.
connection. That's the first thing. So, well, thank you for taking the time to join us. Would you be able to tell us a bit about TD Cowen and the overall company, and then after that we can get on to your interest in the space?
Sure. So first off, thank you very much for having me. It's great to see you again. I've been looking forward to this conversation all week, and let me just say how impressive the agenda you put together for this unconference is. So TD Cowen is part of TD Securities. We focus on equity research, trading, and capital markets globally. We are historically strong in US equities, but we've built out a meaningful London presence as well, supporting clients trading UK listed and international stocks. And increasingly, our work sits at the intersection of public equities and digital assets as those worlds start to converge. As for me, I've been on this platform here since 2010, covering a variety of tech, media, telecom sectors. I had previously been a TMT-focused investment banker and began my career working as a macroeconomist focused on fiscal and monetary policy. My Bitcoin journey began in the fall of 2022 when my boss asked me to take a look at a little company then known as MicroStrategy. And at the time, I actually knew nothing about Bitcoin, but that didn't stop me from being highly skeptical. It was all contempt prior to investigation, and as part of my diligence, I wound up reading The Bitcoin Standard by Safety and Amos, and it was at that moment that the scales fell away from my eyes. You know, once you really see Bitcoin, you can't unsee it. Am I right?
You are right, 100%. So obviously you speak to lots of different institutional investors, and if we think about the different metrics that you and I talk about sometimes, what's your perspective of the understanding of the Bitcoin metrics that we all think about in the wider context of those that, if we're blunt, may not even care that much about Bitcoin at the moment?
Well, sure. So, I mean, look, from my standpoint, Bitcoin yield serves as the cornerstone of our valuation framework. Bitcoin yield is, of course, the pace at which Bitcoin per fully diluted share changes over a given period of time or by virtue of one or more specific transactions. All else equal, investors should want to own the companies that will grow Bitcoin holdings on a per share basis the fastest. That is to say, they will report the highest Bitcoin yield. The premium to underlying Bitcoin holdings at which a company trades, some call that MNAV, that should largely be a function of expected Bitcoin yield over time. So a company that is expected to generate a 30% Bitcoin yield over the next 4 years should trade at a considerably higher premium to its underlying Bitcoin value than a company that's only expected to generate a 10% Bitcoin yield over the next 4 years. Of course, all else equal. Now, forecasting future Bitcoin yield isn't for the faint of heart, but we think investors can get a beat on that by considering historical Bitcoin yield along with current leverage ratios, capital market conditions, and so forth. And look, the bottom line is, so long as Bitcoin continues to outperform most other asset classes, I think there's going to be a range of positive outcomes for the various public Bitcoin treasury companies, or PBTCs as I like to call them. But all well-run PBTCs should materially outperform spot Bitcoin or spot ETFs, because a well-run PBTC will employ leverage and potentially accretive stock issuance at a premium to NAV in order to grow that Bitcoin per share. And I like to put it this way, and I can't emphasize this point enough. If you buy one Bitcoin today and you hold it for 20 years, in 20 years, you've got exactly one Bitcoin. If you buy one Bitcoin via an ETF, in 20 years, you'll have something like 0.95 Bitcoin because the fees that accumulate are generally paid for by selling Bitcoin. Whether the investor wants to do that or not, that's what's going to happen. Those fees, by the way, they may not amount to much in any given year, but the impact, of course, is compounded over time. And my view, at least, is that anyone interested in Bitcoin is almost by definition concerned with longer rather than shorter timeframes, right? If you want to store value for a week or a month or even a year, go ahead and use the dollar or the pound or whatever. It's those of us that are looking to retain our wealth over generational timeframes that are most drawn to Bitcoin. In any case, the fact of the matter is this: if you buy Bitcoin through an ETF, you are contractually guaranteed to own less Bitcoin per share over time. Now let's compare that to a well-run PBTC. If your shares in a PBTC today represent one Bitcoin, in 20 years, those same shares may represent 5 or even 10 Bitcoins per share. So 1 Bitcoin, 0.95 Bitcoin, or 5 to 10 Bitcoins. Why on earth should these assets trade at the same price?
Well, I completely agree with that. And in our presentation, we also talk about that quite a lot. If that was a question, why on earth should they trade at that? Then I haven't got the answer, Lance, I'm afraid. So go on. I was going to say, so when you initiated coverage of the Smarter Web company, we were in a cohort that was with a number of other US companies, one of which wasn't a Bitcoin treasury, it was a DAT. What's interesting about the UK, and I'm obviously not, as much as it would be nice if you did, I'm not fishing for a compliment here, but why did you pick a tiny company from the UK? Why the UK alongside the US? What's interesting about that in the DAT space?
So let me start. I'm going to take a step back. I am going to answer your question, but let me start by just saying that by the time I launched coverage on MicroStrategy, this was now in the summer of 2023, it was clear to me that if the world were starting with a clean sheet of paper, we'd all be better off on a Bitcoin standard. But we're not starting with a clean sheet of paper. We're starting with a world of dollar hegemony. And let's face it, right? There are powerful forces that would love nothing more than to kill Bitcoin in the cradle, so to speak. No one voluntarily gives up the power of the printing press. No one voluntarily surrenders their status as global reserve currency. So in 2023, despite its profound fundamental advantages, I viewed Bitcoin as something of a long shot. Now, what's changed, and where I'm going with this is I'm trying to set the stage for why we published the big report last month in the first place, and then I'll get into sort of why we included Smarter Web in that. But over the past 3 years, I have been amazed at the pace of Bitcoin's global adoption. And here in the US, what's happened not only under the Trump administration, but significantly when the Democratic Party was in the White House. And I'm referring specifically to FASB changing accounting standards to enable public companies to more easily hold Bitcoin on their balance sheets. The SEC under Chairman Gensler, no less, no friend of crypto, essentially blessing retail investment into Bitcoin via ETFs. And then, of course, it all accelerated under Trump, too. In my opinion, Bitcoin's final success is still far from assured, but its future has never looked brighter. And meanwhile, while my conviction level has grown, institutional investors have begun increasingly to at least take notice. We're still very early in the process. If this were an American audience, I'd say we're in the first inning. I don't know what the British analog is, but in any case, the publication that we put out, Digital Gold, Digital Picks and Shovels, that was published this past April 9th. This was our attempt to tell the institutional investment community, this is happening. It's no longer something they can ignore. Publishing our big piece last month was our way of saying game on. So we launched with this first wave of companies. I expect more to follow. And as you mentioned, that first wave included the Smarter Web company. I tried to be very thoughtful about which PBTCs we included in that launch. And I think that regional primacy is a key differentiator. I think being the largest PBTC in the UK by far matters a lot. When we think about cost of capital advantages, when we think about potential consolidation opportunities, when we think about advocacy, it's pretty clear to us just that, just as Bitcoin itself enjoys a network effect, we think the leading regional players will have that too. And the last thing I would say is, if you're bullish on Bitcoin, focusing on smaller players that have demonstrated scale benefits without having plateaued on their eventual growth curves is important. Given its size, MicroStrategy, or strategy as we know it today, isn't likely to see the kind of explosive growth that we could see from smaller peers like Strive or the Smarter Web Company. If you're bullish on Bitcoin, I believe there's a sweet spot in terms of big enough, but not too big. And these are the companies that we most want to put in front of investors.
Thank you. That makes a lot of sense to me. And also, I really like Strive as well. It's a great company, and Matt Cole will be joining us later today. So I've just got two more questions for you, if I may, Lance. The first one is not necessarily for us at Smarter Web, but us as an industry, the CEOs of the different companies. If you could give us one or two things that you think we could do better to improve the adoption amongst institutions and grow our businesses at the same time. If you had to give us one or two bits of advice, what would that be?
Well, look, so really it depends on what kind of Bitcoin treasury strategy you're talking about, right? I mean, the simplest strategy is to merely include Bitcoin as a treasury asset on the balance sheet. And this strategy may actually appeal to corporations that generate good cash flow but aren't growing much. Their options today are either accumulate cash, which is proven to be a poor store of value, invest in risky business projects, which may or may not pan out, or distribute cash back to shareholders via dividends or share repurchases. None of these options are great. Instituting a dividend can come back to haunt you. If you have to cut the dividend, you're likely to see a shareholder revolt. Share repurchases, I've seen this can cause a death spiral by further limiting volume and thus interest in a stock that may not have much interest to begin with. Not good if your company isn't growing. So storing surplus value in Bitcoin, on the other hand, doesn't create any of these problems. While we expect Bitcoin will over time become an effective store of value, in the near term, adopting Bitcoin as a treasury asset creates an immediate uptick in volatility, which means more volume and more interest in the stock. So the challenge here is that it takes time to educate oneself, one's employees, one's board of directors, one's customers, vendors, investors. Adopting Bitcoin even as a treasury asset should not be done capriciously. Those of us who have already bought into Bitcoin have to remember, before any of us were believers, each of us were skeptics. Resist the temptation to try to steamroll your skeptical critics. Approach the skeptics with patience and trust. Understand they too want what's best for your company. Engage the skeptics in a dialogue. Encourage them to do their homework as you have done yours. Now, if you're talking about a company that's already become a full-blown PBTC, it gets harder from there, right? They have to do all the heavy lifting I just mentioned regarding adopting Bitcoin as a treasury asset, and that's just table stakes. How does one gain or enhance access to the capital markets? The key to the capital markets is differentiation. As a would-be PBTC, you need to ask yourself, what's my edge? What's my angle? What sets me apart from the Smarter Web or Strive or SharpLink or Strategy? How can I convince investors, even those that believe in the model, that I'll be able to effectively manage treasury operations such that I can grow Bitcoin per share without taking on an imprudent amount of risk? I think these are legitimate questions that are tougher to answer adequately today versus a year ago. In terms of what investors want to see and what would help, you have to sort of think about it in two groups. There's the investors that already get the PBTC model, and then there are those that don't. So let's focus first on the guys that already get it. They want to see demonstrated access to the capital markets and an ability to access the markets creatively and effectively. They want to see a management team that is committed and unlikely to fold up shop during the first Bitcoin or the next Bitcoin downturn. And perhaps most of all, they want to see more than just a DAT. They want to see synergies with legacy operations beyond operating a Bitcoin treasury. For example, your ability to leverage web design and the cash flow that business generates. For MicroStrategy, it's business intelligence software. For some others, it's asset management or trading strategies. And while it hasn't proven out yet, I think an ability to generate not just Bitcoin yield as we know it, but a true return on one's holdings, a yield on one's holdings, that could ultimately become a key differentiator. SharpLink, for example, can cover its operating costs entirely from the revenue it generates staking its Ether. Now, we don't necessarily want to see them using their Ether in this way, and I know this is a Bitcoin conference, but all else equal, investors like the protection that that affords.
Yeah, no, I agree, and that's why today, we've been showcasing the recent acquisition that we made, Squarebird. So they're here today. If any of you have got a business or want to find out a bit more about them, please go and speak to them afterwards. And also that's why I so like the strategy that Strategy have invented of the perpetual preferred equities, right? Rather than putting the Bitcoin at risk to generate a yield off that Bitcoin by trusting someone else with it, they've created or reinvented an equity instrument that can effectively create that yield through the arbitrage between the price you pay and the potential returns that you get. So, we said right from the start, Lance, in our 10-year plan, we said, we're going to grow our operating business organically and through acquisitions, and we're going to grow our balance sheet. And we've always said that we're growing that balance sheet for a purpose. So, it's quite an exciting time. We're running a bit short on time, and obviously I am truly grateful that you've taken the time to join us today. But just for the last minute, obviously I've read it in the research, but could you share your 12-month outlook for Bitcoin, if that's possible?
It is possible, although people say the easiest way to look foolish is to predict the price of Bitcoin. But then again, I've never worried about looking foolish. So our published estimate is 140,000 US dollars at December, at the end of this year. For what it's worth, we're at 85K for June 30. So last couple of days aside, we feel like we're tracking in line. And look, it'll be interesting to watch.
Yeah, so that's a pretty good point to leave it. 100% from here. Thanks, Lance.
Take care.
Hello. Everyone hear me all right? I assure you this is water, not Guinness. Thank you very much, Andrew, for inviting me to come and speak at this. I wanted to talk to you about two things I've ever done in my career, traditional wealth management, then I went down the Bitcoin rabbit hole, and I think a lot of the time Bitcoiners hate the wealth management financial advisory industry, and the financial advisory industry hate Bitcoin. But really, they can work together. And I think the more this asset class evolves and the more we have financial products and in companies like Andrew's that can then bridge the gap, the better off people will generally be. So today I wanted to just do a quick, 12 minutes specifically, probably the most riveting 12 of your life. Just talk about how Bitcoin can now start getting into wealth management, and everyday financial planning can then benefit from Bitcoin or Bitcoin products. So, important notice, this is absolutely definitely not investment advice, but, it's probably what I do. So the first thing you've got to think about is what is wealth? And a lot of people have got different opinions on this. Some people, think about it as money. Some people think it's freedom, time. And that's the really important thing. If you're looking at traditional wealth management, like what are you actually trying to create? So that's an important thing for me to establish first. So some people want financial independence. Some people call it time. Choice is, for me, choice is really, really important. Like I will do what I want to do when I want to do it, and I won't be told by anybody else. So that's personally for me. Again, freedom's similar to that. This is an interesting one. Recently, if you don't know who George Boyd is a friend of mine. He was a footballer. And we just launched a podcast a little while back called Bitcoin and the Long Game, talking about how sports people can take the earnings of a really, really big earning window and make that last forever because their careers are really short. And I said to him, like, what do you even do now? Because he's retired. Obviously, he had a good agent, saved enough money to live for the rest of his life. And he just said time is wealth now. So he takes his kids to school, he plays paddle. And for him, time is more important than money. So this is the important bit. We need to establish what are we actually looking for, what are we trying to do with our wealth, and therefore can we then create a plan around it. So if you want to sit and watch the Bitcoin markets all day, I generally don't like bank holidays because there's a day of trading you can't be sat watching, especially when the markets are going well. Like George was saying, take your kids to school every day, sitting on the beach with no obligations, building the next thing because you want to, not because you have to. And it's whatever you want it to be. So if you want to build a financial plan, you kind of need to know where are we going with this. Then, how do we manage it? So what is management of that wealth? So I think that this Robert Kiyosaki, if you don't know who he is, he wrote Rich Dad, Poor Dad. This quote is great. It's not about how much money you make, but it's how much you keep, how hard it works for you, and how many generations you keep it for. And for me, that really encapsulates what are people generally trying to do with their wealth. So I would generally start with, what do you want your life to look like? So what do you want to do? When do you want to stop working? What do you want to leave behind? What brings you joy? And then you go and start wrapping a financial plan around that. Because if you don't know those things, it's like getting in a car and just driving without knowing where you're going. So protect, grow, structure, use, and plan for your wealth is generally what people want to do. And so how do we go and do that? Well, I think that there's 3 distinct periods where you need different pots of money. Look at this masterclass in animations. So there we have the working years. So generally your income increases over time, and there's a big fat bubble in the middle of it, which used to we'd call the expense bubble, which is kids and mortgages, but now it's just like plain inflation just ruining everybody's capacity to spend and earn. And you'll see that your income generally will increase over time. You'll get to the end line, and that's your retirement line. And then you want to think about, right, how do we structure our assets to give us a retirement? And then once we're unfortunately not retired anymore because we died, what do we then do with our money after that? So if you're in retirement, like Andrew, they're probably chilling out with a pina colada down Western Supermare, you want to enjoy retirement. So that's the next phase we can talk about. And then the worst thing is the dreaded Grim Reaper, Rachel Reeves, comes along and wants to just take all your assets after you've died. So what can we do to help ourselves with Bitcoin in our sort of toolkit? Now, these are the 5 phases. And I think there's 3 pots of money you need in your working years. And we'll work out what we can do with those and how Bitcoin can help them. So pot number 1, always you need an emergency fund in case the shit hits the fan. Like it could be a boiler break, car break, lose your job, whatever. How can then Bitcoin, because traditionally you would just say, well, just leave it in cash or cash ISA. You're probably going to wave goodbye to returns. You're not going to make any money on it, but it's going to be there. But what we can look at now is how can Bitcoin change that? And there's been a big emergence recently with digital credit. So if you can park your emergency fund but still get, 10, 11, 12% return on it, well, that's an unbelievable difference because Bitcoin is now in the back pocket. You could then, even if you had a big stack of Bitcoin, you could then borrow against your Bitcoin. Obviously, you've got to look at, can we afford the repayments? Is it going to erode it? That needs to be a consideration based on, your actual income surplus. But there's so many things now that Bitcoin can do that you couldn't have done previously just by having, cash in a crap account somewhere. Medium-term pot. This is supplement, that big bubble of expenses, stuff that you probably, might not need access to, but if you needed it, it needs to be there. So typically, people would have had a stocks and shares ISA, premium bonds, whatever you wanted, but you could get the money. It wasn't locked away for the longer term, and you could get access to it. So now Bitcoin enhances that in, loads of ways. You could actually just hold Bitcoin Treasury stocks, Bitcoin ETPs. Use an ISA for tax efficiency to just grow Bitcoin tax-free, which is obviously better than, taxed Bitcoin. And this is to really make sure that you're building a nest egg. And if you don't use it for, getting rinsed by inflation in the peak spending years, it can then eventually form part of your long-term pot of how do I stop working one day. Then, again, long-term pot, direct Bitcoin, obviously, self-custody on exchange, whatever you're comfortable with. Exchange-traded products as previous. And again, obviously, Bitcoin treasury companies is varying opinions now on, a SIP was great for tax efficiency, but now is going to get trapped inside the inheritance tax, death loop. But you need to make sure that you've structured it like you maybe would have done before, but how can we increase what we're doing with Bitcoin? And what I think Bitcoin can do for these things is it goes back to the previous slide of, what do we want? Do we want time? Do we want choice? Do we want freedom? And you could eventually get all those things, but I think with Bitcoin in there, you can get them either sooner or your income can be bigger. And you can have Bitcoin as a standard tool within all these, useful vehicles that were already there, just without having Bitcoin access to. And they can just give you more of the things that you want in life that are, time with your kids, holidays, whatever it may be. Retirement pot. So now we could look at our Bitcoin holdings. You could lend against that. A lot of people never want to sell their Bitcoin until Saylor sells his Bitcoin. But if you never want to sell the Bitcoin, but you want to then monetize it, you can then always lend against your Bitcoin because you want to hold it and leave it for your children. Again, private credit or digital credit, you could then park it in Stretch and have an 11% income, for the rest of your life if they hold it at that. Or you could then just draw down your funds from, your Bitcoin treasury company stocks in your SIP or whatever it would be. And then the last thing you want to then think about is how do we then leave what we've got and give it to where we actually want to go to? Because in the UK, inheritance tax is absolutely appalling here, in my opinion. So you can leave £325,000 to anybody with no tax. If you leave your house, it can go up to £500,000. But above and beyond that is 40% inheritance tax. Now, just to put that into perspective, in America, I think you need to leave $13 million before any inheritance tax kicks in. So I was chatting last night with Ed. I don't know if Ed's in the room, and I was talking about this. And he was like, "What's the point in growing wealth if it's just going to be taken when you die?" So there needs to be incentives for people to actually grow their wealth and build it because they can leave it on to their children. This particular government aren't looking very friendly to that. So the last year or so, I've been working on another business, which I was hoping would be live by now, but typically the traditional banking world doesn't want anything to go quickly in Bitcoin. But there needs to be more ways in which we could do IHT mitigation for Bitcoin once you get to it, because Bitcoin is such a growth asset that what I see from my traditional wealth management hat is that just becomes a big tax problem if you don't plan for it properly. So I've been working on a company called Bitcoin Life, which I can't really talk to you about too much about, unfortunately, yet. But if you want to find out a bit more, come and grab me afterwards. But we're looking at how can we then allow for people to leave Bitcoin to who they want to leave it to without inheritance tax just taking 40% of it. But all in all, we're coming towards the end a little bit. But if you want to then try and put Bitcoin and traditional wealth management together, I think this is a reasonable foundation to then start basing your stuff on, because typically before you would have had a plan of action if you had a financial advisor or in wealth management, but now that market can't really work with Bitcoin particularly well, because under our regulatory framework, financial advisors can't really monetize Bitcoin. So what they don't really want you doing is putting all your money into Bitcoin in somewhere where they can't try and look after it and take their ongoing advice charge. So what all these things need to do is trying to start harmoniously working together to allow you to have the tax-efficient vehicles that we used to have anyway, but now start accepting Bitcoin into it. And well done for people like Andrew and Bitcoin treasury companies that have broken into this market. And I think one of the things Andrew regularly says is about he wanted to have something in his ISA that was a UK product, not just MicroStrategy. And that was one of the drivers for him to actually launch the Smarter Web Company as a Bitcoin treasury play, but with an operating business. And I think that's such an important thing. It's great to have, an American product within, like strategy, but we need our own homegrown products like what the, Smarter Web has done. And that then fits into the traditional estate planning, financial planning models that we already have, that are already familiar. And you can then start integrating Bitcoin into your standard plan, but then get it to be enhanced. So this can either then bring your, let's say we held Bitcoin in our SIP. Instead of, a standard, we used to look at 5, 7, and 9% returns as illustrative returns. If you're looking at Bitcoin's, compound annual growth rate, it absolutely demolishes all of that. So that either means that your retirement date comes earlier or your income in retirement goes up. So, either way, you're better off. So combining Bitcoin and wealth management is, a big passion of mine. I started working in the city the day Lehman Brothers crashed in 2008 in traditional wealth management, and then went down the Bitcoin rabbit hole, a few years back. And so I think we're going to make it an absolute mission to try and bring Bitcoin into the traditional wealth management space, because most people generally know it. Most people are comfortable with it. And if you can start getting advisors who, advise people to put Bitcoin in these sorts of products, then everybody makes more money in the end. The advisors want to make money, they want to charge you on it. But if Bitcoin can enhance your assets under management, then they'll probably make more money anyway. So that's pretty much where we are. Regardless of how you hold it, it's a great idea to get some Bitcoin. I don't think we need to preach to this room. Bitcoin going forward is going to be a major protection against the, I find inflation and money printing is just an absolute crime somebody in the future needs to then, investigate and take to prison whoever thinks it's a good idea to do that. But yeah, it might make sense to get some just in case, but hold it strategically, hold it for a plan, make sure you know where you're going with it. So if you've got a plan of action, make sure Bitcoin enhances it, and then hopefully you'll have more time to spend with your kids, go to the beach with Andrew in Weston-super-Mare, and just live your life. But anyway, thank you very much, and I hope you enjoy the rest of your day.
Good afternoon again. So this is the last big stint that you hear from me today. You'll all be pleased to hear. So we've got a few important investment notes. This deck actually isn't on our website yet, but they're the same notes that we always use if you want to go and read them. So, the Smarter Web Company. We are an operating business with a Bitcoin treasury, and we are trying to grow our balance sheet for the purpose of our shareholders. So, today we own a little bit under 3,000 Bitcoin. We've added 19 this week, and we intend to keep growing this balance sheet through a combination of the operating business and increasing our Bitcoin over the coming years. And we believe that if we can keep executing, we will get into the FTSE 250 and then the FTSE 100, and then maybe a bit bigger from there. So before I move on from this, it's just important that everyone understands how everything links together here. And I wanted to zone in on Squarebird there, because we acquired Squarebird earlier this year, a profitable web design agency that's grown over the last, approximately 10 years. And we did that by using approximately 1% of our balance sheets to increase our revenue significantly. That's really important because obviously I focus on Bitcoin per share all of the time. It's the most important metric in the world to me. But we need to use our balance sheet in a number of ways, and that's one of the ways that we do it. So there's a couple of things that I'm pretty proud of, and you can see some of these listed here. But whilst the last 13 months has been good, the future's far more important. And I want us to be a leading company in the global Bitcoin treasury space. And as Peter was saying a moment ago, I think it's important that we get UK companies that are global success stories. And of course, what's the point of all of this? Well, the point is it's done for the benefit of the shareholders. I hope that many of you will see that every decision I've made today has been about the shareholders, and it's fantastic to see so many of you here today. So we'll keep this next bit quite brief. I don't think it needs too much explanation, as most of you will believe in the potential that Bitcoin offers. But it's worth saying that to different people, Bitcoin does mean different things. But this is a Bitcoin Treasuries conference. And so in the context of a Bitcoin treasury company, the bottom line is it's by far the best capital to build a corporate balance sheet, full stop. So, as Jesse talked to you about earlier today, Bitcoin is still just 0.2% of the global asset value, which is quite mind-boggling, really. And what I find even more alarming is that in this year so far, M2 has increased significantly as well. And I don't know whether many of you will be aware that a lot of that increase in the M2 money supply has come from China. So it's not even a government that we elected, or many of you may even support. We can't control it. Our governments can't control it. So, money supply globally is something that other countries can have a significant impact on. So, we've all talked recently about the impact of the war in Iran and that on markets and so forth. But, money supply is arguably worse, in my opinion. And even with this, some people still can't see the values of Bitcoin. And before we move on, Jesse did a great job earlier of explaining our UK asset landscape, which is available on our website. But it is worth remembering that even though we, like most companies, countries have got problems, we're still, we think, the third best capital market globally. So the pure equity Bitcoin treasury model. So I think how we've implemented the model to date, we've shown everyone that it can be quite powerful in terms of Bitcoin per share growth with certain market conditions present. And we've increased our Bitcoin per share by approximately 60 times over the last year. I'm not aware of many companies that have increased their profits by 60 times over a year. I would imagine that's quite difficult when you get to a certain size. This year to date, in a much tougher market, we've increased our Bitcoin per share by, let's call it 15%. So that's still not bad going. So what that's enabled us to do, as I talked earlier, is to grow our operating business, and we've done things like entering the FTSE All-Share, which means more liquidity, more eyes, more acceptance, on our path towards getting to the FTSE 250. The thing that I'd like to say, though, is that whilst it's good what we've done to date, relying on sentiment for a premium or certain results that you may or may not be able to achieve is not really good enough. You need a very, very clear way to demonstrate to investors that they should be prepared to pay a premium for continuous Bitcoin per share growth. And as we do with everything, we are very transparent, and the reality is if you're buying a public company as opposed to, say, buying Bitcoin for self-custody, then that public company's got costs. So a public company has to outperform Bitcoin, right? So earlier this year we started to add some responsible leverage to our balance sheet. Coinbase have kindly sponsored the event today, and we've announced the facility that we've got with them. We're doing it in a very cautious way, and I think it's a massive opportunity for us to increase the size of our Bitcoin balance sheet. As some of the topics have been today, in very simple terms, that allows you to add fiat liabilities. Bitcoin goes up, fiat liabilities stay the same. The value of that increased Bitcoin just goes to the ordinary shareholders. And many of you will be familiar with what strategy have pioneered. So if you look on the slide, you can see that, in our opinion, there seems to be a correlation between the premium to NAV and the amplification ratio. Our amplification ratio today from leverage is approximately 13%. So in my opinion, again, what strategy pioneered and then Strive have adopted is probably the most significant development in Bitcoin treasury capital strategies ever. And maybe it's even the most significant revolution in capital markets, So I believe that amplification of a balance sheet for the benefit of ordinary shareholders is pretty important, without saying anything that I shouldn't, of course. So where does this leave us then? So in our opinion, we're well on the way to becoming amplified Bitcoin for the UK, and that means using our balance sheet to expand our operating business, as you've seen from what we've done today with the acquisition of Squarebird, and in the future, I hope you'll see more of these things, but they'll only be the right deals at the right time. That's important because, you know, lots of people talk about this phrase, capital flywheel, which is a phrase that I'm not that keen on. But for us, the capital, the balance sheet flywheel, or whatever we'll end up calling it, is all about the business and the capital markets and taking everything that we offer together. So not everyone will agree with this, but this is my take on things. I think that if we can add leverage and we can grow our Bitcoin per share, we can outperform Bitcoin. You know, Jesse, our head of Bitcoin strategy, has modeled this. And we think that if you've got 10% increase in Bitcoin per share, 10% increase in leverage, 29% increase in Bitcoin, that would double us against Bitcoin over the next 5 years. You know, but our benchmark is Bitcoin, and Bitcoin's going to outperform everything else. So if we can absolutely smash Bitcoin, then, you know, in my opinion, that's a good place to be. So, you know, obviously, why would somebody want to own, you know, a company like Smarter Web, you know, if they weren't paying attention to the last slide and also shared my beliefs on the assumptions? Well, obviously, we're doing something different in the UK. You know, we've done something that everyone told me we couldn't do, and it's worked out so far for the company. And I'm very, very proud of this industry that we're helping to sort of develop. But you know, the reality is that, you know, a Bitcoin treasury company is arguably the best opportunity that you can find in capital markets for the foreseeable future, if you believe the assumptions that I've outlined there. So finally, I just wanted to briefly say where I see Smarter Web going. But rather than just my opinion, which, you know, I give to people when they're prepared to listen to it, how we're actually going to get there. Because, you know, I can say we want to do something, but, you know, it's more important how we're going to do it, you know. And I hope that everyone's seen that what we've said so far, we've delivered. You know, we've taken that very, very seriously with transparency and, you know, an element of speed. So, you know, if we say we're going to do something, we'll most likely do it. So I believe that we can get to the FTSE 250 in the not too distant future. You know, for balance, we do need Bitcoin to help us out on that one. It's approximately a 3x from here. And then after that, I will be setting my sights on the FTSE 100, and then we'll take it from there. How we're going to do that is through these items that we've listed there for you. The solid tick is what we've done. The dotted ticks are what we're working on, and then, you know, we'll tackle the rest of the list thereafter. Obviously, different things will be done in different times. Some are continuous. And we're going to do that by executing. You know, I think what we've done over the last, you know, 13 months or whatever it is we've executed reasonably well, and, you know, we'll continue to do that. And I think we've got a great team of people in place to do that for the benefit of our shareholders. And then, because I think that I'm running short on time, I will just say thank you for listening and enjoy the rest of the afternoon.
Everybody, does it work? Yes. Perfect. Hello, everyone. Thank you all for being here today, and big congrats to the Smarter Web company, to Andrew, Jesse, Laura, all the team. I am incredibly grateful to have been invited to share our perspectives on the European market. And it is really very friendly and nice and constructive and collaborative competition that we have with the Smarter Web company. And I think the most important aspect is that we've been collaborating since the beginning. And the Smarter Web winning is capital B winning, and capital B winning is the Smarter Web winning. And a very concrete example of this is that whenever the Smarter Web will do a capital raise that's successful, a lot of investors will want probably to do that as well. The reverse is true, and in fact we have joint shareholders, including Tobam here with us today, and UTXO management, and many more. And would like really to thank you all, because we also have a lot of shareholders in our two companies, and I'm really very happy to be here with you today. So, as you may know, Capital B has been Europe's first and largest Bitcoin treasury company. We are actually the third in the world after Strategy and MetaPlanet. And then the smarter web came in, and it was really a great year of 2025. A few disclaimers as well that you can read at your discretion on cptlb.com, and important information about all that we publish. It's capital markets, risk factors. Please, of course, take that into consideration. It will be quite a concentrated presentation. The slides didn't almost get through with the size of the presentation. But I will go a bit fast, but if you want to get into more details, it will be on the website very soon. So we've been characterized by being the most liquid, most institutional, the fastest growing Bitcoin company over in Europe, and very significant performance last year as well. One of the most performing and sometimes best performing company over in 2025 in Europe, in France, the most liquid Bitcoin treasury company over and on Euronext growth, 300 million euros raised to date, 1,600+% of BTC yield from November and December 2024, where we had 40 Bitcoin, and now we are at 3,135 Bitcoin. And I'm really honored to building this with you together on this journey. That is made possible by a team of Bitcoin maximalists, a team of Bitcoin capital markets experts, the strength of our shareholder base, of our strategic investors, Adam Back, the only person mentioned in the Bitcoin white paper, Yves Chefati, the president founder of Tobam, Tobam itself, of course, with Yves and Axel here in the room, Blockstream Capital Partners, the largest Bitcoin venture capital fund in the world, before with Fulgur Ventures, and UTXO Management, the investment arm of Nakamoto, that I'm sure Nakamoto will also have a great success over in the future, as they are really at the frontier of innovation of Bitcoin capital markets, and we are really honored to have our strategic investors with us on the journey together with you. That represents 3 to 5 million euros of volume per day, more than 30,000 shareholders all across the world, 100 countries represented, 50+ institutions, France, Europe, outside of France, the US. We are a global company, the 4th largest Bitcoin treasury company shareholder community in the world, hand in hand with the smarter web as well, of course, and 20+ indices. That's quite a specificity. We've benefited from the fact that we've been listed since 2011. And in fact, the company was already wired into a lot of institutional flows. And then the company got restructured. We launched the Bitcoin Treasury Company strategy. And now we are amplifying European institutional flows. Tobam, of course, La Française, Bitwise, Franklin Templeton, and many more. 14+ funds, 20+ indices. And that's only the public available data. We have also passive investment flows, some of the largest in Europe, and the largest, in fact, in Europe for Bitcoin, with Tobam funds, with the life insurance, and with Bitwise for the Bitcoin Standard Corporation ETF, where we have a 7% allocation with the Bitcoin treasury companies. But all of that is made possible by Bitcoin. We are Bitcoin maximalists. We work for Bitcoin. We serve Bitcoin. And our role is to contribute to Bitcoin adoption overall. And with an equity, with credit instruments that can provide value in capital markets and even outperform an asset that is outperforming everything else. It is important to zoom out. Bitcoin is completely outperforming everything else if you look at the right time horizon. A capital investor is looking at a 10-year investment, and at a 10-year investment, Bitcoin is up 18,000%. And the Max 7 digital intelligence is 800%. Digital capital is where all of the profits are stored. All of the profits from the AI wave are going to be stored. All of the money printing is ultimately going into Bitcoin. And Bitcoin is going by 20x over 8 years, and the bottoms keep going higher and higher. $200, $3,000, $15,000, and now $60,000. And we are just getting started. Bitcoin, in fact, is heading to the capitalization of gold. And 100K invested back in May 2020 yielded 250K in dollars for gold and 700K in Bitcoin. And this is in the bear market we are right now after minus 50%. So Bitcoin is just the best long-term store of value. And in fact, the period where we found ourselves in is a major asymmetrical opportunity. I've never seen such a level of asymmetric information in my whole life. I'm young still, but in Bitcoin, with the Bitcoin capital markets adoption and with the growth of digital credit, almost nobody knows about STRC, about SATA, about digital credit, and about the potential companies like Smarter Web, like Capital B, to deploy that into major capital markets in the world. Publicly listed companies, in fact, are the best Bitcoin accumulation machines, and this trend is growing by the day. You see news that Bitcoin treasury companies, some would have sold Bitcoin or some would be slowing down, and I see posts of very well-known people in Bitcoin that Bitcoin treasury companies are dead, or that I heard earlier this morning that supposedly small Bitcoin treasury companies will be mostly dead. No, I'm sorry, I completely disagree. If someone has a very small portfolio and invests all in Bitcoin, it will not be dead in 10 years. And it will be the same for a small Bitcoin treasury company that adopts Bitcoin today. It will not be dead. It's based on Bitcoin. Unless you are bearish Bitcoin, I can understand. But if you are bull Bitcoin, I don't think it's really appropriate to think that a Bitcoin treasury company will be dead in 10 years, unless it uses inappropriately, of course, leverage and so on. But holding Bitcoin is the winning strategy with a small company, with a medium-sized company, with a large company. And of course, there are advantages to being the largest Bitcoin treasury company in a specific region. Strategy and Strive have shown the success of digital credit over in the US, and I'm sure Smarter Web, Capital B, MetaPlanet will show that future potential in their respective markets. In fact, when you look at the respective performances since the launch of each respective strategy, Bitcoin treasury companies that are focused on digital credit are the best performing companies out there. And Smarter Web is also outperforming. We need to add that on the chart. But I think it's like 2,000% and 500% or even more. And I think that's aligned with what you see here. And that's the story of companies being able to multiply by 100x and more their Bitcoin holdings in a market where Bitcoin is flat. And if in the market of Bitcoin flat, you are able to accumulate 3,000 Bitcoin, if in the bear market we were able to accumulate 700 Bitcoin, I think that shows that there is something that's working, there is something interesting, there is some curiosity that could be important. And I'm glad to be with you today because here the room is full of curiosity, is full of forward-looking. And actually I had a talk earlier before, an interview, and I think the most striking thing is in this room, everybody is relaxed. Everybody is long-term oriented. Everybody is looking at the future, and that is allowed by and powered by the Bitcoin network, allowing people to focus on the long-term potential of their financial performance and of their sovereignty ultimately. And digital credit is also doing that for the 99% of the population that cannot handle the volatility, but is interested to have the best risk-adjusted returns. And this is today STRC, SATA, and potentially in the future, the potential products that other companies could issue in their respective regions. Strategy for each dollar of dividends has $60 of Bitcoin reserves. And this is just the most over-collateralized type of perpetual obligation in the market. And this is completely transforming how capital market assess performance, assess risk, and this is going to eat the world. When you see Jesse's slide on the market potential of Bitcoin and Bitcoin treasury companies, this is going to eat the whole slide. And this is the most important thing that I think is the asymmetric information today. I have 10 seconds, maybe 2 minutes more, but we'll keep that in 30 seconds. With that context, Capital B is completely focused on maximizing the number of Bitcoin per share. And the best way to maximize the number of Bitcoin per fully diluted share is to deploy the strategy playbook at European scale for us. And the best way for that is to deploy perpetual digital credit over in Europe and for the world. And that is our full focus. We are laser eyes focused on maximizing BTC yield for the future for our shareholders on a Bitcoin standard with the power of digital credit. Thank you so much all.
All right, how's everybody doing? We are running a few minutes early, so we're going to have Phong Le, the President and CEO of Strategy, joining us here in just a few moments. And yeah, we're going to cover the topic of digital credit, the iPhone moment. So would invite you to just sit tight, and we will be with you in just a matter of moments. Thank you. right, we're back. We are joined by Phong Le, the President and CEO of Strategy. Phong, thanks for joining us today.
Thanks for having me, everybody.
So the topic today is digital credit, the iPhone moment. And I do have some questions for you, but I'll give you the floor to walk through digital capital, equity, and credit.
Thanks, Tim. Thanks, everybody. It's wonderful to be able to join you all virtually, and I'm excited to share with you the latest innovation in the Bitcoin space, which is digital credit. If you have not heard about digital credit, it's the fastest growing Bitcoin-backed asset class this year. Stretch and SATA have really pioneered it, and I want to give you a perspective of why we did this and why it's important. And so this presentation focuses on sort of three components. It's digital capital, digital equity, and credit. And so I'll start with the baseline. Many people say, what is Bitcoin? We say Bitcoin is digital capital. And if you think about traditional capital, you have stocks, bonds, real estate, gold. Those are, in the case of gold, capital from the last 5,000 years, stocks and bonds from the last 500 years. And Bitcoin is the digital transformation of that. And sometimes people ask, well, you know, what happens with Bitcoin? What's the inherent value? Well, the value is it is the digital transformation of capital, just like Netflix is the digital transformation of entertainment. Apple was at a point in time the digital transformation of music. Google is the digital transformation of information. And so when we talk about digital capital, there are a couple of, when we started down this path in 2020, there are a couple of existential threats. I'll call them headwinds that have turned into tailwinds in the last couple of years. Existential threat number one to Bitcoin was, is it going to be regulated out? Under the administration, previous administration and Gary Gensler, it was very possible that Bitcoin was not going to be something that was accepted in the US, and as a result, perhaps in the EU or the UK or all around the world. And now we have the four most important regulators that have to do with the financial markets: the Treasury Secretary Scott Bessent, the SEC Chair Paul Atkins, the new Fed Chair Kevin Warsh, and the head of the CFTC Michael Selig. And I've met with all of them. They all love Bitcoin. And that's what's important. That's what's changed in the last couple of years. Behind that, we have one bill that's passed, the Genius Act, another bill that may pass, the Clarity Act. Regardless of whether the Clarity Act passes, what's important is it's already paved the way for rulemaking within the SEC that will be positive towards Bitcoin, positive towards tokenization, which I'll talk about later, and positive towards stablecoin legislation. The second biggest existential threat was, are the banks going to fight us tooth and nail? And once the regulators in the US came on board, the banks very quickly followed. There are major activities, with example, Citibank, where they will launch banking's Bitcoin custody and exchange services this year. Morgan Stanley's done so with E-Trade. They're going to have their own native custody service, hopefully launched this year. And other banks will follow. And you're seeing more and more news, not just with banks in the US, but overseas with UBS and Societe Generale as an example, but many others who are now also announcing major activities within the Bitcoin area. And we're starting to create an index that shows what is happening, but you can see everyone has embraced Bitcoin. So the two biggest existential threats of digital capital and Bitcoin becoming a reality have come around to our side, and now they're actually tailwinds. ETFs have embraced Bitcoin. We know the IBIT ETF that was launched in 2024 is the largest ETF in the world and the fastest growing ETF in the world, and the most profitable one for BlackRock. And more companies are embracing Bitcoin each year. We have more and more treasury companies like Smarter Web as an example, and we're up to 194 publicly traded companies with Bitcoin on their balance sheet, $1.2 million. Strategy represents about 65% of that. So that's digital capital. Well, what do you do with digital capital? Well, you can build a company based on it, and that's digital equity, right? When we did this in 2020, MSTR was a proxy to get access to Bitcoin, right? People all around the world who couldn't buy and hold Bitcoin or didn't have a mandate that allowed them to do it decided, I'm going to buy MSTR instead. And that's what's led to who we are today. We're 844,000 Bitcoin, a market cap of $54 billion. I'll talk about Stretch. We've raised $10.5 billion. This year alone, we've raised $13.8 billion of capital for people who want to put their money into a company that goes and buys Bitcoin. And we've bought Bitcoin every single quarter since we started. And what's interesting is when we got to 2024, people were like, wow, you have 250,000 Bitcoin, right? That's about 1%, 1.5% of all the Bitcoin that's ever been in existence. Can you continue to scale? Like, are you at this massive 250,000 holding of Bitcoin? Are you sort of at your limit of your ability to raise capital? And in fact, we've shown our ability to accelerate the capital that we raised and the Bitcoin that we've added, and we've tripled that in the course of not even 2 years. We're at 840,000 Bitcoin, 4% of the Bitcoin that's ever going to be in existence. And so initially when we started this in 2020, people were like, hey, so you guys are a Bitcoin proxy in a public market, and so if I want to access Bitcoin, I can buy MSTR, and it's a little bit easier because it's traded on the NASDAQ. And we said, no, that's not just our goal is to be a Bitcoin proxy. Our goal is to outperform Bitcoin. And the question is, have we done that since we started this in August 10th of 2020? You can see we have. In fact, we've outperformed Bitcoin about 50%. Bitcoin's up 37%, we're up 55%. And people are all worried, you know, Bitcoin is now priced at 73,000 or whatever it is, or we in some other Bitcoin bear market. Lest we forget, in the last 6 years, Bitcoin has still outperformed the Mag 7, which has outperformed the S&P 500, which is about similar performance to gold. Like, the most interesting thing on this slide are three things. One, in the last 6 years, the S&P 500 and gold have had the same exact performance. Two, Bitcoin has outperformed both of those asset classes by 2.5 times, and we have outperformed Bitcoin by about 50%, even in a Bitcoin bear market. Imagine what these numbers look like in October of last year. How do we do this? How do we outperform Bitcoin consistently? We do it because we add Bitcoin per share. That's our biggest, most important KPI, is when you buy a share of Bitcoin at the beginning of the year, right? If you buy one Bitcoin's worth of IBIT, call it $75,000 at the beginning of the year, I guarantee you at the end of the year, if you do nothing else, you'll have one Bitcoin's worth of IBIT. If you buy one Bitcoin's worth of MSTR at the end of the year, you will have more Bitcoin at the end of the year. We are giving you more Bitcoin per share. That's our KPI, and you'll have an example here. You know, in May of 2025, you had 181 Satoshi per share. That's 1 millionth of a Bitcoin, 181,000. In 1 year, we increased that to 220,000. And that growth is Bitcoin yield, right? And so BTC yield is, in the Bitcoin treasury world, the equivalent to revenue growth, if you will, in a traditional company's world. And BTC dollar gain is basically earnings per share, right? So these are the KPIs that we run the company with: Bitcoin per share, Bitcoin yield, Bitcoin gain, and Bitcoin dollar gain. And so how have we done? If you believe that Bitcoin per share, and all of our shareholders do, this is the most important metric, right? The most important KPI. Well, depending on the year, we've done either extraordinarily well or reasonably well. Right. The first year that we entered into this venture in 2021, the first full year, we increased Bitcoin per share 47%. In a bear market in 22, 1.8%. Right. Coming out of the bear market in 23, 7.3%. In a bull market in 24, 74.3% Bitcoin per share growth. Last year, we did 22.8%, very respectable. If you think about a company, can you grow revenues 22% a year? It's effectively what we did. And this year to date, we're already ahead of last year's pace. And we have accelerated this year. And the question is, well, how did we accelerate Bitcoin per share growth? Look at what we did in March, look at what we did in April, and look at what we're doing in May. And that's, of course, the answer is digital credit, which I'll talk about more. For perspective of the scale of strategy, just so everybody understands, you know, there are many other Bitcoin treasury companies out there, very respectable ones. And by the way, I believe every country should have its own #1 Bitcoin treasury company, right? Which is why I think Smarter Web has a great opportunity in the UK. And here in the US, we're the largest, and we are the largest issuer of equity, period. You know, AI companies, healthcare companies, retail companies, whatever they are, IPOs of new companies. In 2025, we were the largest equity issuer in the US, right? And we issued $23.2 billion. This year to date, we're again the largest issuer of equity in the US, $13.7 billion. We're 10% of the entire equity capital markets. And some of you might be thinking, okay, how long is this going to last for? Because SpaceX is going to IPO next month and they're going to raise $80 billion and they'll be #1. Yeah, they'll probably be #1. Can we catch them this year? It'd be difficult, but it's not out of the question, right? And so keep in mind, all of this equity is going into strategy, which is going into Bitcoin, right? So this is a vehicle for us to get all of the people interested in Bitcoin to find a way to invest in it and get amplified Bitcoin. And this is what I mean by amplified Bitcoin. We structure and we securitize Bitcoin. So those who are in the room, you already know Bitcoin's had an annual return of 37%, right, over the last year, and the volatility of since 2020, and a volatility of 28%, right? It's a roller coaster ride, right? And all of you know it because you own Bitcoin. And when I go to cocktail parties and tell people, you know, about Bitcoin, and they're like, yeah, I want it. And I'm like, do you have the stomach for a 40% return, 30% vol? And they're like, maybe. And then if you really want a roller coaster ride, like we were saying, look, you know, the analogy we've been using recently is Bitcoin is like a fighter jet. Well, MSTR is like a rocket ship, right? The return is 55%, but we step up the volatility to 65%, right? And so we're securitizing Bitcoin with higher returns, higher vol. That's what MSTR is. But I know that there are many people who don't want to be in a fighter jet and certainly don't want to be sitting in a rocket ship. They want to be in a passenger plane, right? They want the step down volatility. And that's what we've engineered with digital credit is we found a way to take the volatility from 28% with Bitcoin down to 18 to 10 to 5 to 4, while still giving the asymmetric risk returns that Bitcoin has. And so the yield in stretch is 11.5%. So we've structured and securitized Bitcoin, and we financially engineered volatility and yield. Why are we important for Bitcoin? There are about 100 million people who are beneficiaries of MSTR. 1,400 institutions, 927,000 retail accounts, 1,300 ETFs and funds, the NASDAQ 100. So people who are passively putting money into the NASDAQ 100 are putting money into MicroStrategy, now Strategy, which are putting money into Bitcoin. So let's talk about digital credit. Bitcoin was built off of a unique combination of multiple innovations, right? So when Bitcoin came out in 2008, Satoshi Nakamoto took some amazing, extraordinary innovations, proof of work technology, public-private key cryptography, peer-to-peer networking, distributed timestamping, and the first time put them all together in a unique monetary asset called Bitcoin. And what made Bitcoin successful is that unique combination of emerging and established technologies. Stretch is the same. Digital credit is the same thing. We have taken a unique combination of items and put them together into what we call digital credit. We first took a listed digital equity, MSTR, listed digital capital, Bitcoin, right? And so I've talked about digital capital, digital equity. And we took the concept of a preferred equity, which already existed. We made it perpetual. We called it Stretch. We put it as a 4-letter ticker on the NASDAQ, just like MSTR is a 4-letter ticker on the NASDAQ. We moved from a monthly fixed dividend, where the price fluctuates, to a monthly variable dividend, where the price stays flat. Right? We discovered that people, who want access to asymmetric risk return of Bitcoins, but they want stability. What they really want is they want price stability, right? And so we target a price of $100, right? And then on top of that, we discovered a very favorable tax treatment, return of capital, because we don't sell the underlying asset Bitcoin. We hold it for the most part, right? We don't realize capital gains. We defer those taxes, and we can do the same to those who hold Stretch. And then we have an actively managed ATM program on top. So those 6 things existed previously, but they're unique innovations put all together. And what do we solve by doing that? We solve the biggest dilemma that most investors have, right? You hear about the 60-40 equity stock bond portfolio. Well, the reason people split it between the two is they want to have both. The equity investors want double-digit returns. They want the tax efficiency of if you don't sell the underlying equity, you don't get taxed on it. But they don't get low volatility. The stock goes crazy usually. And they don't get capital preservation, meaning if you put in $100, that might be worth $50 in a month, or it might be worth $150 in a month. What do your bond investors, what do your credit investors want? They don't get the returns, they don't get the tax efficiency, because whatever interest or whatever dividend you get gets taxed right away. They do get lower volatility, and they get capital preservation. A money market's the best example. Stretch gives you all of these things. There's been a lot of talk about where else can I get these things. So private credit's discussed often. Hedge funds are another way for people to get this. Private equity is another way for people to typically get these types of this type of profile. But what's the issue? Issue number one is we're liquid. You can buy in and out, sell in and out every single day. I'll show you some of the liquidity metrics. Those are not illiquid. You have lockups that go from 90 days to 3 to 7 years for private credit to 7 to 10 years sometimes for private equity. Very difficult to get interim liquidity and sell out. Maybe it's 5% a quarter or something like that if you're lucky. We charge no fee. They charge a high fee, the 2 and 20. We're homogeneous. You know exactly what's behind Stretch. It's Bitcoin. They're heterogeneous. You rarely know what's behind them, and it could be a bucket of 100 different assets. We're scalable. We can raise capital every single day because we're on the NASDAQ with an ATM. They're discrete. They do raising rounds every 1 year, every 4 years, whatever it is. We're accessible, and this is an important one. Because we're traded on the NASDAQ, you can buy us on Robinhood. You can buy Stretch and Digital Credit on Charles Schwab, Fidelity, whatever it is, anywhere you can buy an equity. These are typically limited to people who are high net worth, working with private wealth, Morgan Stanley, UBS, whatever it is. These are the instruments for the rich. If you don't have a lot of money, you can't buy into them. We're transparent. We show you on our website exactly what's in there. The holdings of some of these typically, in some cases, are not transparent at all. So we think we've engineered something better. And as a result, it's for everybody. Right? Retail investors are buying into digital credit, digital money, crypto native are hybrid and equity investors who are typically buying preferreds right now. And I'll share what some of those look like. Corporate treasuries, institutional credit investors. This isn't new, the idea of a preferred stock. We have just transformed it. Preferred capital was the primary way of raising capital in the late 1800s to early 1900s. Railroads were built on preferred stock. 20 to 40% of the money they raised came from preferred. The railroads laid the groundwork, the rails for the Industrial Revolution. We think the transformation of preferred stock into digital credit is going to lay the groundwork for the digital revolution. So financially, how should you think about this? I mentioned Bitcoin, digital capital, 30% ARR. right? We have basically engineered a product that takes the volatility away and the excess return away down to 11.5%. That goes down to the digital credit, STRC. And the excess returns between the 30% and 11.5% and the excess volatility goes into the digital equity, right? So digital equity absorbs that return, absorbs the volatility. Digital credit dampens everything. How might someone think about this, right? Like, and there are people who do this. I wouldn't recommend it for everybody, but what if you wanted 100% exposure to Bitcoin? Well, you could put a portion of that money into buying Bitcoin, and you buy it and you hold it forever, right? This is the one that you pass to your kids and your grandkids. That's what Bitcoin is for, right? You might, for the short-term returns, call it 1 to 5 years, buy MSTR, and that's where you make wealth for yourself. And at some point you sell MSTR, you go buy a house, you go buy a boat, whatever it is, right? And then your really short duration money, 1 to 2 year money, right? The stuff that you don't want to fluctuate because you want to pay for your kids' tuition or whatever it is, you put that into stretch. Right? So that's just an example of how someone might think about the different use cases for STR, for digital credit versus equity versus capital. I want to explain the return of capital tax treatment because it's an important one and it's a very unique one that is associated with digital capital. First, at a conceptual level, why are we able to make this a tax-deferred instrument? Well, it's because we take the capital, we bring it in, we buy Bitcoin, we don't sell Bitcoin, because Bitcoin is a digital capital instrument and it's a commodity in the US. Unless you sell the underlying, we don't get taxed on the gains. We take those unrealized gains and we pass them over to our stretch holders. And so we take the 30% unrealized gains, we pass 11.5% it over to you. Because we're not taking gains, you don't see the gains either, right? And we do that through a variety of mechanisms. We could sell our equity, right, and fund it. We could sell our Bitcoin and fund it. We could sell other prefers and we can fund it. But we don't sell the underlying at a gain. Therefore, you have return of capital treatment. What does this mean, by the way? It means as long as you don't sell the underlying, you get a 0% dividend tax rate, and this passes through to most countries in Europe too, right? And what happens is the cost basis writes down. So at 11.5% over 9 years, you don't have to pay any taxes in 9 years. You start paying qualified dividend taxes, which is 20 to 35%. You never have to pay interest income taxes, which is what stock, bonds, money markets, bank accounts provide charge, which in the US is 37 to 55%. One additional feature in the US, I don't know how this works everywhere else, is if you pass away and you pass on the stretch to your heir, the cost basis steps up so they get another 10 years of tax deferral. So how is this instrument working? How is it performing, right? Conceptually versus actually. The performance has been pretty extraordinary. We've raised $10.5 billion. There's daily liquidity of $335 million. And year to date, we've raised $7.5 billion. And the Sharpe ratio is 1.8. What does this look like? We've gone from 2.8 billion to 10.5 billion in 10 months. Fastest growing product in the history of the world next to IBIT. Financial product or otherwise. You know, if you compare to regular products, it's grown faster than the iPhone. It's grown faster than Google AdWords. It is one of the most best performing products because we've engineered something that nobody else has, right? Just in the world of preferreds, we're the second, we are the largest preferred in the world. I'd mentioned sort of what preferreds were used for in the past. Now they're primarily a bank instrument, right? So Wells Fargo has the second largest preferred. Our liquidity is 22 times the second largest preferred. Average liquidity of a preferred is $1 million. We're at $335 million, right? And here's the ultimate question is, how does it perform? The price has been flat, roughly right around $100, even during a Bitcoin bear market. So Bitcoin goes down, is showing that level of volatility. Ours has shown essentially no volatility, right? And we've been trading within that target range of $99 to $101 pretty much all the time, which is what we were targeting. Volatility has declined from 14% to 3%. And why is this interesting? Well, we're offering 11.5% versus other credit instruments and other instruments in general that are offering 8.4%. If you can get into it, like I mentioned before, private credit, all the way down to a money market, we're providing 3 times the yield of a money market. And on a tax equivalent basis, we're providing 5 times the yield of a money market. Right? You go outside the US and you go, for example, into the euro, it's even harder to get this type of yield in Europe. If you're in Switzerland, the yields that you're getting are negative, right? And here, compared to some cities in the US, but the tax rates are only going up in the US. What about Sharpe ratio? Sharpe ratio is sort of that ultimate goal, right? That an investor is looking for. A Sharpe ratio is how do you perform against the risk-free rate, 3.5%, divided by the volatility. So what is your performance versus the volatility? And here, Stretch is performing better than everybody else. Compared to traditional assets, we outperform. Compared to traditional equities, the only better performing equity in terms of Sharpe ratio right now is NVIDIA. I think you've all heard of NVIDIA. And here we have an instrument that is a digital credit preferred that has a Sharpe ratio as good as NVIDIA and much better than the rest of the Mag 7, right? So here's what you see. We're just getting started, but who are we competing against? $300 trillion of money that's out there. And so what's happening? Is this getting adopted? It's absolutely getting adopted. 80% of retail, 80% of Stretch is owned by retail. When we launched this, 36% was distributed to retail, right? So this is an instrument that people are looking in the retail space as something where it is a good preservation of value, but also some place where you can get real yield. Right now, we have about 3 million estimated beneficiaries. You can see a lot of these folks are buying through regular broker-dealers, Charles Schwab, Fidelity, Robinhood. And interestingly, we're seeing corporations who typically, historically, put their money into money markets that are FDIC insured in many cases, now putting money into digital credit, right? So if you have a treasury that has a 1-year duration, you have working capital that you need to use in the next year, why not get 11.5% on it? We're now one of the leading holdings in our preferred ETFs with BlackRock and Van Eck. You see here, in 10 months, we went from a nobody to number 3 behind Boeing and Oracle in these ETFs. And more are starting to expand into this space. So what's next? What's next with digital credit? And we already see this starting to happen. Well, you can start to build layer 3 products on top of Stretch. And there are 2 options. One is digital money. Take the 4% vol, take it to 0. Take the 11.5% yield, give a little bit less. Or you can create a digital yield product where you step each of those items up, right? And so we're seeing both of those already created. Strip the vol to 0, make it look like a money market even more closely, or lever it up and give even more performance with low volatility, right? And so digital credit can be programmable, right? And so now we're combining Bitcoin with the DeFi world, so you can tokenize, you can create private funds, public funds, and accounts. You can put this on an exchange, an ETF, bank, a network, corporate. There are many products being built off of Stretch, and we've talked to dozens of companies that are doing it. And once you do that, imagine, for example, putting digital credit behind a digital token, right? So Tether or Circle, USDT, USDC as examples. Now imagine they don't have ways to get yield. If they put it Stretch behind it, they can start to provide yield. And we're having those types of conversations already. Now imagine if BlackRock or Vanguard should do the same, or even banks doing the same, where as an alternative to putting your money into a money market and getting 3.5%, they could offer a digital money account where you're getting 11.5%. We're seeing this layer 3 adoption now, right? In the last 2 months, We've seen nearly $1 billion of money going into layer threes built on top of Stretch, $1.3 billion so far. This happened literally in the last 2 months. So what does this do? Why should you care about this as a Bitcoiner? We have found a way to integrate Bitcoin into the banking system, into the digital credit system, and into DeFi, right? So now you have digital capital, digital credit, layer 3, and more applications being built. And this is important because people feel like Bitcoin's being left out of the tokenization conversations, the DeFi conversations, the stablecoin conversations. This is how we get Bitcoin into those conversations. The last thing, if you're a holder of Stretch, we're actually going to make it even better. We're going to go from paying once a month to paying twice a month, everything else being equal, right? And so we're going from 12 payments a year to 24 a year, which effectively it's the same product, same note, double the frequency, an octave higher. It would make us the only semi-monthly instrument in the world in terms of equities. And of course, we know that there are others out there now, SETA, who's doing great innovation on a much smaller scale. They're about $500 million. We're about, we're 10.5 billion, but still very respectable. They're actually moving to daily. So if you're a holder, please go vote. We have a vote that's going to end on June 7th. And with that, I've gone a bit long, but thank you for the time. And would love to spend a little time, Tim, or if anybody wants to answer a couple questions.
Thank you, Phong. 2 quick questions for you before we let you go. What do you see as the upper echelon of amplification that's possible with digital credit? We see, as an example, Strive right now with an amplification ratio between 40 and 45%, let's say. Is this something that the market decides, or are you open to strategy increasing their amplification ratio from where it is right now?
I think that 50 to 60% range is not unrealistic. I think once you get beyond that, you start to stretch out the capital base and the risk profile of the instrument. And we have a lot of risk models and equity models that we run to answer this exact question. So there's what do we think is right? And I think that sort of 40 to 60% range isn't bad. There's also what does the market dictate, to your point, right? Like if we're at 60% and the market's still buying the product and pegging it to par, then maybe you can stretch it even beyond that. So that's how I look at it. All that said, we're pretty early with this instrument, 10 months in, right? And so I think it's early for me to state when we created a brand new category what the right ratios are without letting the market, both on our common and our preferred, sort of dictate what's right.
Last question. What has been the most surprising or memorable conversation that you've had recently with a retail or an institutional investor?
The Prevalon Energy example is a good one. Here's a company that is growing from 20 million in ARR to $1 billion in ARR in 2 years. Like, wow, how do you do that? Well, they basically provide battery backups for high-performance compute data centers, right? And so what's growing like crazy? High-performance compute data centers and AI. What do they need? They need access to energy. What do they want? They want to level out when they're buying energy from the grid. So they buy energy when it's cheap, they put it into batteries, and they deploy the energy when it's expensive. Otherwise, they just use the cheap energy when they need. But this is a massively growing company that's raising money faster than it can deploy, right? Like people are putting in contracts for their batteries 2 years in advance, and they're delivering the battery 2 years later, right? So they have massive amounts of capital. And here, a CFO just out of nowhere sends us an email, Ben Honeywell, and he's like, hey, I think I want to buy a lot of this. How do I do it? We're like, oh, you just go buy it on the market. And he does, and they're up to $80 million. So these folks who are discovering that if you have short-term capital, 1 to 2 year capital, rather than get 3.5% from a money market, why not put it to use, right? And these are very sophisticated individuals who spent a lot of time looking at our instrument, and we're seeing more and more of that. Apex is up to $500 million. We didn't tell them to do it; they just did it, right? And they said, hey, their typical question is, how do I buy it? And what they really are asking is, if I want to buy 500 million, are you giving me a discount? And we're like, no, you just buy it at $100, right? Or now it's actually a discount. It's like $99. That's the discount you get. Buy it in the market.
Thanks for your time today, Phong. We really appreciate it. Warm round of applause for Phong Le. Thank you, sir.
Thank you, everyone.
All right, that was very exciting from Phong. There's quite a few new slides in there that I enjoyed. I'm going to look at those later more closely. So this panel is about institutional investors, and I guess we'll start with brief introductions, where everybody's coming from too, and then we'll dive into. I'm quite excited after Phong's talk, so I think it'll kind of change a little bit of what I was planning. But here we go. Let's start with you, Tyler.
Great. My name's Tyler Evans. Really glad to be here today. I run a firm called UTXO Management. We are now the asset management arm of Nakamoto, which is a U.S. listed public company. I started that firm about 7 years ago, really focused on the Bitcoin space. And so we run a couple strategies at UTXO and have been very focused on the Bitcoin treasury sector for the last couple years. So we were very early pre-IPO investors in Smarter Web Company. And I'm thrilled to sit on the board there, as well as the board of MetaPlanet out of Japan.
Hi everyone, I'm Alexandre. I'm the CIO of Tobam. Tobam is a traditional asset manager, a quant asset manager. We used to work mainly with big institutional out there. And what makes us a bit special, and the reason why I'm here basically, is that we started to talk about Bitcoin and design funds for institutional and to allow them to invest in Bitcoin for quite some time now. The first open-ended fund in Europe has been launched in 2017. And since then, Yves Chouefati, our founder, and all the team have tried to educate institutional investors to the Bitcoin thesis. Tobam is as well a partner of Smarter Web, the Smarter Web company, and of Capital B. And so, yeah, I'm very happy to be here. Thanks for the invite.
I'm Alex Norris. I'm the head of investments at Silver 8 Capital, which is a US investment manager with a directional digital asset strategy. We bought our first Bitcoin from the US Marshals back in late 2014, and we've been, Bitcoin's been our highest conviction bet ever since.
Hi, my name's Alan Howard. I'm a partner at Tennyson Securities in London. We're a specialist stockbroking firm that's really been focused specifically on the digital assets area now for several years. We were the first company to list a Bitcoin miner here in the UK back in 2018, Argo Blockchain, some of you may remember. And we're also the broker and worked on the flotation of Smarter Web. So I probably come here from a UK perspective, but that's where we come from.
Yeah, so we have crypto native, Bitcoin native, US, UK, Europe perspectives up here. And I guess I wanted to start, and we'll kind of see where the conversation flows from here, but from Phong's talk, I want to get your thoughts, whoever wants to jump in, about the typical institutional investor's perspective at this point in time about Bitcoin, but then also about Bitcoin treasury companies as they've been known, And then about digital credit and amplified Bitcoin. And I think you'll see, you guys get the sort of differences, and would love to hear your thoughts on where institutional investors in your networks are at in terms of their understanding and perspectives on those 4 different things.
Well, maybe I can start. So you mentioned the typical institutional investor. So just a word, I mean, there are many typical institutional investors. So let me maybe start on the one we talk to mostly, so the big asset allocator, asset owners out there. And I would say, well, there's the good news. The good news is basically things have really shifted over the last 2 years, I would say. Bitcoin is not taboo anymore. So you have interest. They want to know. They are aware Bitcoin exists and has a purpose in a way. Then it's still a discussion about strategic allocation, how to deal with that, and some of them have taken the leap forward, but most of them are just hesitating, and it's a question of they see Bitcoin as a kind of anecdotal alternative asset for now. It's not a question of, okay, this is strategic for us, like, of course, bonds or equities or even gold. So it's a bit like a curiosity.
I think curiosity is right, and what I think Bitcoin has today, it's really come a long way in terms of education and people's familiarity with it, but it really has a classification problem, where for those investors, what bucket does Bitcoin even fall in? And if you look at most traditional investors, like there are a set of funds that trade commodities, but those are very small relative to equities or bonds, and so Is Bitcoin fall in your commodity allocation, like gold or oil? Does it fall in alternatives? Can we transform it into something that fits into your fixed income allocation, which is a much bigger bucket? And like what arm, what sleeve, what manager actually is the right person inside a massive pension fund to make an allocation to Bitcoin? And I don't think that's still clear for most managers.
Yeah, I mean, look, from my perspective, clearly things are moving in the right direction over the last few years, and so we should all feel very positive about that. But the world I inhabit is talking to traditional small-cap fund managers in the UK, which is, not crypto allocators, just generalist UK fund managers. There is no such thing as a typical UK PM in this space. There are some that are Bitcoin haters, that take on the Financial Times view of the world, that think the government can be trusted to look after the money supply in all of our interests, etc. There are some that are actually tech specialists, but because it's the UK, it's a relatively narrow sector, which means that they don't have the time to deep dive, which is more of a problem. There are some that are momentum junkies that are very happy to talk to this sector when we're in the bull market. When we're in a bear market, they're equally happy to tell everyone that it's over. But for those of us with longer memories, we all know that the bull market is just around the corner. And finally, there's also actual Bitcoin enthusiasts in the fund manager community. But the challenge there is to get them to actively invest on behalf of the funds they actually manage, rather than their personal portfolios. So there's nothing typical, but the good news is that we're moving in the right direction, and we all know that when there's price action in our favor and the bull market is there, it only moves in one direction in terms of enthusiasm.
Yeah.
Yeah, I was just going to add, recent conversations, I've been very, very surprised at how well understood Bitcoin is by big institutions. And by that, I mean there's always a handful of people in every team that really get it, have been trading it, find it interesting for volatility or other reasons. But then you get onto treasury companies, and we're so far behind on that side. I think it's still perceived historically as maybe a regulatory workaround. No one really gets the digital credit side, why there's potentially a sustainable arbitrage there. So lots of education to do there, I think, but lots of people in this room who have made that argument very eloquently today.
Yeah, we'll dig into that, but first I want to touch on what Alan was saying there. Alan, you and I were talking before about how there are many Bitcoin supporters who are working in TradFi roles who, when they get to work, they can't be advocates for Bitcoin.
Yeah, I think I was just recollecting there's a specific investor I know that is extremely enthusiastic about Bitcoin. But when he gets to work, yes, he doesn't have the support of senior management, and he's even kind of reluctant to expose himself in front of his colleagues and his juniors, right? So that's a very interesting phenomenon, and it reminds you that actually the UK is a very consensus, conservative-driven investment community. And what they need is a fear of missing out to kick off, and they need the peer pressure, and they need to make sure they're doing something that everyone else is doing, right? And that's just something in the UK we have to live with. But I'm fortunate to know that there's people from other parts of the world where we can actually lean on thought leadership, which is what particularly North America is doing for us in this space, and that's what we can leverage.
Yeah, I suppose that is true. There's probably a little bit more of that in the US in particular. But I think is a trend in general that institutional investors are thought of as being the smartest in the room and therefore must have the most up-to-date understanding of Bitcoin or Bitcoin treasury companies. In my experience, and perhaps anybody can chime in on that, not so true.
Yeah, maybe with regard to the treasury companies themselves, one problem is that if you talk, to the allocator, you're going to talk about monetary theory, Bitcoin, debasement, that kind of things. And it's hard to get that kind of people down to analyzing, a treasury company itself. And when you discuss directly with the PM, you have other issues there. So it's a bit like what we said about, finding the right people, finding the right frame or sleeve where to put Bitcoin. It's even harder for treasury company right now. And we have strategy, which is well known. Usually these CIO guys have heard about strategy after 2025 performance, you know what I mean? And the MSCI stuff. So, yeah, I think we really, and strategy needs as well, more diversity, more scale in the space, to be able to understand that what treasury company really bring to the table is a risk transfer or risk transformation of Bitcoin return and Bitcoin risk, which is extremely valuable for people doing asset liability management for pension funds or asset owners.
Fantastic. Yeah, maybe that's a good segue into Alex, what you were speaking about earlier, about the risk transformation is a great way to summarize it, of what digital credit represents and how that fits into a Bitcoin treasury model. And you mentioned the sustainability of that. And so what are your thoughts on what that adds to the model and how well known that is?
Yeah, I guess institutional allocators will look through a sort of no arbitrage lens, right? They're looking at how is this sustainable? You're taking on debt, you're buying Bitcoin, you're relying on a certain path. For me, it's sustainable because strategy has found, of course others are now following, a way to get that demand for long duration debt, right? There's no long-term lending market in Bitcoin. So that is a genuine, unarbitrageable financing advantage. I think that needs to be better understood by institutions, and then they'll get quite excited by it, right? Because, if there's a sustainable arbitrage, they'll go for it.
Yeah, that's been one of my intuitions with the development of Stretch recently, is that I think that it will accelerate institutional investor recognition of MSTR as an investment, because it'll fit into what they understand about how this is going to work out. Yeah, any thoughts on that before I want to dive into a digital credit question for Tyler here? Yeah, okay.
I mean, all I'd add to that is I think the big story this year is exactly that, how you optimize the balance sheet of a BTC treasury company around the entire capital stack, viewing Bitcoin as pristine capital. And what Saylor has done in educating the whole community on that has been fantastic. But again, I go back to the thought leadership question. When we talk to UK equity investors, what you're discussing there is essentially a fourth base, and we're trying to get to first base. So that's one of the challenges of being a broker in this market, that we know what's going on in the US, but we're talking to people who are all the way back here. And the way I think about it actually is that the battle for hearts and minds is actually going to be won by the Bitcoin network. As long as that continues as it has the last 17 years, we will get there.
Yeah, that's right. That ultimately the best marketing for Bitcoin or Bitcoin treasury companies is a sustained Bitcoin up and to the right trajectory over time. Bear markets be damned. So Tyler, I want to turn this to digital credit, because what Phong was laying out for us just now. I didn't know that when they introduced Stretch, it was 36% to retail, and then now it's become 80% to retail. And we're starting to see this additional layer of DeFi and stablecoins popping up that are absorbing some of Stretch supply and transforming it further to to digital money, as they're starting to call it. So what do you think's happening there? Where is the demand for digital credit coming from? How do you see that taking shape over time here? And when are institutions going to be loading up, or will they not?
Well, I think the slides Phong just walked through kind of showcase the growth of these products, but really how much of a retail-driven phenomenon it is, which is not unlike Bitcoin. Bitcoin was a retail product for a decade before it became an institutional product with the launch of the ETFs. And that should be some consolation to all of us in the room. Like you're saying, there is an opportunity for the individual investor, for the retail investor, to front-run the institutions, just like we did with Bitcoin, with these digital credit products. And I think a lot of that stems from kind of the retail comfortability with Bitcoin that the institutional allocators are still getting there on. But I do think there's a couple key unlocks missing. One is just the recency of digital credit as an asset class. And when we talk to a lot of allocators, Stretch is 10 months old, doesn't even have a year-long track record. Credit investors in particular are some of the most risk-adverse, long-term oriented capital pools. And so when those products have a one-year track record, a three-year track record, really a five-year track record is kind of the benchmark for a lot of funds to now take this seriously as something that has shown that performance and that credibility over time, that they're willing to take seriously, with the view of making a decade-long bet on the asset class. So some will just mature naturally over time. I think the other big unlock institutionally is really credit ratings around these products. And then the Bitcoin community, especially like the True North guys, have done a great job of creating the credit underwriting lens and framework for how you should underwrite a digital credit product. But when we speak to traditional allocators, even preferred perpetual equities, which is what Stretch is a form of equity. It's not truly a fixed income product. And so things like some of the layer 3 innovations Phong mentioned, and to my own horn, a fund that we recently launched at UTXO a couple weeks ago, are trying to transform these perpetual equities into a true credit fixed income product that can have a credit rating that can fit even more cleanly into a fixed income allocator's view of the world, with a covered loss ratio, or default probabilities, and even some specified terms in some case. So the packaging, the unbundling and rebundling of this core digital capital foundational engine into structures and new securities, ultimately, that the institutional world can understand and kind of digest and can fit cleanly into one of those allocator buckets, is the work to be done over the next 3 or 5 years.
Yeah, that's right. I think we're at the very outset of this raw ingredient that strategy has now created, being transformed into all sorts of different products, and made to fit into institutional investor mandates and what they're expecting. So Alex, a question for you if we have an asset that's 11.5% annual return and 3-4% vol, how does that change? The Sharpe ratio is as good as NVIDIA, better than every other stock out there. In some ways, perhaps mispriced risk. In my opinion, I think it's quite low risk, really. So how does that change portfolio construction for many institutional investors? How does this fit into their mandates?
I don't want to pour too much cold water on Stretch because I do think it's fantastic, but it's not liquid enough yet. It's very, very liquid, but it's not liquid enough yet. And the vol is a little bit of an illusion, right? Because if it depegs, it's going to depeg significantly. It could go under 90 in a stress scenario. So for us, how we think about, we hold some Stretch, how we think about putting in the portfolio is we're already underwriting that Bitcoin risk. For us, it's a very nice sort of way of using cash. We monitor it very actively, and we know that we can hedge it if we need to with Bitcoin options. To get to the point where it's more attractive to institutions, I think it's just time, size, liquidity, and seeing a stress event maybe and being able to see how the market reacts to that, liquidity coming back, and the ability for strategy to handle that.
Interesting. Yeah, so it's still not big enough.
Yeah, maybe a quick word on that, because actually I used to be a credit investor for some time, so
I didn't know that.
I went to answer that. I mean, we are conservative people. That's pretty true. But I think one thing that could really help, and that is really needed, to get from where we are at the beginning of the story of digital credit to a real market, is an opportunity to diversify risk and more issuers, because of course, it's easy to think of digital credit like, you have Bitcoin collateralized credit and that's the same for everyone, but that's not true. You have a major component in the credit risk, which is willingness to pay, what we call willingness to pay. I mean, the management of the company matters a lot. Everyone is not going to have the same LTV, the same rules, the same project, and the only thing you can do to really manage credit risk is diversify. So we really need other, issuers coming to the market at scale.
Noted. You make a very good point. There's really only two that are currently trading, and if it is as big of an innovation and an unlock for how capital can flow into Bitcoin and the incredible value proposition to fixed income investors that it appears to be, you would expect there will be more than two in the probably not too distant future. Yeah, so I'm curious just in general about, we've talked about Stretch and we barely touched on amplified Bitcoin. I'm curious about, folks in your networks. Have they asked you about Stretch? Have they asked you about what's strategy doing? What are all these prefs? Is that something that's on their mind at all or completely off their radar?
Well, I'll start with my UK equity network. I mean, I think, yes, the awareness of what Saylor is doing is very strong. But there is some confusion as to what amplification or leverage brings to the model. And all I would say, I think, from a simple equity investor's perspective is that they all come into the room with different ideas of what they want from the meeting with a Bitcoin treasury company. They have established ways of looking at companies, cash flow, asset values, earnings multiples, all that stuff. And you never know exactly what the conversation is going to go to, but they have their established ways. And the most important thing a Bitcoin treasury company can do is give consistent, regular, high-quality balance sheet information, because that's what enables the equity story to be discussed in the room. Because they will have radically different views as to whether this leverage, this amplification is something they want to go with. They will also have radically different views of why they want to invest in a Bitcoin treasury company, whether it's a leverage play, whether it's a proxy ETF, or whether they really buy into the Bitcoin per share, the Bitcoin yield story. So, all these things are on the table. But from a simple equity investor's perspective, the most important thing is the track record of high-quality balance sheet information. And the good news is that the best Bitcoin treasury companies are doing exactly that.
Yeah, that is one of the reasons Smarter Web cares so much about data transparency and how we represent our track record over time, because I think it's the way to win is to showcase that this is what the state of the balance sheet looks like and how it tracks over time, because Bitcoin does that heavy lifting for you, and if you're well positioned, you get to reap more than Bitcoin returns because of the potential of amplified Bitcoin. But yeah, if any others wanted to.
Yeah, I think Stretch and what Strategy have done this first half of this year is probably the second biggest story of the year. Well, I'm sure we'll come on to, at least in my opinion, what the first one is. But we're getting constant inflow from our investors now about Strategy, what they're doing. They want to know about it, the sophisticated investors, and they really, they're starting to engage with it. Once you explain and go through what the model is, they love it. So at least that's what we've seen so far.
That is encouraging. So I guess we have a couple minutes here, and one theme that I wanted to sort of spotlight a little bit more is, and we'll wrap with this, is institutional investors are sort of viewed as this mythical sort of character, this archetype that will come and save the market, right? Like the institutional investors are coming, and in my experience now speaking with many of them, I have a sort of different view of institutional investors in general. Do any of you want to share sort of your thoughts on the mismatch between market perception of institutional investors and reality, or any just general thoughts about what the broader Bitcoin investor landscape should think about institutional investors?
Yeah, maybe one word about central banks. So I've heard quite a lot that, well, we're waiting for central banks to buy Bitcoin as a reserve asset, and this is when things are going to really realize and we're all going to be happy, blah, blah, blah. Well, I think that's a bit of a misunderstanding of what a central bank is doing when accumulating reserve, and the point is, what they really want to do is to ensure that their currency is going to be tradable. They're going to be able to exchange things. So that means that when these institutions are going to accumulate Bitcoin, it's going to be the last trade or the last institution to come to this market. It doesn't mean it's not going to happen. Of course it will at some point, but I mean, the price will be different, the volatility will be different. And we're still at the start of the adoption, so really it's not going to start by the PBOC. Stop looking at that.
I think another underrated factor too is that institutional investors are unique in that they have career risk still with Bitcoin, where for us to make a trade, be okay with the volatility, but for someone sitting in those big allocator seats, even to get comfortable with Bitcoin or be known around the office as the Bitcoin guy, or to invest in something that's novel like Stretch, there is real career risk, not just monetary risk of it being a bad trade that goes poorly, but of their entire team being fired if it goes the wrong way against them. And so that the fear and greed that drive all investing are just as real for the biggest allocators in the world.
I think I'd just add to that we know some investors whose careers have gone very well because of investing in Argo and Smarter Web. So, it does work both ways.
I was just going to add on to wrap up then that for me the big story was Morgan Stanley. I think they've now underwritten from the top down. You can talk about Bitcoin in the office, with the ETF launch. That's going to change everything.
Absolutely. Good point to finish this on. And yeah, just in general, I think that institutional investors are not ahead of retail. It's because each retail investor is an investment committee of one, and it's much easier to get to a place where you feel comfortable or have conviction in something that's new, and that's just not true of institutional investors. So I think it's an opportunity that exists in Bitcoin, and is pretty unique to Bitcoin, where you can be ahead of institutional investors. So yeah, thank you everybody for this panel. Thank you.
Mic perfect, and the clicker. All right. Good evening, Bristol. First off, thank you so much to Andrew and the SWC team for having me and all of us here. My name is Borja. I'm co-founder and CEO of Roxxon. Maybe you saw that logo in Fong's presentation. We're one of those guys building stuff over digital credit. And today I'm here to talk about digital equities, right? Tokenized equities, whatever you want to name it. And when I was thinking about this presentation, I was thinking, what is the best way to put this? So this is the way. What is the most important thing for a Bitcoiner ever, financially wise, right? Why are we all here, essentially? And the answer is pretty easy, right? The only thing that we need to work on, financially wise, again, is to make sure that we have more Bitcoin today than yesterday, and that we have less Bitcoin today than tomorrow. That's our financial mission, let's say, and our task. We always need to have more Bitcoin. Another way to put it is, everybody is a Bitcoin treasury company. You are Bitcoin treasury people. Your mission, again, is to have more and more Bitcoin every single day. This is our mandate. This is what we have to do, right? Besides having a family, being happy, etc. Besides all of that, you need to have more Bitcoin, right? And so then the big question is, how do we accumulate more Bitcoin? Okay, I understand it. Like, I need to have more Bitcoin over time. This is what I have to do. I will do my family and myself a favor in the future if this is what I work to achieve. So how do I do this? How can I be great at stacking more Bitcoin? And for me, that I come from Argentina, for you guys to know, like 20 years ago, 1 peso was $1. Now $1 is 1,500 pesos. So, you know, the way that Argentines managed to actually have welfare, let's say, or a good financial life was switching the mindset. Argentines stopped thinking in pesos, stopped pricing their wealth in pesos, and they switched their unit of account. So everybody went from living and saving in pesos to living and saving in dollars, right? Easy, hard currency. What else are you going to save in? For us in Roxxon, Bitcoin is to the dollar what the dollar has been to the Argentine peso, right? The harder currency, the new unit of account. The way we see it, the US dollar, the British pound, the European euro, they are just way more beautiful pesos, but they are still pesos. They still have the same intrinsic problem. They still have the same root problem, which is they get inflated, depreciated every single day through printing and so on. So how do we accumulate Bitcoin at a conceptual level? Well, we think Bitcoin. In the same way that Argentines started thinking dollars, we think Bitcoin. So if I invest in the SP 500, I'm not looking at the entry price of the SP 500 in dollars. I'm looking at the entry price in Bitcoin terms. And whenever I sell, or whenever I want to track the performance of this investment I did in the SP 500, I should always be tracking the performance in Bitcoin terms. That is thinking in Bitcoin. That is pricing my investments in Bitcoin. That is understanding my wealth in Bitcoin. If I buy an apartment, I should be thinking about how much Bitcoin I'm investing. All I care about is how much Bitcoin I'm worth, not how many dollars I have or how many dollars my Bitcoin are worth. All I care about is how much Bitcoin do I have. And the answer of why is easy. I believe that Bitcoin will be in less than 10 years $1 million, then it'll be 5 million, then it'll be 10 million, and whatever. And so if I have 1,000 Bitcoin, then I'm going to have $1 billion, right? It's the same thing as in Argentina. Why did everybody switch from thinking in pesos to thinking in dollars? Well, because everybody knew that $1 would be thousands of pesos in many years, and here we are, right? So we see the same thing happening here. And so we think in Bitcoin, we price the world in Bitcoin, and so then we can accumulate Bitcoin because every investment and financial decision that we're going to make we're going to know if it's good or bad. If the investment I make is worth more Bitcoin, then it's a good investment decision, right? If the investment I make is worth less Bitcoin, then it's a bad trade. And so at Roxxon, we believe there's many ways, but mainly 3 ways nowadays to stack more Bitcoin, to actually get more Bitcoin on the way. Number 1 is great equities. NVIDIA from 2018 to today, 1,000% in Bitcoin. We were talking about this before. This means that if you had 100 Bitcoin back in 2018, when Bitcoin was $3,000, and you said, I'm going to put all my Bitcoin into NVIDIA, your portfolio now would be worth 1,100 Bitcoin. So the best thing I could have ever done as a Bitcoiner ever in 2018 was investing in NVIDIA. Or I'll give another example, strategy. Sorry, this is strategy. This is from 2020 to today, 2 bull markets, 75, 76% in Bitcoin terms, right? So if you invested 100 BTC worth of dollars into NVIDIA, now your portfolio would be worth 175 Bitcoin, right? And like this, I could continue. This is a chart on NVIDIA. Again, you can see there 1,000%, 977% from 2018 to today. And this is what we do every day in Roxxon, right? We allow everybody to access global equities. Right now we support US equities and soon many other equities from different places, SWC, Capital B, and many, many others from anywhere in the world. And everything is priced in Bitcoin, just so that you guys know if your investment is good or not. Because what's the point of tracking your investment in dollars or in pounds if you want to stack more sats, right? Number 2, Bitcoin dividends. This is one I love. Did you guys know that starting from June 16th, you'll be able to get Bitcoin every single day? Every single day you can get Bitcoin. Sounds like a scam, right? Because if I tell you you can get Bitcoin every day, yeah, it's very weird. But this is what's happening with things like SATA, things like Stretch. With Stretch, you're going to be getting Bitcoin dividends semi-monthly, and you're going to be getting Bitcoin daily dividends every day of your life. And how is this possible? Well, again, what we do in Roxxon is a Bitcoin investment platform, let's say, and naturally dividends are paid out in Bitcoin. So you want to make sure that the assets that you hold, if you guys hold digital credit, the way we see it is, this should be serving me more Bitcoin, and this is why we do it, right? And so, for example, in our case, and this is beyond Roxxon, you could guys do this in your houses or on your own, but this is why we do what we do, because thanks to things like SATA and Stretch, now people will be able to make Bitcoin every single day. You're making Bitcoin, and the other way to put it is, if you're not making Bitcoin or getting Bitcoin every day, then what are you doing, right? Yeah, this is a beautiful moment that you get once a month and that you get every single day in 2 weeks. And then you have Bitcoin carry trades. What is this? Well, this is a trade. I have Bitcoin. I borrow against my Bitcoin at, you could go to DeFi, 4%, 5%, 6%. We lend out at 7%. I get that money, then I buy SATA or Stretch at 11.5%, 13%. I have a 4.5% difference. That's a Bitcoin yield. That's a Bitcoin carry trade. What if I told you that you could generate Bitcoin yield by having exposure to oil? Anybody, quickly raise your hands. Anybody knows Petrobras, Brazilian oil company? Few hands here and there. Petrobras is one of the largest oil companies in the world, Brazilian-based, largest oil company in Latin America. They had a corporate bond that already expired a few weeks ago that used to yield 11%. Now they have a new bond that is yielding 8.75%. But the whole point is, I can do the same carry trade I just talked about. I can borrow against my Bitcoin at 4, 5, 6, 7% and buy notes of one of the strongest oil companies in the world, yielding at 8.75% right now. And so now I'm having Bitcoin yield with exposure to the oil industry. So yeah, you're bought into gold and you're making Bitcoin yield. And so this is the kind of things that we are thinking about every day, right? Because again, for us, Bitcoin is our currency, is our unit of account, is our hurdle rate. And so we're always working on this kind of Bitcoin-denominated trades. And what's the common ground in all of this? Well, the common ground is this, is tokenized equities. Because through tokenized equities, we can offer people from all over the world access to all of these opportunities. How can you allow somebody from Japan to do the Petrobras carry trade? How can you allow somebody from the UK to do the Stretch carry trade, Petrobras carry trade, invest in Stretch, SATA, any Bitcoin treasury company, buy Capital B, SWC? How can you connect the dots? And all of these dots are connected through tokenized equities, right? And this is why tokenized equities are so important, because today, if you guys want to invest in any market, you could. It just has a lot of friction. And tokenized equities remove this friction, and they allow for any of you guys to do any of the things I was just talking about in a couple of clicks. And this is exactly, right, the result. Then you end up with this. You end up having centralized venues or decentralized venues in the future from where any of you guys, again, can invest in any of these assets, do any of these carry trades, and so on. So since we're finishing, I just want you guys to have in your mind two things. Number one, always be stacking harder and making more Bitcoin. Number two, there's many ways of doing so. We know as safe ways these three. And number three, all of this is possible thanks to tokenized equities. So thank you very much.
Please welcome to the stage virtually the Chairman and CEO of Strive, Matt Cole. Matt, how are you today? Thanks for joining us.
Tim, doing good. How you doing?
I'm doing great. How's the gym behind you? You getting a workout in?
Workout this morning. It's going well, man. I think Bitcoin's the hurdle rate financially, but we also got to take care of our health as well.
Workout, hydrate, buy Bitcoin, something like that?
Exactly.
Let's dive right in. We were speaking with Phong a few minutes ago, and I asked him what he thought the maybe higher echelon of amplification ratio might be. You know, right now, correct me if I'm wrong, Strive's in the low 40s, 42, 45, 42.5. I'm sure it changes every day. What are you seeing in the market, and what do you see as something that's you're comfortable with, that's responsible? Does the market decide? And I'll give you the TLDR. I don't know if you saw the interview. He said 50 to 60%, then he said 40 to 60% plus. So what are your thoughts on financial engineering is a term that we've used a lot today?
Yeah, I actually did catch the interview. I think he might have also said that if the market was comfortable, that if digital credit was pegged at 100, even higher than 60% could make sense. And so I think a couple things are true. One, that when you don't have debt, when your balance sheet is debt-free and you're amplifying with preferred equity only, that from a risk management perspective, especially with Bitcoin, as we're talking right now, Bitcoin's down on the day, it's 72,700. The 200-week moving average is not much further below this. I think we've been in a bear market, that whatever your comfortable range of amplification is, you should want it to be at the highest end of that range when Bitcoin is really cheap. And I think right now, Bitcoin is really cheap. And so when you actually run all the different Monte Carlo simulations, thousands of different simulations of, how does it break from a credit perspective, right? Not just from does SATA stay at 100, but just does the model work? That amplification could push much higher than 60% if you have a cash reserve in place. If you assume that the current Bitcoin bear market will not be deeper or longer in duration than prior Bitcoin bear markets. And so right now, the current Bitcoin bear market has been a very mild one. The sentiment might be low, but the lowest Bitcoin's been from its previous all-time high right now has been about 50%. Historically, it's been 80% plus drawdowns. And I think that's consistent, Tim, with what you and I on the hurdle rate have been talking about for ever since I've known you, about this concept of that we're probably more in a super cycle right now than we are in a typical Bitcoin bear winter, which I'm skeptical that we see 80% drawdowns in Bitcoin maybe ever again, but definitely not in this bear market. And so if you have that belief and you think that, likely the Bitcoin bottom is in, but even if the Bitcoin bottom isn't in, that we don't go much lower than the previous low, then you would want to be amplified to the max right now. And so I think, even a 70%, 80% plus amplification ratio with preferred equity would not be something that I think a company would struggle to get through from a credit perspective. The flip side of that is that may not be true from a market perspective. The market may not let a company go that high before it starts pricing in concerns on either the common equity or the preferred equity, right? And so this is where you really start getting into more of the art than the science, right? We are underwriting a perpetual bull thesis in Bitcoin with digital credit, and that flywheel is most successful if the preferred equity investor has confidence in the security, right? That it's trading well from a credit perspective, and that the common equity has confidence in the company that it'll be able to manage those liabilities over the long run. So you have to manage both of those stakeholders very seriously. And so what have we seen in the market to date? I think Andrew Webley has covered this really well, but the market has rewarded, generally speaking, higher amplification, not just with a higher, EV multiple, but also a higher market cap multiple. They view higher amplification as more bullish if they think that the company is going to be able to survive and thrive with that. We see that across kind of the industry right now. So that's one data point that suggests that the market is comfortable with higher amplification ratios. The second is that you look at SEDA as an example. It's pegging at par right now. We're moving towards daily dividends and we obviously have a higher amplification ratio than Strategy, but SEDA's liquidity on a relative basis. So for one share of SEDA, how liquid is it, is actually more liquid than Stretch. Since we've announced daily dividends, it's been pegging at par more frequently, and we have higher amplification. So maybe amplification ratio is not the number one concern for the investor in digital credit. Maybe they're more concerned with dividend frequency, they're more concerned with the yield, and still underwriting a general belief that Bitcoin will go up into the future, right? Right now, with Strive's amplification ratio, 45% plus, we're very active in the markets right now. So I guess you'll see next week what our amplification ratio is, our new one, but that the market's pricing in a lot of confidence in that. And I'm glad to see that, because I think, Tim, you've obviously been part of the True North crowd that I think is the institutional grade analysis on digital credit. And they've gone deep into how hard it is to break these structures. And I think the market is saying they agree with that analysis. And so all that to say, that was a super long answer, that I think that 60% amplification doesn't even give me a heartburn at all, but that we will also care what the market's perception is of that as we manage our risk.
I'm going to go right to what I think, at least for me, and I don't think I'm being selfish here, is like the most important question. What creates liquidity and trading volume in a Bitcoin treasury equity, in a Bitcoin treasury publicly traded company? Is it education and podcasters per share, as we talk about? Is it being big enough to have institutional allocations from institutions? Is it something else? What's the secret sauce to some of these companies having liquidity and trading volume and other ones not?
I think it's mostly driven by capital structure and belief in creating a flywheel to amplify and outperform Bitcoin over time. And so what I mean by that is you look at Strive and our common equity, which I think is probably the most liquid per Bitcoin owned in the ecosystem right now. And we like to joke about podcasters per share. I think that's going to age into like an epic meme that if you were there, you'll know. But for those that aren't there, we'll just think we're crazy that podcasters drive, in and of itself, drive value. But it ultimately is the structure itself. And so what do I think that investors want? I think investors want a understanding that there's not some debt term that causes potential liquidation risk. I think people get, I would say, almost overly concerned with that relative to the actual risk, which kind of gets into, when Strive had, we talked about this in the hurdle rate, Tim, but when Strive had literally less than $1 million of debt remaining, and I was so focused on retiring that last $800,000 of debt because I knew that it would just live kind of rent-free more than it should in people's minds. So I think that is something that causes almost irrational fear, but they want amplification. So effectively they want levered Bitcoin exposure without the ability to get liquidated to the downside. I think that's really important for people. And I think that's most effectively done through digital credit. And so, I think as other players enter the digital credit ecosystem in the Bitcoin treasury landscape, I think the market will reward that to the extent that they can get liquidity in the digital credit instrument. And so that's going to be providing something that the market wants. So that could be a digital credit that pays in the pound. It could be the one that pays in the euro and the yen. And obviously there's different regulations, but just at a high level, if you think about, I think about digital credit as it's obviously not a money market account. That's literally like the first thing you see on our website. But I do think that digital credit, if designed well, can be better than a money market account. And that the demand for that can be exponentially high. I think it's going to be north of $3 trillion pretty easily in the next 10 years. And when you think about something that is that large of an opportunity, it makes sense for there to be more than one issuer. Right now there's two. I think it makes sense for there to be much more than two. And for each issuer to really think about what is the value proposition that I'm bringing that's different than the ones that are out there. And I think that there's so many different ways that could go. It could be what you pay in. For Strive, we took the approach of being kind of the perpetual Bitcoin bull. We're going to run fast with high amplification, and we're going to pay a higher yield on the digital credit ecosystem. And we think that there was going to be demand on both sides, and that thesis is playing out. But I think there's a lot of other very coherent theses that I think will have a lot of demand with a digital credit instrument that will power a Bitcoin treasury company. So, it's going to be very interesting to see what the different players come up with. But I think there's a lot of demand for more players, and we want to be helpful in getting more players out there because it helps us too, to have a thriving digital credit ecosystem, to having a thriving Bitcoin treasury ecosystem. And I think that's what we're going to see over time.
I kind of feel bad putting you on the spot with a technical question, but you mentioned there's two issuers of digital credit right now. Do you know how many, or approximately, obviously more than two, products from separate issuers we would need in order to build this ecosystem, meaning certain ETFs, ETPs need a certain basket of products, not just one or two. I think, 21 Shares launched something in Europe, but I don't think we've seen anything launched in the US yet. Can you speak to that at all? And then on top of digital credit, what are you seeing behind the scenes, or what conversations are you having both in the traditional finance side and the DeFi side as we, is it going to be blockchain, tokenized, whatever the words are, to export to the world, or what do you see maybe through the rest of this year?
On the ETF side, you probably need 30 to 40 issuers, really, to say you have a mature industry. There are workarounds in ETF land through things like swaps, where you can create ETF products with less issuers. We announced a digital credit ETF that's effectively a levered version of something that will hold both SATA and Stretch. And that was actually from talking to financial advisors and asking them what type of an ETF they would like to see. I'll never forget that that made Michael Saylor laugh when I told him that people want levered exposure to digital credit in the financial advisor space. But that is something that we're putting out there and will allow us to talk digital credit, just even SATA and Stretch directly to about 7,600 advisors that we're connected through on our ETF business. So, but if it's 30 to 40, that means that there needs to be a lot more issuers of digital credit. But if you think about any financial services industry, banking, insurance companies, there are so many different banks, there's so many different insurance companies. And if you asked an average person, what's the difference between Bank of America and JP Morgan besides the brand, they couldn't give you an answer, but they're both massive and there's massive demand for them. And I think the same is true in the Bitcoin treasury space, which is why it's such a fun space. It's why you have a conference like this with the Smarter Web company, and you have all sorts of different executives from different Bitcoin treasury companies that are coming in that want to see Smarter Web win, and Smarter Web wants to see them win, right? It's about growing the pie at this stage and being collaborative with each other, friendly, competition type sort of thing. And I think that will continue for, the next decade plus, to come. As far as what we're seeing talking across the institutions, the DeFi ecosystem, I think right now it's been pretty well covered that Stretch is 80% owned by retail. It started out smaller. Strive has something similar. I'll say that the data to verify these things is really opaque. Just as an example, we'll see like a very large holding from Fidelity for SATA, and Fidelity we know is part retail and also part institution, and breaking that out is hard. So I think there is some data quality issues in those, but we do know that it started out more institutional on both of them and it's moved more retail, and that kind of makes sense to me. Bitcoin was a retail phenomenon before institutions even started looking at it, and I think digital credit will be a similar thing, which leads to the DeFi part of the conversation. I think DeFi is going to be huge for digital credit, and it's really not that crazy when you actually unpack it a little bit. That there is demand for hundreds of billions of dollars of stablecoins, and the primary source of that demand is not in a place like the United States. My credit card works, and so for me to go from using my credit card and paying it off, whatever every week or something, to using a stablecoin, that doesn't really solve a solution. It doesn't really solve a pain point in a lot of people in more developed countries' lives. But in the overseas kind of third world authoritarian nation places, there is a desire to be outside that system and to be in something that's more stable, which was the rise of stablecoins, like Tether as the primary example. I think that digital credit is going to compete directly with that, to the extent that those investors, those multimillionaires, billionaires overseas that are stablecoin buyers, see the ability to get an attractive yield in an instrument that has not a lot of volatility, and they're already on chain, so they already are obviously going to understand things like Bitcoin. I think the demand for that is going to absolutely skyrocket. And to the point on one of the last panels, unlike an institution, those buyers of stablecoins, they have an investment committee of one individual. And so I think they can move very quickly. And I think as tokenization happens and makes these products available to them, I think you're going to see very quick demand to continue on chain.
Matt, many people probably know that we consider Bitcoin to be our hurdle rate, but the conversation has kind of come around to Stretch and SATA digital credit being the hurdle rate for corporations. Do you agree with that? And have the conversations you've had with executives changed over time from more of you should adopt a Bitcoin treasury strategy to, you should look at digital credit, and I would assume that digital credit conversation is easier. But what has been from your seat, your experience with Bitcoin versus digital credit in the public or private sector? And I'll stop there.
It comes down to a couple different things. One of them is your conviction in Bitcoin. And so I think what you're seeing right now is kind of a bifurcation of the initial, influx of Bitcoin treasury companies, that some of them actually did not have conviction in Bitcoin. I think they viewed it as more of a get-rich-quick scheme for their corporations, and you're seeing them capitulate on the strategy, right? We're seeing that even yesterday, a company completely abandoned their Bitcoin strategy less than a year after they've done it for probably no reason other than Bitcoin's in a bear market, and they weren't prepared to ride that out. And then you're seeing other companies like a Smarter Web company, like Strive, like Strategy, a handful of others that are continuing to stack, like unapologetically, unfazed. For those types of companies, Bitcoin is a better hurdle rate than digital credit, right? Because they actually have the conviction and the ability to stack regardless of the volatility, and can take a long-term time horizon. For the average company, they're just trying to meet their bills. They're trying to park their cash to invest in the future, and they're able to go from cash or treasuries to digital credit and go from something that is losing money relative to the rate of debasement of fiat currencies, around 6 to 7% a year, to something in digital credit that actually is outpacing that. And so that's a better instrument, while, and I think this is the reality right now, is that fiat currencies are still the reserve currency. The dollar is the reserve currency of the world right now. I think we're in a fourth turning. I think we're moving from a system where fiat currencies are the main source of money to a Bitcoin denominated future. But I think that's going to take probably decades, even still, as Bitcoin moves into the millions of dollars per coin. And during that transition, I think digital credit is a great form of effectively money or savings for these corporations, where they don't have to underwrite the volatility of Bitcoin, but they can still benefit from this monetary transition instead of being harmed by it.
The first daily dividend from Strive, from SETA, is June 16th. The next, June 17th, is the next Fed rate decision in the United States. What are 2 or 3 or 1 things that you're looking at every single day that, short to medium term, could at least give us an idea of where we're going, in addition to Bitcoin per share?
Yeah, on the Fed side, because of the war, there's obviously some, and even because of the quick growth of AI, right? The build out of all the infrastructure, there's a lot of short to medium term inflationary demands. But when you look beyond that, there's kind of a deflationary cliff that you're starting to see from AI. And so what I think that will likely do with someone like Warsh, that has decidedly been more forward looking, is probably be on the dovish side. So I think he's going to be more likely to just kind of hold steady through this higher inflation period. It's hard to see him do rate cuts, although I actually think that rate cuts would probably be more appropriate than rate hikes. But I think they probably don't have that much guts as an institution. So my guess is they'll just hold, even though the market, I think, is pricing in a hike right now. And then ultimately, as if and when the war in Iran winds down, I think we'll start to move a little bit towards rate cuts. But I think what we're seeing right now is, we're seeing record highs in the stock market. I think Bitcoin is kind of in its bottoming process. And I think we're entering into a productivity boom. And I think that's ultimately going to drive Bitcoin substantially higher. And I think it's going to break out sometime in the next 12 to 18 months, probably, I would say, on the shorter end of that than the longer end of that. But we don't need to underwrite as a company that it needs to happen in the short term. So I push that out a little bit, but I think we're going much higher. I think Bitcoin treasury companies that have had conviction during this bear market are going to develop a great track record that will benefit their company for decades to come.
Matt Cole, Chairman and CEO of Strive, thanks for this fireside today. We really appreciate your time.
Thanks, Tim.
All right, Ed Julien and Andrew Webley. Andrew, thank you for saying yes to a conference in the UK.
Thank you all for staying. When Andrew called Tim and I a number of months ago and said, I want to bring what you guys did in New York to Bristol, it's like, how are we going to get people to Bristol, Tennessee? That's going to be a tough one, right? So he corrected me, he said, no, it's in the UK. But no, what a pleasure to come here. I can't believe you guys live with this heat all year long. It's got to be just devastating. You know, we like to do two things when we do these events. One is that you're entertained. You know, it's like watching a show. I think we get a lot of panel fatigue and you get a little bored of it, but that this room stayed filled all day was a real testament. I think that we put a show on. The second one is connections. I hope that out in the hallway and the way this beautiful facility is laid out, you were able to make some great connections. Those are the two most important things that we do. And before Andrew kind of gives his closing thoughts here, we are doing our conference again in New York in September. You can either go to bitcointreasuries.net or to Luma, look for Bitcoin Treasuries Conference, and it'll be either the 14th or the 15th in New York. Bigger, better than last year, so hope to see you all there. And Andrew, what do you have to say and to announce?
Well, firstly, I just want to say thank you, Ed and Tim. You know, it's appreciated, and you know, looking forward to doing this event with you again next year. If anyone wants to buy like an early bird ticket for it, then they're on the website. You know, in a few months' time, we'll start putting out the agenda, speakers, and all that stuff. But one thing that I did want to say before you all shoot off is, you know, everyone thinks of me as smarter web, and I think sometimes they don't always think about the whole team, and not only Jesse and some of the others, but with specific reference to this conference, you know, Laura and Alex, you know, if they're here, Alex over there, and yeah, I can't see Laura, she's probably working still. Yeah, they've done so much, and it wouldn't be possible. And then, you know, some of the rest of the team are here. So Sean, our chairman, he might be in the audience somewhere. Mario, Oliver, Jamie couldn't make it today. You know, there's a whole team of people that work really, really hard to try and make the company better. But yeah, in terms of the conference, you know, we couldn't have done it without Laura and Alex. You know, it's been quite remarkable, actually. So other than that, I just wanted to thank all of you for coming, the sponsors for, you know, sort of, you know, largely funding the event, the speakers for giving up their time. I hope that you've enjoyed the content. When I wanted to do it originally, my most important goal was that we could have a day of content that we could sit through, and on the whole, it be something that most people would enjoy, pretty much all of it. And I think with the great speakers that we've had today, in my view, we've achieved that. So, yeah, any closing words?
We're going higher. Lost for words.
Yeah, first time ever. We're going higher.
Support the sponsors, right? They put their money into this because they're trying to get something out of you, and that's perfectly fine. So, you know, when you see the sponsor list up here, use them because they're the ones that are going to make these events happen. Thank you for buying your tickets. If you bought your ticket, buy your ticket for next year. And support events. Bear markets are really tough for events. We don't get the tourists, right? So in times when Bitcoin is spiking, we would have filled the hall next door if you haven't seen that. So keep supporting the events. Come, network, enjoy the content. And we'll look back on this one as a tiny event we did back in 2026. So thank you all very much. We'll see you next year or in New York in September.